cut interest rates maybe a little bit more. So I would think pockets of consumer discretionary probably look relatively good as well. But to be honest, I'm not doing a lot of work on sectors, but those would be some ideas for you.
Okay, all right. Really appreciate it. Thank you very much for joining us on the show this Friday and leaving us feeling fairly optimistic. So that's a thumbs up coming in from Jeffrey Dennis on India. With that, let's tell you what are the interactions lined up on the show today. At 8:35, we'll be speaking with the management of Capacité Infraprojects. The company has received a letter of intent from the Saifi Burhani Upliftment Trust for a project in Mumbai worth over 600 crores. At 9 o'clock, we'll be in conversation with Kapil Singh of Nomura, India. Reports are saying that the anti-lock braking systems will become mandatory for two-wheelers. So what could that mean for the listed space? We'll find out. Krishna Sangvi joins in at 9:20 a.m. He is our market master of the day. At 9:30 a.m., we'll have Chanchal Rajora of Transformers and Rectifiers and Nikhil Nigania of Bernstein joining in to talk about some of the key developments in the power sector and the fact that the Mumbai market, for instance, Pune and Mumbai, could be getting more competitive. There are more players who are interested in hopping over in the discom space over here. At 9:50, Amita Malhotra of HSBC India and Bhavesh Shah of Aquarius join in to talk about the recent block deal buzz that we've seen. Towards the end of the show, in our special segment, Indianomics, Lata today speaks with the economist Praveen Krishna of John Hopkins on the likelihood of reciprocal tariffs after the July 9 deadline. Okay, on that note, we'll take a very quick break. Come back on the other side and all the key stocks to watch this morning.
Welcome back. You're watching us here on Bazaar Morning Call. Good start to the new series, and the Gift Nifty is indicating a start in the positive by over 100 points. So that's the kind of move that we're seeing after a big move that we saw in yesterday's trading session as well. So let's drill it down to individual stocks. We have Vivek joining in on why Tata Power will be in focus this morning. Vivek.
Well, good morning. Very interesting development as far as the state of Maharashtra is concerned. Just a couple of days ago, we had told you about how Torrent Power had evinced interest and had received a conditional nod from MERC to operate as a parallel electricity distribution company. Now, along the similar lines, you're actually seeing Tata Power also looking to enter the parallel electricity distribution sector in Maharashtra. They've applied to MERC, which is the Maharashtra Electricity Regulatory Commission, and they've applied for a license to operate parallel electricity distribution in 10 areas in the state of of Maharashtra. So, what Tata Power told us was that, the total consumer base already stands at 12.8 million across Mumbai, Delhi, Odisha, as well as Ajmer, where they operate as the discom provider. So these new additions will allow them to cross the 15 million mark. So it's an interesting development, important development. Expect some green on the stock today.
Got it. Thanks a lot for that, Viv. Let's go across to Vama. She's here to tell us about some stocks and news. Morning, Vama.
Good morning, Nigel. Let me first start off with Hitachi Energy. They've received an order from Power Grid. They will be supplying 30 units of 765 kV, 500 MVA single-phase transformers, and analysts are suggesting that this order could be worth over 1,000 crores, so bodes well for the company. Mahindra Lifespace is the next counter that I'm watching out for. This counter is also expected to open higher because they have been chosen as the developer for a redevelopment project in Mulund, Mumbai, and the project offers an estimated GDV of around 1,250 crores. And lastly, keep an eye out on Digitide Solutions. Keep in mind that this is the first result that the company has posted post the demerger from Kescorp. The revenues was rather flat at 732 crores. The EBITDA margin, though, contracted by around 390 basis points. The EBITDA fell by almost 26% sequentially, and the company reported a net loss of around 1 crores. The bookings, on the other hand, in Q4 crossed 568 crores, and the management says that they're entering FY26 with optimism, a strong pipeline, and a clear focus on profitability.
Okay, all right, got that. And we've got Sonal joining in with some news on Gail. I think it's a what's the update here?
Well, there is an interesting note from Jefferies, and they talk about how there is a possibility of increase in unified tariffs coming in the next PNGRB meet. It's expected to come in soon, and this is where Gail had earlier asked for a 33% tariff hike. While that is the case, it would go up to 78 rupees per MMBTU. While Jefferies thinks that they are hopeful for a 10% increase in unified tariff, Gail is expecting a 20% increase versus the 33% that they asked. That is because their volume transmission has come down. Jefferies says a 10% tariff will lead to 13% increase in EBITDA and 26% increase in EBITDA if there is a 20% tariff hike. This is the key to watch for Gail, because if there is no tariff hike, that would be a key risk to the stock. So they expect a 34% upside from potential tariff hike in the target price. They have a buy rating on the stock currently.
All right. Thanks a lot for that, Sonal. And so good to have you back. Welcome back. Looking forward to having you more on air. Take care of the little one. But we missed your research, so welcome back, girl. Okay. All right. Well, let's...
Thank you so much. It was...
Got it. We'll catch up later today, Sonal. All right.
Yeah, that backdrop looks eerily familiar. I wonder where that is.
Got it. All right.
We all have been there, Mangalam.
All right. Let's move on. Let's get in Manisha Gupta, who joins in for a quick roundup of all the commodity and market action overnight. Morning, Manisha.
Morning, Nigel. Thank you for that. I'll start with the crude oil prices, where we're looking at a second straight day of some steady moves coming in, a percentage point of gain in the overnight market. The whole focus now, of course, shifts on the Iran and U.S. meetings in the next week. We understand that the officials from both countries are meeting. And the focus also is on the July 6th OPEC Plus meeting, where Russia may support a production hike if needed. So that's a couple of things to watch out for. But the overnight market and the week, and by the way, the month of June, absolutely is about metals. Overnight as well, we've seen silver gain up by a percentage point, but it has been platinum, which is up by 5%. So when you look at the month of June, well, we've seen silver gain up by 11%, copper is up by 9%, platinum, palladium giving you returns like 20 and 30% for the month of June. And with the kind of fundamentals that we are working with, well, it continues to be a buy call for many of these.
All right, that's the word coming in on all things commodities. Copper prices at 3-month high. Nigel's been speaking about how the metals index will be in focus over the next couple of months. We'll watch out for how that pans out. With that, we'll take a short break, come back. How do your portfolio stocks benefit from the current developments in the world? We will connect with Siddharth Khemka of Motilal Oswal Financial Services for Fundamental Stock Talk. Stay with us.
Welcome back. You're tuned in to Bazaar Morning Call here on CNBC-TV18. Well, as promised, let's get in Sid Khemka, Head of Research Wealth Management at Motilal Oswal, on the show. Hi, Sid. Good morning. Good to see you in, as always. Sid, I wanted to ask you about a couple of names, but let's focus on tech pack first. Overnight, the Nasdaq has done well. The Nifty seems to be getting its mojo back. The globe seems to be in a better space, but the tech index is 15% away from its all-time high. What's your view on the tech space, first of all? We'll be getting numbers in the next 2 weeks. And what's your top pick from the tech pack?
Yeah, good morning, Nigel. Thanks to be on the show and wishing everyone a happy Rath Yatra. So good day to be on the television. So if you look at overall globally, things are seeing some improvement while the US Fed rate cut has been paused. There is still talks of the tax cut that is still pending from the Trump's election promise. I think that could be a big positive for the overall tech spending. The management commentaries across have been mixed. If you see, Accenture has upgraded the lower end of the growth guidance, but new order wins are not coming forth. So clearly, near term, there could be still weakness as uncertainty persists. But what we see is that some of the Indian tech companies, they have a strong order book, execution is picking up, and given their niche presence, they are definitely seeing tailwinds towards their own efforts. So for example, one of our top picks, Tech Mahindra, has seen a management change, and we are seeing the transition under the new leadership playing out well. We believe that that could be a good, strong play. HCL Tech is the another preferred pick within the tier one case. Given it's a diversified book, we believe that's a defensive bet within the IT space, clearly with a strong diversification across digital infrastructure management and other businesses. Again, if you look at tier two is the space where the growth is much better and faster, and within that niche sectors such as again digital Gen AI investments are leading to stronger growth. So Persistent and Coforge, these are our two preferred picks within the tier two IT space. We see strong earnings growth over the next few years. In both of the stocks, at least 20-25% earnings growth, and we still see headroom for potential upside in terms of valuation. So Coforge is our top pick with a target price of 2,200, giving nearly 20% upside.
All right, so that's about Coforge. Siddhartha, I wanted your thoughts on Nykaa because they held their analyst day yesterday. They are speaking about growth in their beauty and personal care business, speaking about the fashion business breaking even in FY26, mid-single digit sort of margins by FY28, and their own brands, Nykaa house of brands, likely to compound at about 30%. The stock has been an outperformer over the last 3 months or so. It's rallied about 25-30%. How much more is in store according to you? Do you think it's good for more?
Hi, Mangalam. So, unfortunately, we don't cover Nykaa, but what we hear from the management meet, I think definitely the focus on in-house brands and the growth numbers that they are putting up, that should be helpful. As a space, we like this space, the e-commerce space, and given the niche presence in the personal care, we believe growth should be good. But overall, we don't have a view on Nykaa.
All right. Do you have a view on Eternal and Swiggy? Because Nykaa has announced its foray into beauty quick commerce. They've launched Nykaa Now as well. They will be fulfilling orders for beauty products between 30 to 120 minutes. They've launched that in top 10 cities or top 7 cities, if I remember correctly. You track the e-commerce space. You like the e-commerce space on Eternal and Swiggy. What are your thoughts?
I think many players are jumping into the quick delivery business, and that's only to show that the model is effective and is a good solution for the Indian market. So we definitely remain very positive on the quick commerce. We believe it's a once in a generational growth opportunity or disruption opportunity in the way consumption happens in India and the way the delivery is happening. So near term, because of the increased competition of Zepto, the cashbacks they are giving, there is definitely some pushback in terms of numbers. Both Zomato, Swiggy have raised capital, and they have front-loaded the capex. So again, we believe that Zomato is our preferred pick there. We believe that the food commerce, food delivery business, that is a stable market leadership for Eternal. They're making cash flows there. Quick commerce, we believe that by Q2, Q3 should see improved numbers. And overall, we remain very positive on Eternal. We have a buy rating there. And we believe there could be decent upside from current levels as well.
Sid, what about the real estate pack? What do you like from there? You have the new IPO, that is Kalpataru, that hit the market. A lot of smaller players as well have been rallying in the last few days. Some excitement in the real estate space. What is your preference? We had yesterday Baman Rustamji Irani who joined us, and he, as always, is sounding rock solid. Things are good. They'll achieve the numbers. What is your reading, and what do you like more importantly?
Definitely, I think after a pause, now real estate sector should again see improvement in the demand on back of the improved liquidity, whatever efforts that RBI has taken in last couple of months, the sharp cut in interest rates, the CRR cut. I think that is only going to improve the overall liquidity in the system and lead to, and the lower interest rate should lead to demand, especially for the mid-tier real estate or mid-tier housing segments. Previously, we saw a lot of growth coming forth in the luxury and the upper end of the housing segment. But with the interest rates now coming down, we believe the mid-market housing segment that should really pick up. And players like Godrej Properties, which are present across India, that is something that is within our top preferred pick, given its national presence, large presence in the high growth markets like Mumbai, NCR, as well as the NCR region. Apart from that, DLF is another stock that we like. It is among our preferred picks, consistently delivering growth, and we have a positive view there as well.
All right, we request you to stay on. You've spoken about real estate. Infrastructure is not too far away from that. You listen to this conversation and we'll get your views on the infra space as well. Capacité Infra is the first management on our show right now. They received an order worth over 600 crore rupees from the Saifi Burhani Upliftment Trust in Mumbai's Bhindi Bazaar area. We have the contract which includes both core and shell works, as well as mechanical and electrical, plumbing and firefighting services. We are now joined by Subir Malhotra, who's the promoter and ED at Capacité Infraprojects. Thanks a lot, Subir, for joining in. Congratulations on this order win. The street needs to know a couple of things. One, by when do you execute this order? What are the kind of margins that you need, that you will be enjoying on an order like this? And thirdly, basis this order, what's the kind of target that you have for FY26? Not just this order, but all the others that you have as well. Because FY25, you missed your revenue growth guidance.
Good morning and thanks to be back again. Yes, so, okay, I'll answer the last one first. We finished last year with 2,400. I think that was quite in line with what we were expecting. We did almost a 23-24% growth last year. Coming back to this matter of the Saifi Burhani Upliftment Trust, we are extremely thankful to the SBUT Trust for giving us the third order that we have from them. And you can very well imagine executing an order in a crowded, high-density area like Bhindi Bazaar requires some extreme skills of execution, which I'm sure we have displayed in the last two projects that they have reposed trust in us for the third one. The timeline of this project is the standard 30-month project, and we intend to finish it well in time. We are already executing or in midway through their second project as we speak. The numbers as we speak, as the end of the day, quarter one, as far as an order book is concerned, has been very interesting. We've clocked orders of more than 1,200 crores, out of which SBUT, Indus, Raymond's, and not to forget the high-speed rail data center has been part of the orders that we've picked up in the quarter one. We have a look ahead of around about 3,600 crores in this year as a quarter, as an order intake. I don't see why we should not drop that order.
All right. Hi, Mr. Malhotra. Good morning and good to see you, Ben. Give us a few basic numbers first. Revenue growth for the year, if I got that correctly, you said it'll be more than 20%. Could you just reconfirm that number? One. Two, what kind of margins are you looking at? And your working capital days, though it cooled off a little bit from higher levels, I think it's still around 200 days. So where do you see that number stabilizing at? Three big numbers.
So, I would stick with the projections that we have been giving in the past. 20% is very well in line. We did that last year. I don't see why we should not be doing it this year also. Our order book dictates that we should do at least that. Number two, the working day capital is a very non-linear kind of a line to monitor, because when you're executing big mega EPC projects, such working day cycles may keep on going up and down depending on the nature and the kind of job that you're executing in that particular part of the time frame that you're looking at. As far as the bottom line is concerned, we have always maintained that a 70% EBITDA at the end of the day is what we will look at on an annual basis. We have always maintained that. We have achieved that in the past. And I don't see any reason why we should not be doing that in the present.
What is that number, sir? I missed that. What is
13%.
13%. All right.
17%.
17% is what you can do. All right. Between FY25 and FY24, you were between 16 and 17%.
That's about where we are. Right?
Yes. What about, labor issues? I have to ask you this because a lot of the infra projects, infra companies that have come to us, they've said that order inflows, not big problem. Costs, we're somehow managing. We're holding on to our, margins. Labor is a challenge, and that affects our ability to execute. Are you facing that as well?
I think they have absolutely hit the nail on the head. Labor is an issue. Orders, thanks to how the environment is in the market today, I don't think order book picking is an issue. The only way that you get over that is that A, you get to technologies where your dependence on labor is less, like get the quality and system formworks that we have always banked upon. B, you get to some kind of labor retainership initiatives on which you can then see that at least the labor that you are picking on, banking on, holding on, and trying to increase is there. But as we speak, yes, that is a challenge that the industry faces.
And how insulated are you versus the others because of all the measures that you just spoke about?
Well, I would say that we are better insulated than them, but it affects all of us.
Got it. All right. Mr. Malhotra, if we could focus on a couple of projects. I want to focus on the MADA project and CIDCO project. On the MADA project, I think you were to deliver the first 2 towers this month. You could correct me on that number with regard to the number of towers as well as the timeline. And on CIDCO project, I think you were looking at delivering the first 2 locations somewhere in the first half of the year. So an update on both these 2 fronts.
Yes, so we are looking to deliver both the projects. The first tranche of the delivery should happen in the next month or 2.
Okay, all right. So it's working according to plan. Is that correct?
Absolutely. In both the cases, both the client as well as Capacité itself are strongly aligned to deliver the project within the next few months.
Okay, all right. And on the signature project, I believe you had started work on phase 1 and phase 2 was due as well. So how will this pan out?
So as per my last discussions with the client, phase 2 commences in September. And phase 1, I'm happy to report, we cast the raft yesterday.
Okay, all right. Just one more question from my end. How is the balance sheet looking with regard to the total debt? What is it currently in your books? And you could break it up for us. How much of it is short term?
I would like to say that our net debt to equity ratio over there is very well, say around about 0.1 or 0.15, fluctuating as we move. And the short-term debt is very well under control, especially with the new measures which the government has also taken out. I see interest rates coming down drastically, or at least hitting us positively on the balance sheet as we speak.
You could apprise us of what the absolute number is and what your repayment plan is also, because you have order inflow targets and execution targets.
That's not exactly available on a per debt basis with me at the moment, because there are various debts which are to be repaid in various time frames as we speak.
Okay, all right. Very quickly, sir, before we let you go, the stock was so much of interest a few years ago, and then it lost its way a bit. But going by what you're saying, it pretty much seems that you're quite confident. What would your message be to the investors? Because they have seen levels of more than 400, then the stock corrected, and now it's holding at around 330 rupees odd. So what would your message be to your shareholders?
I would say always remain confident.
Okay.
Are you confident at 330?
Undoubtedly. undoubtedly we are deeply vested with it.
Did you pick up some stake at lower levels?
No, that's not something I take an answer on it.
All right,
Okay, all right. Good speaking to you, sir. Thanks a lot for joining in. We'll hold you at all these numbers and looking forward to chatting up with you in the time to come as well, maybe the end
Nice
of
to
your
be
first
back.
quarter's numbers.
Thank you.
Well, time to slip into a short break. On the other side, our technical experts are waiting for you. Shrikant Chauhan and Mitesh Thakkar will join in with their take on the index and individual stock calls. Welcome back. Hope you're having a good Friday morning and even better Friday evening. For the time being, let's focus on the morning. We have Shrikant Chauhan and Mitesh Thakkar who join us on the show. Hi, gentlemen. Good morning. Good to see you all in. Well, yesterday we had a late flourish and the markets ended at the high. That's always a good sign when you end the series at the high. Now, all eyes are on the July series, which historically, we put some data out. Historically, it's been very, very good. Last 10 years, beautiful, both Nifty as well as Nifty Bank. So there's optimism we get to fresh all-time highs. Mitesh, you go first. You think that's coming?
Morning, Nigel. So, all-time highs, even if they come, I think, one, there will be a very important supply pivot. I think, people always respect historical highs. But before that, I think there are a few challenges. There's a gap around 25, 700 zones, which is my target for the current ongoing upward. So let's see if we can get past that. But for the time being, I've been trying to take profits as we get closer to 25, 700, 750.
All right, 25, 700, 750. Shri, I'll have to go to Shri because, since morning, Nigel has been using a lot of these, you call Nige, Viv, Vama, Sud, Sid. So, Shri, your call on the Nifty?
Good morning, Mangalam. Good morning, Nigel. For Nifty also, I think the overall analysis is the same as Mitesh indicated, that at 25,750, the market is having good amount of resistance. But at the same time, the way the market has broken the range of nearly 750 points, one thing is very clear that we are heading for 26,000. And in case if there is any correction, then certainly we should look for adding or taking position in this market close to important support levels. So 25,400, 25,350 is the area where we should look for taking long positions in this market. But as we are very close to the important resistance level, I think here again, we can expect some activity in mid and small cap companies instead of any large cap companies, because whenever there is a rally in the market, we see buying interest in large cap companies. And as the market stops at important resistance level or because of uncertainty, we start seeing activity in mid cap and small cap companies. So similar sort of trend we can expect today.
Okay, so buy all dips. That's the advice coming in. Gentlemen, good morning and happy Friday to both of you. Let's talk about individual stock trades as well. Mitesh, what would you go with?
Yeah. I have all buy calls today, just like last couple of days. Adani Enterprises is a buy with a stop at 25.60 for target of 26.45. Cement as a sector has done well, so Dalmia Bharat is a buy call. Keep a stop below levels of 21.60. Look for targets of around 22.50. Also a buy on Axis Bank if it crosses yesterday's high. I guess it might happen in the opening. So buy about 12.40. Keep a 15-point stop loss around 12.24 and 12.75 is the target area. And Bajaj Finserv is the final buy call. Buy here to stop at about 20.30. Look for targets of 2110.
All right, so there's Dalmia Bharat, Bajaj Finserv, as well as Axis Bank on his buy call. But Surabhi, I thought you would take the trend forward and perhaps call him Mits. But
I don't know if Mitesh would necessarily, like that. So that's why I refrain.
It's Friday. I don't think he would mind.
Okay, Mits. Okay, that's the popular house call. I'm sorry, Mitesh, but no, we'll go back to Srikanth.
Oh, but are you okay with that?
Totally fine.
Totally fair. Okay. Shri, your
National
individual
television,
stocks.
you're putting him on the spot. Srikanth, go on. Your stocks.
Yeah, Surabhi. We like a few metal companies because there also we are seeing good amount of buying interest. Based on the rally in the metal market, we can expect rally in Vedanta, which is around 455, 456 levels. There I'm expecting again the stock can move towards 470.75 where it has resistance. So at current levels, it's a decent buy with a stop loss at 447. The other stock which we like is Dixon Technology, which is around 14,300. It is forming some consolidation at the bottom of the fall. And from here again, the stock can move towards 15,500 or 16,000. So it's a buy at current levels with a great risk reward ratio. We can keep a stop loss at 14,000 for creating any long position.
Okay. All right. Quick question, Shri. Wanted to ask about, since you pointed out Vedanta and the metal index, we pull up a chart yesterday. That one got its act together towards the end. But if I plot a one-year chart, still it's unmoved. We were highlighting today that the 50 DMA has crossed the 200 DMA on that one. Do you think the index is good for more? Obviously, there are various variables. We don't know what Trump does next. You don't know what's going to happen with regard to global uncertainty. But one factor that's supporting it is that dollar index is soft. So your take.
Yeah, absolutely. The way the dollar is weakening from its highs, and if we consider the dollar index, the chart of dollar index, then based on that, I'm expecting dollar index may fall to the levels of 93 or 92 in coming few weeks. So it will take some time, but gradually I'm expecting dollar index to come back to the levels of 92, 93. And if that is going to happen, then this will help all these metal companies to do well, especially Hindustan Copper, Vedanta. I think these are the stocks which should be on our radar for next few weeks.
Wow, 92, dollar index, and this is over what time frame, Srikanth?
In next maybe max 2 to 3 weeks.
2 to 3 weeks from 97 to 92. That'll be very interesting to track. Srikanth, Mitesh, thank you so much for joining in. We'll come back with stocks at 10 as well. With that, we'll take a short break, come back with the pre-opening. Also with us will be Kapil Singh of Nomura, as reports suggest that the anti-lock braking systems will be mandatory for all two-wheelers. Which companies stand to benefit from that? Kapil will tell us. Welcome back. This is Open Exchange live from the CNBC-TV18 Motilal Oswal studio. We're counting down to market pre-open and market open as well. 16 minutes and a little more over 30 seconds remaining for the market to open. The GIFT Nifty indicating a 100-point jump at start itself. Sid Khemka still with us. So you heard what Capacité Infra had to say to us. Do you like that stock? And in general, the infra space, do you think it's ripe for an up move from here on?
Yeah, definitely. So again, we don't have coverage on Capacité Infra, but overall what we are seeing is that ordering momentum has been healthy, especially if you look at in the T&D space, renewables, as well as the defense segment. Even our economists suggest that the central government capital spending has surged to the highest ever monthly level of 2.4 lakh crore in March. Even for FY26, they have front-loaded the capex spending even for April, May. So spending in April stood at 1.6 lakh crore, which was up 61% on a YoY basis. Obviously, last year, April, pre-election, there was not much spending. So definitely, that's a big positive for the overall capex theme. As I said, some of the key segments that is witnessing strong growth is the T&D segment, renewables and defense. Players like L&T, Kalpataru, KEC are benefiting from the strong pipelines, plus the defense overall global theme that is also playing out. So our preferred picks within the overall capex theme, L&T, which is a top pick with a target price of 2,950, and then KEC International in the T&D space.
Okay, so some of the T&D players is what you're going with. Siddharth, hi, good morning, good to have you on. On financials, what are you doing? I mean, yesterday, the whole market was lit up. Obviously, when you got 12,000 crores of FPI buying coming in, so everything was up. But give us the one or two top names. There could be banks, non-banks, lenders, even non-lenders for that matter. Maybe some ideas here.
Yeah, definitely. Good morning, Surbhi. So I think, yes, that is a big theme that is playing out this year. It's a purely domestic theme, so it's not affected by the global volatility and the geopolitical concerns. Plus, RBI is taking a lot of efforts to improve liquidity, bring down the cost of capital. That is supporting the entire theme. So overall, what we expect, credit growth to improve, NIMs to stabilize, and then again, especially for the NBFCs, NIMs will see some improvement, and followed by banks where the entire effect of the CRR cut as well as the liquidity will start taking place. So definitely banks are something that we like. ICICI, SBI, HDFC Bank are our preferred picks. Within the lending, NBFCs, what we like, Bajaj Finance, we believe consumption credit will go up, and being the market leader, that would continue to do well. Shriram Finance and Chola, these are some of the other stocks that we like. Within the non-lending NBFCs, capital market as a big theme, we are seeing market volumes going up. Again, a lot of IPOs have started coming in, so you will have traction in the CDSLs of the world, the AMCs have started seeing a lot of interest back, and finally you have the AB Capitals of the world, where so L&T Finance, AB Capital are some of the other themes, and CDSL are some of the other themes within the overall financials that we like.
Okay, all right, got that, Siddharth. Thank you so much for the ideas this morning. You have a good trading session, and we'll connect again soon. We are just about getting up to 9 a.m. First of the pre-open rates are coming in. They're sort of suggesting that there could be a cool-off given the big run-up yesterday. But let's see. I mean, all the experts have been telling us this is a buy the dip market. So will this dip get bought? I mean, let's see if it indeed is a dip when the actual opening happens. As those rates settle, let's put the spotlight now on the two-wheeler space. Autos is what we're looking at. And this is because reports are suggesting that anti-lock braking systems could be mandatory for all domestic two-wheelers from 2026. We have to remember that the ABS systems help prevent wheel locking up during sudden braking. Nomura believes that prices can see an increase of 3 to 5% if the companies decide to pass it on. To talk about this, what the ramifications are, we have Kapil Singh, auto equity research analyst at Nomura. Kapil, thanks so much for joining in. Good morning to you and happy Friday. So, I believe that ABS was anyway mandatory for bikes above 125cc. but the bulk of the Indian market is below 125cc. So, what's the thought process? Because the rollout time is also very short. I mean, we're talking 1st July 2026, 6 months. First of all, do you think it's feasible? Is it possible? And I'm guessing it has to be, of course, prospectively, not retrospective. So, what are the implications for companies?
Thanks, Abhi. Good morning, everyone. So, as far as ABS is concerned, yes, you're right that it was present only in vehicles more than 125cc. But less than 125cc and below forms almost 85% of the market. And the price points there are lower, and therefore the customers are also much more price sensitive. So that was one of the reasons, that is one of the areas of concern. Having said that, they do have an advantage for the customer where, as we said, wheel doesn't lock. So from a safety perspective, it's important. We do think that the timeline is steep, but again, these are news reports. There is no confirmed notification that has come from the government. So we will wait for that. Maybe there is some discussion with the manufacturers and the suppliers on getting the capacity in place, because I'm sure, this kind of capacity will take some time to put in place. So maybe, there can be some relaxation that is possible if the regulation were to go through. But that will depend on the discussion that happens between the manufacturer and the government.
Yeah, I mean, it's not a new technology. So yeah, you're right, because it's been there. It's applied to higher cc bikes. So it's not a new technology. It's a question of having enough capacity to roll it out on all bikes. Now let's talk about this price increase. According to, I think these are, I believe, your estimates, a 3 to 5% price increase. Tell us more about this. And again, will it be palatable?
Yeah, so our estimate is currently, it will require, even if there is a single channel ABS, it will require one disc, and the ABS, the cost without the taxes could be about 3,000 rupees for the vehicle. There can be some variations depending on the category of vehicles, but this much impact is going to be there. We have noticed that the customers right at the lower end are more price sensitive. So in some cases, historically, when manufacturers have introduced variants like disc brake, the adoption rates have not been high. So one of the things we conclude from there is that customers are very price sensitive also. So it does increase that concern that there could be a demand impact. Sometimes in the past also we have seen that when regulatory costs increased because of insurance or ABS, CBS, there was some impact on demand. So that is possible. We think there could be a 2 to 4% kind of demand impact possible for the industry.
We'll ask you to hold on, Kapil, because there's important breaking news at the bottom of your screen. This is something that we got an inkling into yesterday afternoon as the markets were, just about to close. It was the possibility that JSW Paints will go ahead and acquire the entire stake of Akzo Nobel India. The promoters were looking to sell, the foreign promoters, and that exactly seems to have happened. So JSW Steel will go ahead and acquire 50.46% and 24.3% respectively from the promoters Akzo Nobel at a price of 2,762 rupees. Remember, Akzo Nobel's last traded price was close to 3,215. So this price is at a discount to that. 2,762 rupees is what JSW goes ahead and acquires Akzo Nobel's business for. And over and above that, there will also be an open offer. So this is what we have now. The deal which was in the works for a very long time. A lot of players were reported to have bid for Akzo Nobel. Goes ahead and JSW Paints goes ahead and buys it. In the past, Parth Jindal has said that they have ambitions for the paint industry or the paint sector to grow. At the same time, they also have ambitions for the paint business to be listed on the bourses itself. Akzo Nobel, of course, is the 4th largest paint player in the country right now, has an important premium brand, Dulux, where they have a higher market share than what they have in the mass products. And this is a positive. From a listed player standpoint,
the pricing, which is really interesting. At the peak, I was looking, Akzo Nobel had rallied to over 4,000.
Yes.
It anyway cooled off from there, and the deal has been done at a price even lower than
which is what
now.
the question is all about, the industry itself right now. what is positive for JSW Paints is that they didn't have to pay top dollar, but all the other paint players who had the opportunity to go ahead and buy this passed this over, which means that valuations at these levels did not make sense to the current paint players itself. So what's good is that this has been a deal which is done at reasonable valuations for JSW Paints. What is also good for the existing paint players is that they didn't go ahead and buy it, which means that their balance sheets are fairly good. But now you have a large conglomerate other than the Birlas, which has now a bigger seat at the table. Because JSW Paints, yes, they've been in the paints business for the last 6 to 7 years. The last reported number that we know of, what Parth Jindal had told us, was close to 2,000 crores in revenues that they had. But mind you, 60% of those revenues came in from JSW Group itself. So decorated paints accounted for about 800 to 900 crore in revenue. So 5 years of being in the industry, they did not cross 1,000 crore in organic decorative paint revenue. Now they've gone ahead and acquired the 4th largest player. So they've gotten a bigger seat at the table. How aggressive will they be at a time when everyone else is looking to, protect their turf, grow the industry, grow their market share, and at the same time do it profitably is something that we'll most definitely watch out for. So for starters, good for other players that they didn't acquire it because their balance sheets are ready for a fight. But for JSW Paints, they got it at a reasonable valuation. They got a higher seat at the table. Interesting times, colorful times.
Just going by the numbers that you're giving us, Mangalam, 2,000 crores is what JSW Paints had done, right? And
yes.
Only 800 crores was X of the group companies.
Yes.
And now they'll acquire a company that has around 4,000 crores or thereabouts.
Yes.
So from 2,000 crores of revenues, they go to around 6,000 crores approximately. And more importantly, the chunk X of the group will go to around 4,800 crores, just rough numbers.
Yes. And the important part here is that Parth Jindal has been talking about the IPO of the paints business. But now could there be a case where Akzo Nobel is acquired by the JSW Paints business? They rename the company to JSW Paints and they reverse merge the unlisted paints business into this. So that prevents them from the entire process of the IPO itself. So by virtue of buying a listed entity, they become a listed company themselves.
And I don't think the paint sector has been more interesting in the last many, many years, because I just want to remind our viewers again on the table, the big fight. So there's Asian Paints, there is the Birla Group, and now there's JSW. And remember, the Birlas had moved the Competition Commission of India against Asian Paints, saying that they're abusing their market dominance. So I think there's a big story playing out here, and JSW is making its seriousness, its intent very, very clear.
There is a big story playing out here, but it will be very interesting to see how much bigger a dent will JSW Paints make as well. Because again, I'm reiterating, the last 5 or 6 years, including Akzo Nobel, if they do about 6, 7, 8,000 crores as well, that's less than 10% of the paint industry right now, which is anywhere between 60 to 80,000 crores, depending on what you're looking at right now. But more importantly, the aggression of the Birlas, will the JSW Group be able to match that? Because in the first year of operations itself, Birlas claim to have gained almost 6 to 7% of the market share of the paint industry. Here, by acquiring another company as well, you are just at low double digit or double digit at best in terms of market share. So with the Birlas having a target of, 10,000 crore in paint business by year 3 of operations and EBITDA profitability, they are walking that path, and they are walking that path very aggressively.
So remind us of the revenue again, just so we have the pecking order right.
So we have the pecking order right. Asian Paints would be close to around 35-40,000 crores.
Almost 40,000.
They are above everyone.
Yeah,
else.
Absolutely.
Birlas are targeting 10,000 crore in revenue by year 3 of operations,
which will make them the second biggest.
Which will make them the second biggest or third biggest in terms of revenue. Then you have Berger, which is around 12 to 15,000 odd crores. These are numbers that I'm remembering off memory.
Top of your head.
So might not be
unfair
accurate.
to Mangalam, but
the only thing that I'll be looking at from here on is whether they grow profitably or not, and what happens to the overall market share of JSW Paints in the industry, because 6 to 7,000 crores would keep them at 10% market share. Can they grow beyond that or not is the big question.
All right, Mangalam, I'll give you further time to just look into those details, and all the numbers were bang on target with regard to Asian Paints, Berger Paints, as well as the deal that just announced. But we have Amnish Agarwal, Director Institutional Research, PL Capital, who joins us on the phone line. Hi, Amnish. Thanks a lot for joining in. What are you making of this deal? The deal has been announced. It was speculated that JSW Paints is in the forefront. They've gone ahead and they've bagged Akzo Nobel. What do you think with regard to the pricing that it's been done at, and how does it change the dynamics of the industry?
You see, the pricing actually it's a 15-16% discount to CMP, and this is even when your Akzo Nobel was not trading at a premium to other players. So the pricing to that extent doesn't seem to be that high. That is one. The second, in terms of the industry dynamics, I think it's going to be the most fiercely competitive scenario than we have ever seen in the paints industry, because already we are witnessing a lot of competition coming from Birla Opus, and now Akzo Nobel, which was I would say an MNC, but they actually never tried too hard to gain market share or do anything which is very extraordinary. Now with they falling into the hands of JSW Group, which is very aggressive, and on their own they have been making quite a lot of efforts. I think now it will become much more competitive in the entire paint industry. And in terms of margins, in terms of growth and all, I think the market shares will continue to be redrawn for the next 2 to 3 years.
Amnish, market shares aside, I have to ask you about for Akzo Nobel shareholders. You said that the stock wasn't trading at a premium to peers anyway. With JSW acquiring it, do you think a case for a re-rating comes by, or do you think the street will await the moves from JSW Paints before making any investment decision on Akzo Nobel?
You see, I think we will have to wait and watch what is the exact structure and how JSW handles it. Okay, but definitely it's a long-term positive, but in the near term, there is nothing much for the shareholders from the tea.
So very quickly, Amnish, for paint stocks, more downside in general?
You see, the sector has already seen a lot of correction for most of these stocks in the past couple of years, and I think they will remain weak to sidelines for quite some time. The incremental weakness will depend upon how much
on the pricing intensity, the competition,
share, margins, yes, how the competitive intensity plays out in the market.
Absolutely, take that point. Thank you very much for that quick overview. Let's actually start with the paint stocks. Let's look at what color they're choosing. Asian Paints is flat. Let's pull up Akzo itself. Akzo's at 32.10, and remember, it's turning negative now. The deal itself has been done at sub 3,000. So let's see how it plays out. Let's pull up Berger, Kansai Nerolac. Let's get all of the paint stocks up on the screen. Akzo is not falling too much. Berger is also flat. Most paint stocks actually flat. Perhaps, like Mangalam's been saying, the market had an inkling of this coming all along, so it's not coming as a big surprise. Now Akzo is seeing a little bit of red as the market digests the news. Yeah, a little over 1% down on Akzo Nobel. So that's what we have.
So now my sense is that the Akzo Nobel stock would be, in the red all the way until, the deal price is there, and that acts like a floor price for the stock from here on. Yeah. All those who were bidding the stock higher, hoping for a deal and an open offer to come by at prices earlier at which Akzo Nobel was trading, or at a premium to what it was trading, have their hopes have been quashed. Absolutely. It is at around 2,700 rupees per share. So those people might be unwinding their positions, but they won't until the 2,700 mark is holding on. That will become a base price. And from yesterday's high as well, the stock has seen a bit of a knock. Ever since, the story came by that JSW Paints will go ahead and acquire the company. I remember Ashwin saying on the air as well that they valued the promoter's stake at 9,000 crores as against the 10,000 crores that it was yesterday. So from those levels, the stock has seen a bit of a knock. Still holding.
I know. I actually am a little surprised that the market isn't pricing it, because now you have a price. The asset has been priced at 2,762 rupees, but the market price is still holding higher, which is interesting. We'll keep analyzing the story as we go forward. Let's look at the rest of it then. 50 points higher on the Nifty, so the bulls continue to show up their good form. Let's see what's taking the market higher this morning. There's L&T, 1.5% up. There's Tata Steel. There's State Bank of India. There's Hindalco, NTPC. It's a complete mix of stocks and sectors really out there. Tata Motors is having a decent day. There's Apollo Hospital, Axis Bank. So it's a good mix. Reliance is still contributing. Infosys is contributing on the upside. State Bank of India and L&T. So these are some of the heavy hitters this morning. What is not contributing is HDFC Bank. Pretty, decisive in its down move today, over 1% lower. And then there is Cipla and SBI Life. These are some of the other stocks which are quiet as we speak. So Bank Nifty is playing a little bit of a spoil sport, keeping a check on the Nifty overall. Nigel.
Well, that's right. In terms of stocks on the broader markets, Dixon, that one is getting its mojo back. It's up close to around 4%. Equerris had come out with the note. They have an ad rating on the stock. They remain positive on the stock. They believe there are multiple near-term positive catalysts. And they also say some of those concerns are premature in nature. So that could explain one of the reasons the stock is up close to around 3%. So good up move on that particular name. What else? Metals are doing well as a pack. We had highlighted this earlier this morning as well, that technically, you have the 50 DMA that's moved above the 200 DMA. And the world seems to be in a better place if these tariff tantrums are gradually easing out. At least that is the hope. For the time being, the metal index, which hasn't done anything in the last 1 year, well, that's up close to around 1% or thereabouts. So China remains the problem. We don't know what's going on that front. So that's the other pocket that I'm looking at. A few more names that are moving around. Prime Focus, we don't talk about this name very often. Stock is up more than 10%. So solid up move is what we're seeing on that particular name. Western Carriers, another one that won an order, I think yesterday. I think today as well, there was some small order win out there. That stock as well is opening up higher. And Mobiwick, yesterday it saw a big recovery from the day's low. Today as well, it's building on to those gains. From the broader markets, Brain-based Solutions has come in for some profit taking. Last few trading sessions, it's been moving like a rocket. Today, it's cooling off a little bit. And just one word on stocks like HDFC Bank. Yesterday, they ended with a flourish. Sometimes you see some of these stocks that do that in the last hour of trade at the last day of a particular series. The next day, just for that day, they realign themselves just to adjust for what they did in the previous trading session. So HDFC Bank, I think the trend is up, but I think it, just readjusting itself. Just one word, guys, with regard to this paint deal. I'll keep an eye out on JSW Cement's IPO. Money is going to be required. The group, I think, could look at fast-tracking those plans. Just a comment that I think. So.
All right, we will keep an eye out on that itself. Meanwhile, the Nifty Bank, despite the HDFC stock being lower, is contained by its losses, just about 50-60 points. That's because SBI is doing well. Axis Bank is doing well. SBI, of course, aims to raise about 25,000 crore rupees via a QIP. Torrent Pharma is one of the stocks which is up around 3.5% as well. There's a note that is coming from JP Morgan this morning on the stock. They've upgraded the stock. The target price is close to around 3,800 rupees. So that's one of the bigger gainers in the broader markets. Siemens is one which is coming in for some buying as well, up close to around 3%. We continue to see some traction being built on Vodafone Idea. Ever since the comments that have come in from Jyotiraditya Scindia, the stock is up around 12% this week. This morning starts with gains of about 2%. And rail stocks do fairly well this morning as well. So Titagar is up higher in today's trading session. Translate Lighting is the other one. Another stock not regularly spoken of, but a big mover this week is Bajaj Consumer. They announced the appointment of a new MD this Monday, and the stock was locked in upper circuit, a 20% upper circuit on that day itself. Continued to hold on to its momentum, currently higher by about 4% on Bajaj Consumer. It is it's almost 30% higher this week itself for that stock. So good time to bring in Krishna Sanghvi, who's the CIO equities at Mahindra Manulife Investment Management. Thanks a lot for joining in. The market looks good. Last week has been good. The global, picture seems to be a little more clearer than what it was, say, about 10 days ago, Krishna. But the big news that came this morning was on the paint sector. So let's start with asking you your views on consumption and the paint sector in particular. It's been a long summer for all these paint companies ever since Birla's announced their foray. There has been a multiple de-rating for a lot of the incumbents as well. And now this morning, there is another deal that has come in. JSW has gone ahead and bought Akzo Nobel. In light of this disruption, what are your views on consumption and paint stocks in particular?
Yeah, no, actually, maybe this disruption, as you mentioned, is perhaps, one good indicator that, Indian consumption story is pretty much intact. Yes, there are new players entering, and, for any segment, when there are new players entering, there can be some sort of a, market share, grab kind of competitive activities which plays out and which is pretty normal. But the big picture is, yes, there are quite a few sectors or subsectors of consumption where new players are looking to enter. And so look at consumption in slightly bigger details. Yeah, what all we need perhaps for consumption is, let's say, more money with consumers. That's partly played out through, tax reliefs in the budget. People are going to have more money as the year progresses, the amount actually goes up. On the other side, we also have a situation where in next 6 months or so, the pay commission announcement is likely. Consumption had a slightly weaker patch, even from a numbers perspective. YOY, the base has been weak. So I think broad picture on consumption, core India, demography, India earning, stroke, tax relief, more money with consumers. I think that's going to play out. So consumption as a broad space, we expect things to improve from now on.
The stock of the morning definitely is Akzo Nobel. What a big recovery that we've seen from the lows, despite the offer being a lot lower than the current market price. Maybe the street believes that the new ownership.
That's the only logic that I can find, Mangalam.
That exactly is the only ownership.
It's a deep-pocketed, serious player that means business, that can put more money to work, that can perhaps withstand even a pricing war if one were to come through. And I mean, from Akzo Nobel, who wanted to sell an MNC company, not looking at too much of interest maybe in India, at least in this part of the business. Now you have a serious corporate entity backing it.
I'm not too sure whether it is about the deep pockets of the conglomerate that is backing it, etc. It's more of a relief that okay, the deal is done now, because up until the deal would happen, people would be skeptical of bidding into Akzo Nobel, knowing that at some point someone will go ahead and buy it. So irrespective of who's bought it, and I'm sure there's strong people, whoever buys it is a 9,000, 10,000 crore asset, will not be shallow pocketed, but the ones who buy it, the fact that the deal is over makes people now a little more relieved that okay, this is what the future of Akzo Nobel looks like. The stock has been under pressure. Maybe there is a bet that needs to be taken.
Let's ask Krishna. Krishna, we're not asking you to comment on any individual stock, but we're just trying to find rationale. Typically, when deals are announced in the market pays a lot of attention to the price at which the deal has been done. Here, that price is 16% lower than where the market was after a big correction in paint stocks. And now the market's taking a very favorable view. How would you read into this? What are your thoughts on the paint space?
So I think let's not read too much into the immediate price reaction, just on the deal being announced, because this doesn't really add value, because even the buyer perspective, obviously they've not bought for a single day kind of thing. It's basically a new business opportunity for them. Paint as a sector, as you mentioned earlier, I think consumption play is pretty much the core story. We have a nice combination of whatever I say, house durable, the house paints going on, maybe infrastructure is improving. So paint is structurally a good story. Competitive intensity can decide a little bit shift of market shares or margins, profitability, etc. But that does get captured in market valuations.
Hi Krishna, good morning and good to see you. One problem has been the kind of supply of paper. Day-to-day basis, $500 million, $1 billion worth of sale that's coming in. Actually, for one, I'm happy that we're going to be seeing, the earnings season that will take shape in the next week or so, because a lot of these companies will go into silent period. If that's the case, and if liquidity continues the way it is, do you think there's a chance that you'll have the broader markets actually that will outperform?
Yeah, fair thing, in the sense that let's look at the supply of papers is continuously on the rise. If the numbers are broadly right, I think in last 6 weeks or so, we would have got roughly 1 lakh crore worth of supply, either primary or promoter sale combination. It is a large supply. Luckily, markets are able to absorb, and despite that supply, markets are again making newer highs. So that's possibly telling us the markets are clearly in a bull trend. Maybe global markets are equally supportive. It's not only India. Let's not forget, it's not only India. Almost all major global markets are making newer highs for current calendar year, and India is no exception. So to that extent, yeah, markets are in bull phase. Some of the supply is being absorbed. Two combination, you have a nice free float increase in the market, which somewhere will help rationalize valuation. So in a way, yeah, supply one needs to be slightly worried, because at some stage this supply takes money away from existing stocks. So demand supply dynamics will matter, but yeah, for now the broad bull market phase is on. Yes.
Okay, got that. So Krishna, then tell us about your preferred sectors, and definitely mention in a word on defense, because of the last, I think, 6-7 months, this is the one pocket we spent so much time talking about. Stocks have done well. For now, at least, the war issue seems to have receded in the background. What are your thoughts?
Yeah. So I think from a sectoral choice, BFSI, comes in as one of the name. We got a nice combination of, regulatory support. Reasonable rate cuts have happened. Money supply is increasing. So liquidity is back in system. So if we add those two, which is the core requirement for a BFSI as a space to do well, So that's one particular space. I think consumption, I did mention earlier, is equally a sweet spot going ahead because of multiple factors which I mentioned. Defense, yeah, it's actually India's core story which has emerged post COVID, when government decided to go for some sort of that self dependency, Atmanirbhar, for India's defense needs. And quite a few Indian companies, have shown their ability, or on the way to show their ability to get into export market for defense. So structurally, yes, defense also can be good. Valuations, one can always, wait on some stocks for a better opportunity.
Right. And what about, the banks? A lot of people are finding value in financials right now because every other pocket seems to have run its course or fraught with uncertainty where valuations are compelling. They believe that if there is any growth that is likely from here on, banks stand to benefit the most. What are your thoughts there? Do you prefer private banks, public banks, or you look at NBFCs as an option?
Yeah, so the bigger piece is, let's say, lending. So if credit growth is back in system, I'm sure, banks and NBFCs both have a participation in growth. From a cost of fund angle, maybe, benefits to NBFC may be slightly ahead of benefits to, banks because the way the liability side is structured. But, from a very good angle we got is, when this rates hike cycle happened in 22-23, we got a nice roadmap of how assets gets repriced for a bank and how liability repricing follows with some lag on of 3, 6, 9 months based on the liability profile of the bank. So my guess is NBFCs can be a near-term beneficiary of a lower rates on their borrowing side, while banks should follow with a 6 to 9 month lag at max. So if I look at FY27, maybe which is possibly a full relevant year for this purpose, I think both banks and NBFCs as a lending combination will have a nice sweet spot of liabilities repricing already having happened and the credit growth being back in system. So good earning growth for FY27.
All right, Krishna, final question before we let you go. The fear is, towards the end of this year, again, we get into election mode. Bihar will kick it off with, I think, the state elections. How are you positioning with regard to, what are your expectations, both on the fiscal and the monetary front? RBI has given a good booster shot for growth, and they've shown that they are pro-growth. On the fiscal, it seems that, maybe there's limited headroom now, and particularly with these state elections coming about, again, it, keeps sentiment subdued. Your expectations on both these two fronts?
Yeah, so at macro level, from a fiscal policy perspective, the central government has reached a stage where we actually on a fiscal consolidation, nice way to reduce fiscal deficit by, 20, 30, 40 bips based on the yearly, situation. So that roadmap is intact, which is healthy fiscal consolidation, and that should support the broad macro for the country. So that's a good part. I think clearly RBI policy on monetary, accommodative stance, which they took, and very nicely, the quick quantum of rate cuts in terms of 100 bips in just 4 months, as well as nice liquidity expansion. It should play out for economy going ahead. Elections, do have on the card in India, but we've seen in elections almost every 6-9 months happening in India because 29 states, almost everybody goes through a 5-year cycle. So election part, honestly, markets, have taken into their stride over time.
Okay. All right, Krishna, we'll leave it on that note for this morning. Thank you very much for joining in with your perspective on the market. And the market's been actually holding up okay, but there is a little bit of profit taking coming in, and you'd expect that because it's been a good week. We've been already rallying almost 2%, barely 3% off the all-time high. So there's some, hint of caution, some profit taking. Maybe that's not too bad at all. Where is the money coming off? Bajaj Finance, there's Bajaj Finserv, there's SBI Life. Financials, remember, rallied very hard yesterday. So there's a bit of a cool-off. On HDFC Bank, just to add to the point that Nigel made earlier, someone just pointed out this to me a while back. It's also gone ex-dividend today, and the dividend was 22 rupees. So there's that factor playing out as well on HDFC Bank. So that's pretty much where we are with respect to the market. SBI actually is, however, keeping the other end fairly all right. SBI is up 1.5%. It is the Nifty winner at this point in time. So that's how it's playing up. Midcap index still in positive territory. Well, the sector that we're now putting the spotlight on is the power space because there are, fairly interesting developments. Torrent Power has received an important go-ahead from the Maharashtra Electricity Regulatory Commission to offer parallel distribution services in Pune, in Nagpur, and in the Mumbai MMR region as well. Do note that this decision marks the first step for the company to operate as an alternative electricity distributor alongside existing discoms. And that's not all. Now we know that Tata Power has, bigger plans for the rest of the state, for all of Maharashtra, and they're looking at getting into parallel power distribution as well. So what does this mean for power generators, distributors, or entire transmission set up in terms of fresh capex? What is the opportunity? Let's discuss this. We have Chanchal Rajora, Group CFO and advisor to the board at Transformers and Rectifiers. And we also have with us Nikhil Nigania, Director and Senior Analyst at Bernstein. Gentlemen, thanks very much for joining in. So this is interesting news. It's a good development. Obviously, it's great for consumers. Choice is always a good thing. Nikhil, let me get your opening thoughts in on this whole setup of being a parallel operator. Let's talk about, say, Mumbai, where Torrent Power wants to get in, where the Adanis are already present, Tata Power is already present. Is the market big enough to make an inroad? And then likewise for the rest of Maharashtra, where Tata Power wants to expand. Your thoughts?
Sure. So in terms of the regions, these three players are looking to target. It's not really the part of Mumbai addressed by Tata Power and Adani at present. It's more areas where they compete with the state distribution company, MECDCL. So that is a plan. And if you look at the pockets they are targeting, are pockets where they can see good set of customers, industrial, commercial, and high-paying residential customers. So they are picking and choosing pockets which can be remunerative for them. And the parallel licensing, not the most ideal setup. So while giving options to the customer is what should be the direction, but parallel licensing is leading to a capex uplift. It could have been done in an alternate way where the existing infra could have been used by the same, by these new suppliers as well. But given the Electricity Act, the way it is right now, they have to set up a parallel network, which is going to drive up the capex in this space. I think the number for Torrent, which we don't cover, although, is 15,000 crores across the three regions over 5 years. And for Adani Energy, it's about 6,000 crores in the greater Mumbai area.
So this is where you're just talking about current capex. So Adani, 6,000 crores for greater Mumbai and about 15,000 crores for Torrent if it gets into these three geographies, which it has outlined, right? Yes. Any sense on Tata Power if they go into this whole parallel network arena?
So their capex, we won't have a view yet. But again, there are different pockets that they are targeting, not these regions, other parts of Maharashtra.
Correct.
But again, subject to the area that they have to cover, they'll have to lay out the same, transformers, distribution transformers, conductors, cables across cities. So it should be a big capex number there as well.
So we'll just talk about how this is obviously great news for T&D players, and we'll Wayne get the view from transformers and rectifiers as well. But just before that, Nikhil, to complete the point for the companies themselves, is it going to be lucrative? I mean, at the end of the day, is it going to be a value proposition for shareholders for either Torrent or Tata if they decide to expand on the DISCOM network and go this way? And what's the sense? Can you give us some ballpark estimates? What is the value this will bring to the table?
See, it's still very early days, and this is not a common practice in India, a parallel licensee. These would be among the few ones. The only legacy one is in Mumbai that we have. So it remains to be seen how they evolve. But in terms of returns, if you think from a capex perspective, let's say a 15,000 crore capex would be about 30% equity funded, on which returns on a regulated basis could be about 15.5–16%. Once the network stabilizes, once you get the customers on board, once you reduce network losses, that's the kind of returns usually distribution companies can make.
And to get to that, return of 15–16%, what would you factor in terms of PPAs, power tariffs, costs, to ensure that there's at least that much ROI, at least on the equity component that's going into this funding of the capex?
Correct. Again, so very early, so they'll have to tie up new contracts for buying power from renewable companies, from thermal companies, which sort of for a new player, at least they won't have the old baggage, which less than MECDCL have. They have good contracts, bad contracts, which they have to live with. But the new parallel licensees, they can sign fresh contracts to buy power, and where they can optimize. I mean, they can buy from related group companies or from other generators, wherever they see the lowest levelized cost of power.
Okay, all right. Nikhil, request you to stay with us. So let's get in Mr. Rajora. Thanks a lot, gentlemen, for joining in. Well, Mr. Rajora, if you could tell us the parallel discom services approved for players like, say, Tata Power, Torrent Power, what does it do to the overall addressable market for you? Any kind of approximate capex as well that you could look at because of this new addressable opportunity?
Thank you on this, first of all. Let me tell you that the broader prospect of this initiative is not only is going to be benefited for the companies like us, T&D Industries, but it is going to be the bigger service opportunity for the consumers also. And the state is also going to be benefited for this because the service and quality will going to be improved, as well as the cost of electricity is going to be reduced slightly because there will be competition in that. As far as the capex is concerned, as just now the other gentleman says that we do not know what are going to be the capex infusions are there. But yes, there is going to be a very sizable capex when you are going to create a parallel distribution network. And this is basically step is not going to be confined up to a city or a territory, but what I understand, the state government is more focused to reach out to the rural part of the states where the electricity is not reaching. And as says, is thousands of crores of capex is required into that. And probably as just says the Torrent has come up with 15,000 crores, Adani is coming 66,000. Tata may end up more than this because traditionally Tata is in Maharashtra since long and they don't want to lose that areas, right? So this is going to be a bigger game changer, not only for the state, but is going to be for the other part of the country also. That is what I feel.
Got that point. Just hold on to that thought. You know, the reason why the Akzo Nobel stock is moving higher right now from lows, despite the deal being done at around 2,700 rupees itself, is because there has been an open offer which has been made, and the open offer made by JSW Group is at over 3,400 rupees, 3,417 rupees per share, if I read that correctly. And that explains why the stock has seen a big rally from the lows today itself, up 6%, actually the highest single day gain that we've seen all the way since the company announced that they are looking, the promoter entity announced that they are looking to sell this business itself. The open offer at 3,417 rupees is a lot higher than yesterday's close and is a lot higher than the price at which the deal happened as well at 2,700 rupees, which explains the big move that we're seeing. But back to the power discussion, you know, on Torrent Power itself, the question is that while you are looking to grow here, can your existing infra, lead this growth, or you will have to put up some new infra for the same? Chanchal?
They have to put up a new infra because the existing infra will not be able to sustain this, and if they want to reach out to the every corner of the state or the city, they have to put up the new infra.
And how long before do you think this will actually fructify? Because, you know, announcement is one, execution and the actual implementation of this is the other thing here. What are the realistic timelines?
This may take several years. It's not going to be happen overnight. In my view, it will take 5 to 7 years. Because first they have to go to the regulatory approvals, then they have to go for the different capex infrastructure things. They have to put up the setup and ultimately to reach up to the last digital facilities. You know, and then going to the metering and reaching to the consumers. I don't think it is going to be happened in overnight. I feel that it's going to be happened at least 5 to 7 years.
You know, gentlemen, all this is happening and we're having this discussion at such an interesting time because I want to remind our viewers, and this was actually a very recent story, so I don't know if people missed it. All of this is happening at a time when, for the first time in I don't know how many years, Maharashtra is looking at reducing electricity tariffs. In fact, if I go by the quotes that Mr. Fadnavis, and he has the electricity portfolio in the state, the quotes that he's given, that power tariff rates can drop by as much as 26% over the next 5 years. This is different from otherwise all the discoms coming in asking for a tariff hike in every year. Nikhil, comment on this. I don't know if you caught this news or not, but this is exactly what it is. And I'm quoting the minister. For the first time in Maharashtra's history, electricity tariffs are being reduced, not hiked, starting with a 10% cut in the first year. Tariffs will drop by 26% over the next 5 years in a phased manner. This is from Mr. Fadnavis. So, what do you make of this and all of this capex being put to work that we're discussing at a time when tariffs are going lower? Could that be an issue?
See, the tariff cut spoken about, firstly, it will be different for different segments of customers. So the lower end of customers possibly get a higher cut in tariffs, and industrial and higher usage customers, maybe not so much. The rationale for it, see, one reason we can foresee is if you look at the last couple of years, coal prices have come down. Spot market, which is exchange power prices, have come down. So from a DISCOM standpoint, input power cost or input cost for them for buying power from different generators has sort of normalized over the last couple of years after the high we saw in FY23. At the same time, many DISCOMs across the country took tariff hikes. So hence, a combination of this, higher tariffs, lower cost, is leading to a lower ACS ARR gap or lower gap between cost of supplying power and revenue realized by many DISCOMs in the country. So the number for your reference at the national level fell from 50 paisa to 19 paisa of losses per unit in FY24, and we think it could be similar or a lower number in FY25 as well. So given this factor, that's why.
Let's bring that back to Chanchal. Chanchal, you said everyone is looking to capitalize on this opportunity. The problem is the capacity and the availability of raw materials. Do you think that people will be able to, get that sort of raw material to be able to capitalize on this? Because demand, obviously, no problem. Everyone wants more power. But is there enough supply, enough capacity and availability of raw materials?
The thing is, raw material is a constraint as of now today. But see that these things are not going to happen overnight. These things are going to take place in almost, say, 5 to 7 years' time. And raw material availability is now slowly easing up. Yes, there are the constraint in some of the raw material aspects, like particularly if you see on the transformer sides, there is a constraint on the high voltage transformers, but distribution transformers are well available at this moment. But cabling is the constraint which is now easing up. Metering is available. The raw material things are easing up in this country, and this is going to be a 5 to 7 years chain. So I feel that we will be able to sustain and we'll be able to overcome out of this. That is what I feel into that. And look, reducing the electricity, which is just we were discussing about the electricity charges. We also need to understand that the cost of renewable energies is now going down, and lots of renewable energy is coming up into the country, particularly states like Maharashtra, Gujarat, Rajasthan. And it requires the consumers. And it is this is giving a new opportunity to all the producers, and they're going to be benefited for that.
Absolutely. And I also just want to add here that this power reduction that's been announced in Maharashtra, it is being announced by the state DISCOM, by Mahavitran. So that is where, that's the whole discussion, that what will be the viability. These are parallel networks. Will they operate in the same geography, or whether the geographies will be absolutely clearly demarcated? So that's something that we have to see. Nikhil, finally, to round things up, what do you like here? The generators, distribution companies, you can play T&D, you can play the grid. What would you look at from an investment perspective?
No, specifically to this development on the distribution side, we don't have many companies in our coverage in the distribution space. Beneficiaries obviously would be the transformer manufacturers, conductor cable guys from this capex if it happens, and the 3 utilities which are applying for the license, Torrent, Tata and Adani. But yeah, within our coverage, we don't have a direct play for this development.
All right, we take that point. Thanks a lot, gentlemen, for joining in and giving us your views on this. Let's see whether people can capitalize on this. All the initial issues are taken care of, and eventually everyone benefits. The customers due to higher power, and at the same time, investors who look at players who will benefit from that itself. But the big news of this morning has been the big deal in the paint space, where JSW Paints has gone ahead and acquired Akzo Nobel. In fact, we had an inkling of that from many months. Why is that? Because Parth Jindal himself had told CNBC-TV18 at the World Economic Forum Summit in January in Davos about the Akzo Nobel India acquisition, their interest in this business so far. Listen into what he had to say, and thereafter we'll get an expert to comment on it.
I think there's no choice. If JSW and the ambitions we've shown that we want to be a top 3 player in whichever sector we play in, if I have to do that, then I have to give it everything that I've got for Akzo.
How will you fund it?
It's going to be a mix of the family investing, and private equity.
All right, so that is, you heard it here on CNBC TV18, Parth Jindal himself saying that because of the ambitions that they have in the paint space, they are targeting close to around 5,000 crore revenue by FY26. 2,000 crores is what they crossed in the previous financial year, just about broke even on the EBITDA. They have to grow faster, look at inorganic, and Akzo Nobel was the asset on the block and for which they had made an offer as well. The open offer for up to 1.14 crore shares of Akzo Nobel at around 3418 rupees per share. Gurmeet Chadha now joins in. He's the managing partner and CIO at Complete Circle. Gurmeet, you've been tracking the paint space for a while right now. Asian Paints obviously dented by the aggression shown by Birlas, but now we have major conglomerates who always had an interest in the paint space, but JSW going ahead and buying Akzo Nobel gives them a higher chair at the table. What do you make of this for Akzo Nobel and at the same time the paint industry in general?
Good morning, Nigel. It's going to get very competitive. We recently, and Jindal is an aggressive group. By this acquisition, it's already in top 3, top 4. We saw Birla Opus presentation, a few weeks back, where they spoke about annual capacity of 1,100 million liters per annum. That is just second only to Asian Paints, which is roughly around 1,900 to 2,000 million liters per annum. So, and Jindal will get aggressive. So, may not be great news for Asian Paints from a competitive intensity point of view. But overall, from a sector perspective, it shows you that the prospects are pretty bright. We have seen a series of real estate launches last couple of years. But the decorative side, the home improvement side hasn't done too well, whether it is paints and tiles and home decor and kitchenware, etc. And now as projects complete and the civil work gets done, the home improvement gets into shape. And a lot of the launches have been at the mid-affluent and high-affluent segment in NCR, in Mumbai, in Bangalore. And so the overall demand will pick up, but only from a paint industry point of view, there will be another, competitive pricing. Birla has already reached almost 6.7, 6.8% market share.
6.7, 6.8% market share. It's you suppose it is bad news for Asian Paints, but do you think it is bad news for the sector in general because margins of the sector would be compressed going forward, and at the same time there could be a multiple derating from here on?
See, it's already, some of it is already in the price. If you see the performance of the share over last couple of years, despite markets doing well, despite crude, being lower. In fact, this entire year, it's been averaging at around $70, $75. The stock hasn't done much. So some of it could be in the price. And maybe it may not reflect immediately. But yes, overall, from a near-term perspective, the industry does well, the volumes go up. But I agree with you, margins could come under pressure. Birla Opus also, when we did dealer check, they were putting up these machines, pretty quickly and at, almost at a very reduced cost. Asian Paints used to be very selective in terms of putting the machine, in terms of color mixing, etc. Birla became very aggressive there. So they obviously have been outspending it. And that also added to the pressure in terms of dealer footprints, etc. So I think it will create more competitive intensity. Good for consumers, may not be that great news for all paint players in general.
So the bottom line is, Gurmeet, I'm warning, will you start buying paint stocks? They have gone through such a long winter, but the heat is still on. Competition will probably come in. I mean, these are serious players. They mean business. The question is, buy paint stocks or still stay away?
I would suggest it would be not a great idea right now because wherever you see competitive intensity going up, we've seen that in cement. We saw that some of the price action in cables and wires also, but a lot of them have come back. So I think there are more opportunities in the home improvement space. You should look for things which are more predictable in a market like this. And market isn't cheap. It isn't that even, look at, for example, Akzo Nobel shares. They haven't not done anything for last 3 years, but they still trade at 30, 40 times. Asian Paints hasn't done much, let's say, last couple of years. But you're not getting it at 15, 20 multiple. So my suggestion is that Indian markets, that valuations are rich in a lot of large pockets of the market. So you have to be in pockets where valuations are more reasonable, pricing is more predictable, margins are more predictable. This is not a market where you just simply start playing momentum. And we've seen that in terms of price action over the last couple of months at least. So avoidable in my view. There are better spaces in home improvement. There is, as I said, nothing has happened in tiles. Nothing much has happened in sanitary. Nothing much has happened in kitchen and cookware and appliances. I think there are better opportunities there in my view.
Okay, got it. So play maybe the cooker and the tile and the bathroom fitting folks. Just leave out the paints for the time being. Got that point.
Just one clarification.
Thank you, Gurmeet.
Yeah, just one clarification on the entire paint industry. There are a lot of people, when they keep talking about how new real estate supply will aid growth for the paint industry, etc., 80-85% of the paint industry still comes in from repainting as against the new supply. So even if real estate supply increases a fair bit, you don't have as much growth on the paint industry because it's 80-85% which is repayment demand. And even the prices of paints, everyone says, okay, prices of paints going down is good or bad, etc. for the industry. Prices of paints aren't as big a determinant of demand for paint anymore in the country, because 30-40 years ago, you had 20% of the overall cost of painting that was labor. That has increased to about 50-55%. So if paint prices increase by about 10% or 15%, your overall cost of painting increases just by about 4 or 5%, because 50-55% of the cost is still the labor.
Correct.
So that is something that we'll have to watch out for.
Absolutely.
Okay.
All right, with that, what we'll do is take a short break, come back on the other side. Amitabh Malhotra of HSBC India and Bhavesh Shah of Equirus join us, Wealth, to discuss the recent frenzy that we've seen in block deals.
Welcome back. Guess what? The dip is getting bought. Well, not too much. The market's flat, but that's the point, that every time there was a red, and there were 3 instances of red so far this morning, it's a different market, it's a different texture, and the approach is to buy the dip. And that's exactly what this morning has been all about, at least so far. Well, the other big headline from the market has been all the block trade activity and the block action. So that's exactly what we're going to focus on. We've seen deals worth almost 21,000 crores in the last 2 weeks alone. And of course, the number is much, much bigger if you start compiling from the start of the year. So to decode the environment, the drivers, the pricing, and all of that, we have with us 2 experts, Amitabh Malhotra, Vice Chairman Investment Banking at HSBC India, and Bhavesh Shah, Managing Director and Head of Investment Banking at Equirus. Gentlemen, thank you very much for joining in. Amitabh and Bhavesh, good to have you on. I'm sure you folks have been very, very busy for the better part of the last 12 months, because Deal Street has perhaps never been thriving as much, right? So let's get your opening thoughts in, Amitabh. The naysayers will always raise the question, is there too much supply coming? Does it indicate that valuations are near a top? But, you tell us, which side of the argument are you on?
Look, I think the market is seeing and will continue to see a good amount of activity and support for issuances. There are a bunch of factors that have contributed towards these large set of issuance. As you said, there have been a lot of large blocks that have also happened. There have been recent scale down in geopolitical tension and easing of trade uncertainties. And there are other macro factors like strong GDP growth and recent rate cut that we saw. There have also been significant positive trends in the full year results by corporate India that has further aided the market backdrop. You've seen FIIs increase interest in the Indian market, particularly since April 2025. They were net sellers before that, but you've seen them become net positive buyers. Retail inflows and domestic mutual fund have supported this resurgence. So all of this have led to a reduced market volatility. It has reinforced investor confidence and enabled recovery in deal activity. So I'll summarize that recent IPOs at optimum valuation, strong moats, robust financial and well-funded growth plans offer really a long-term value creation that has received strong interest from local international investor, and we think it will continue to be like that.
Amitabh, just a question, maybe an unfair one, but I'm asking you from the top of your head. The exits have included both Indian promoters paring their stake and maybe raising money to invest elsewhere. But the exits have also included a lot of private equity finally moving out. And that's the nature of private equity, perhaps nothing wrong with that. But can you give us some numbers and some quantum, say in 2025 or maybe the last 12 months, whatever data you've looked at recently, what's been the total value of deals? And roughly speaking, how much would be foreign exits? And then the question, is that a concern?
Look, it's difficult to give you data at hand, but I'll give you some kind of indicators to that. You're right in saying that there have been a mix of both offer for sale and primary fundraise. And at the point being, the market has shown some really good appetite for secondary absorption with the likes of, for example, Hexaware Technologies. It was 100% OFS over $1 billion. And now we are seeing NSDL on the road with 100% OFS. So market is now accepting these stories. This indicates that the market investors have become more mature and resilient in accepting OFS as part of an IPO, as long as the company's fundamentals are strong and pricing is reasonable. And some of these examples that I gave are pretty much an proxy for that. Look, although fresh funding will still play a strong role in growth sectors like renewable, tech and fintech, we believe there will be a slight tilt towards OFS-led IPOs in 2026, particularly because the nature of these situations are where, like you said, private equity, some money to be taken by the promoter of the block to fund their other acquisition. You talked earlier about JSW Paints, obviously looking at acquiring Akzo Nobel, so they've also funded that through that route. So we'll see that happening a lot more.
Okay. All right. Interesting thoughts there. Let me come to Bhavesh as well. Bhavesh, similar sort of questions to you. Your thoughts on the deal buzz that we've seen. And again, the fact that there are so many OFSs. Amitabh is saying it's a sign of maturity of the market. Your thoughts? Is it a concern? Is it not indicative of maybe valuations?
Surabhi, thanks for having me on this on the show. What I can say is what we are witnessing right now is a completely game-changing scenario in the capital markets. It's a very, very positive sign that we're seeing in terms of both the absorption of the stock which is coming into the market, and B, the willingness of the sellers or the ability for them to sell in the market as well. If you really look at the statistics on the demand side, it's 26,000 crores worth of systematic investment plan, mutual fund equity coming into the markets every month. And that's almost like a $3 billion. And the mutual fund investors, they are always looking for great companies to invest in. We have seen data where companies where mutual funds have invested, the same mutual funds want to invest more and more in them. For every IPO, that happens, there's a huge amount of work that happens by the mutual fund investors and other investors before they raise their hand to kind of invest in the IPO. But the allocations that they get in the IPO is far too little for the amount of work they do and the amount of resources that they have to invest. So it is this block deals which really help them scale up their investments into each of these companies. And we have seen that for every opportunity for them, they just kind of, add, as long as the company is doing very well, as long as company has kept its promises, of doing what they have done. I call that as a say-do ratio. If the company is doing what they say, they're maintaining a good say-do ratio. And if the say-do ratio for the company is good, the mutual fund investors are putting more and more money. And in fact, block deals are in fact a very good way for investing for the mutual funds, especially without creating any distortion in the prices. They can buy in bulk. They in fact can get a better deal, negotiated prices.
No, absolutely. And Bhavish, we hear that because when we quiz the mutual fund heads and the mutual fund CIOs, they say exactly that sometimes, you just don't have adequate stock in the market. So at least when there are good blocks, it allows us to participate. By the way, I think this consensus here within us in the studios, we love the concept of the say-do ratio. I think it should become a standard feature in all financial reporting. What is
not just financial reporting? I think everything ever, what you say versus what you do. What a wonderful ratio that is.
What about Mr. Donald Trump's say-do ratio then?
His will be the lowest.
That's a tangent.
Or rather the highest, depending on 2 weeks. Yeah, so his say is a lot more and do is, we don't know.
Shouldn't go there. Okay. I'm bringing the discussion back to investment banking. But Bhavish, you also raised an important point, right? That mutual funds have been, the whole fraternity has been such a strong support, right? They've been buying a lot of the paper that's on offer. But again, I'm playing devil's advocate here. The fact that mutual funds are not getting the kind of flows that they were getting at the peak of the market, and maybe that turns because the market's turning, sentiment is a big thing. But the last 4-5 months so far this year, flows have been coming down, systematically coming down month after month. Could that be a risk? Who will absorb all this supply? And is oversupply a risk for the market? This is something, and I'm not saying this, this is something that CLSA's Vikas Jain told us just earlier this week, that from an overall listed market perspective, the sheer supply of paper could become a concern. Let's take quick thoughts from both of you. Bhavish?
So I personally feel that, we used to have in investment banking something known as a overhang of stock in the market. And we would advise the stakeholders before they went public to see how they can make this as diverse as possible, their shareholding, and as long-term as possible so the incoming investors don't see this as a stock overhang and which can have a potential stock pressure. We are now seeing a complete reversal of that situation, in fact. And again, I go back to the same, if the company is performing well, in fact, the investors want to invest more and more in the same company. So in fact, the stock overhang is now becoming an opportunity for many of the investors to see that I just don't need to hold a small stake in the company. I can eventually hold a larger stake with the kind of money I'm getting through the systematic investment route. I can deploy more and more in the same company. So in fact, the stock overhang, as long as the company is doing what they promised to do, I don't think stock overhang is an issue at all.
Okay, very quickly, Amitabh, your thoughts? Is oversupply a risk?
It's a multi-billion-dollar question, but seeing it from our lens, I think with many companies getting ready and already lining up for public filings on the back of a fairly robust second half 2025, we believe the momentum will continue in looking forward on 2026 as well. And then you talked about both FIIs and in terms of mutual funds. The AUM for domestic asset managers is growing on a monthly basis. And we think they command now a significant space and weightage in participating in many of these issuances. So the point being that with FIIs becoming net buyers and DFIs continuing to kind of increase in their AUM, we think there's going to be significant activity also in the secondary market. And but and there's always a but. This outlook remains subject to overall market condition, regulatory developments, and evolving geopolitical landscapes, because that could influence timing and investor sentiments and create short windows of opportunities. So I will say optimism with a bit of caution.
All right, gentlemen, appreciate you joining in and filling us in with your take. We look forward to revisit this particular point in the couple of weeks or so. Thanks a lot for joining in. Getting back to the markets, though, the Nifty, well, it's more or less flattish. The Nifty Bank is down close to under 100 points. The trend is still up, as we've been mentioning. The 20 DMA has been crossed decisively, but a few stocks doing a thing of their own. Case in point being Dixon Technologies, that is up close to around 4%. Mitesh Thakkar is back with us. Mitesh, what's your take with regard to the markets? We started off well in the green, pull back a little bit. Would you use a dip to buy into the Nifty and Nifty Bank?
I think on the index, maybe not, but I think it's, the index has been moving so slowly, barring the past 2 days, that the trading interest may be slightly on the lower side, though the drift is still on the positive. So I'm positive. I think the index would go to possibly 25,700. But entering now after 2 days kind of a rally may not be the best idea. So avoid the index, but trade with long bias on the stock side. I have a buy on Coal India with a stop at about 392 for targets of 410. And Coforge has given a good breakout today, good continuations signal. So buy here with a stop at 1920 for targets of 2025.
All right, we take that point. Mitesh, thank you so much for that. We'll take a short break. On the other side, Manisha Gupta joins in with all the updates from the commodity space. Stay with us.
Welcome back. Well, let's shift focus to the commodity markets now. We have Manisha joining in. Manisha, it's a happy Friday for equities. You tell us what's up with commodities, considering the dollar is falling so dramatically. What does that imply?
Oh, absolutely. I'm looking at the copper prices, because metals, when you look at the month of June, clearly have been outperforming. So while the crude prices are consolidating and gold really hasn't done so much, but it really is metals, and within that as well, it is copper that you have to keep a look on, because we've seen overnight gains in copper to the tune of 2.5%. For this week now, we are at 5.5% for copper. And for the month of June, as I said, we're looking at 9% of gains coming in for copper, and clearly outperforming 2025 for many of those base metals there, with nearly 28% of gains. So copper, clearly the next gold, is what the street seems to be talking about. That phrase has been coined, and we've seen copper kind of live up to that. Well, Iran-Israel ceasefire is one of the factors that has led to some support coming back in case of industrial commodities. And then the markets also are looking at the weakness in US dollar index, which is trading at a 3-year lows. That has been supportive. Take a look at the demand supply numbers as well, and that has been supportive. When you look at the spot prices, they are trading at a $300 premium to the 3-month futures. So that tells you that the demand in the very near term is on the stronger side, and we have seen backwardations go all the way up to 2026 June. So that tells you that there is supply concerns absolutely coming in. The ready available inventories have declined by 80% in 2025 till time. Well, actually, it has been a 60% of a decline from the month of March itself when it comes to inventories. And with the kind of inventories that LME is holding at this point in time is perhaps just good for one day of global demand. So there are concerns coming in because of that one. Also, when you look at supply disruption, well, we've seen that also continue into the trade there. There are risks on tariff. You could be looking at tariffs coming in copper. US has been talking about it for some time. And then refined copper shipments to US are at multi-decade highs of around 2 lakh tons. So everywhere that you look, you're looking at very strong copper fundamentals there. I also want to take you through supply disruption concerns coming in from Chile and Congo as well. Well, whether it has been about refined copper, supplemented copper, or mining itself, there have been some disruptions coming in. If you look at the consumption in the meanwhile, and that comes in from IEA's data, which tells you that in 2023, while we did see 26.5 million tons of copper demand, by the time it's 2035, the copper global consumption is expected to gain up by almost 32.6 million tons. Much higher, and well, no, we're not looking at supplies increasing in the same way. The consumption for the clean tech is expected to gain much higher. 6.4 million tons in 2023 is expected to be at 11.5 million tons by the time you're in 2035. Well, this demand comes in from EVs, from chips, from transportation, from construction, and of course, energy transition. There's an important statement coming in from BHP as well, which say that the copper mine grade is constantly declining. They also say that where we were at least a couple of decades ago, the grades have continued to decline. The mines also are facing aging challenges. So on the mine side as well, there are concerns coming in. And more interestingly, the University of Southern California says that next 20 years, the kind of copper demand that you would be looking at is the kind of demand that you have seen until now in all of these years. So with those kind of numbers coming in and everybody putting in a very, very bullish tone for copper, the prices have only one way to go, and that's higher.
Okay. Got it. Manisha, thank you very much for that. Well, with that, we have to take a very quick break. Come back on the other side, and it's our special segment, Indianomics. Lata speaks with economist Praveen Krishna of Johns Hopkins on the likelihood of reciprocal tariffs after the July 9 deadline.
We have been discussing the global financial markets in the context of the run-up to the July 9th deadline for reciprocal tariffs. Financial markets have been relatively calm, with the S&P 500 very close to its all-time highs, and Indian markets as well making gains. I have with me Professor Praveen Krishna, the Distinguished Professor of International Economics at Johns Hopkins University, an important speaker at the NCAER's India Policy Forum to discuss how he sees both the domestic US economy as well as international economy gliding through this move towards July 9th. Dr. Krishna, thank you very much indeed for joining us.
Pleasure to be on your show.
Well, first up, how scared should we be about July 9th? If India doesn't get into an agreement, our tariffs go up to some 24%. Otherwise, it is 10%. Every country should be equally worried, but do you see it getting put off? Can we be as sanguine as the financial markets are?
Yeah, about July 9, I'd say that there's an extraordinary amount of uncertainty at the moment. From India's perspective, this would be for at least two reasons. One is that negotiations are ongoing. It is at least conceivable that something is achieved before July 9 of sufficient magnitude that satisfies both parties so that the July 9 tariffs are not imposed back. That's on one possibility. The other is that given the broader domestic concerns in the United States, the possibility that tariffs, the imposition of tariffs will lead to inflation, for example, that sort of set of economic considerations leads the US itself, regardless of a particular agreement with India, to extend further this deadline and maybe to say, listen, July 9 is too early. There have been multiple events that have come in between, the Middle East crisis and India-Pakistan war and so forth. And so let's just push this off for another 60 days or 90 days or whatever it is. The level of variation in terms of what's come out of the White House and the Trump administration in the last few months has been so great that it's really hard to forecast accurately what this would be. So just in terms of what happens by July 9 and whether or not we get the tariffs or not, that would be my reaction to that. In terms of the actual costs of the tariffs, right? So currently, as I understand it, US tariffs are in the range of somewhere between 5 and 7% weighted average on Indian exports. If the July 9 tariffs are imposed, we're talking about maybe a 26%. Let's say it's about a 20% increase of tariffs. That would be on about roughly $85 billion of Indian exports. So 20% of that is $16 billion. One should be very careful, and I see incorrect calculations sometimes about this, that $16 billion is not a cost that's paid by Indians. It's paid by the importing entities for most part. There's some question about whether some of that gets passed on to Indian exporters regardless because they absorb some of this cost and so on. Let's say you had that on a 50-50 basis. 50% of those additional costs are paid by US importers, 50% are taken on by Indian exporters. In that case, you're talking about 16 billion divided by 2, that's about $8 billion. So that's not a very small number. And at the same time, it's for a country India's size and given our export basket overall, I don't necessarily think that it's a devastating number either.
Okay. Well, most of the manufacturers we speak to say there's no way we can absorb, 25%. They're expecting it to get passed on.
Right.
So what's your sense, therefore, of US inflation? Do you think that Jerome Powell is right? He's not moving in spite of the fairly big positive real rate at in the US now, because there is every chance inflation will rise?
There's every chance that inflation will rise. One of the interesting facts here is that the tariffs, the announcements of the tariffs, or the expectation of tariffs, was already in place by February, March, and of course the April announcement. But having announced the tariffs, they were not actually imposed, right? And so the kinds of price increases that you might have had by now, by May or by June, had the tariffs actually been imposed, we're not seeing because the tariffs were announced but not imposed. And so now the expectation is that if now they're finally, in fact, imposed by July, that you might start seeing them affecting prices and so on by later on in the summer, by August or September and so on. And that, I imagine, is what Jerome Powell is actually talking about, which is that given that there is this overhang of this issue of tariffs that might impact prices, that it would be a little too early for him to act in terms of reducing interest rates and so on and so forth. So that concern is there. It hasn't been fully realized, in part on top of the fact that these tariffs were announced but not imposed. There's also this issue that there were large inventories that American importers were holding, and so that carried the U.S. economy through for a couple of months. My understanding is that we've kind of come to the end of that. So now if tariffs are actually imposed, you are going to be paying these higher costs on imports from China, everywhere else in the world. And I expect that there would be some implications of that for prices, very naturally. Yeah.
Okay. What is your sense about the dollar? I mean, It's sub 100 for quite some time now, the dollar index, the DXY, and below 98 as well. Do you think the dollar continues in this downward trajectory? And what is this? What are the factors triggering that?
So all of it, I think, I mean, as far as the dollar and the decline, the small decline up till now that the dollar has experienced, I think all reflects concerns about what the kind of the budget is going to be about, right? So if there's a sense that there's going to be...
You mean the big beautiful bill?
The big beautiful bill of Donald Trump. If it's going to lead to budget deficits, large amounts of financing that has to take place through the printing of money, one way or the other, where you're expecting higher levels of inflation, naturally there's going to be an expectation that yields have to be higher to compensate for that. And so this is the reason that you're sort of seeing people moving out of U.S. Treasuries, and that more than anything else has the kind of the first order impact on the value of the dollar.
Okay, but what's your sense about U.S. growth itself? I mean, the markets are sanguine, although the Fed, even in its SEP in the last policy, clearly marked down U.S. GDP. Why are markets so comfortable? Any guesses?
So, I mean, look, on the one hand, you could look at the world as it is, the multiple wars, the trade wars, the wars in the Middle East, and various other things that are going on, and worry tremendously about where the U.S. economy is headed or what the implications of all of these factors are for the U.S. economy, and ask the question, why is this not reflected in the stock market? And that would be a reasonable question to ask. And if you took that position, that stock should have gone down, you would be on solid ground, I think.
Yes.
On the other side of it, there is this expectation that the big, beautiful bill will do enough things for the U.S. economy, at least in the short run, from the standpoint of taxation, from the standpoint of various subsidies.
So tax cuts and higher earnings, higher EPS.
Higher subsidies for varieties of activities that are undertaken in the U.S., corporate activities and so on, that sustain the stock market. There's that expectation as well, that if this bill actually goes through in some form or some form that's reasonably close to what it looks like at the moment, that could be very supportive for corporates, and that keeps stock prices high.
What's your sense about India? The optimistic way we look at it in India is that if the minimum 10% tariff remains, at any rate, China is going to be charged more. Even now, they are being charged more.
Right.
So, an Indian textile maker or an Indian shoe maker, footwear, textiles and footwear, things that even India does well, will come to India because there is this 20% tariff, percentage point tariff differential. That's huge. That's enough for a company like a Nike or a textile maker to invest in India rather than China, even pull out of China and invest in India. Is that a good hope? Is that a decent argument?
On the one hand, the fact that the tariffs on India are going to potentially be lower than what Bangladesh might face or Vietnam might face or what's actually been imposed on China, it's given some sense of hope to some people that maybe there's an opportunity that we can seize, right? But my sense of this is, look, if these tariffs were frozen in place for the next 2 years or 5 years or 10 years, if investors had this confidence that this is what the tariff regime globally is going to look like, maybe someone who's currently based in Bangladesh or Vietnam is going to say, let's move to India, right? But the chaos is so great at the moment, and the uncertainty is so great at the moment, that what looks like a lower tariff for India relative to Bangladesh might quickly flip if Bangladesh has some sort of deal with the United States or the Vietnamese do, or there's some other change in tariffs, right? And so if you were an investor sitting in Bangladesh or Vietnam at this point, you would really have to take that into account. How long is this tariff differential actually going to last? My sense, therefore, is that investors would probably wait a little bit. They'll probably be well advised to wait for a little bit before taking such decisions, especially in industries where there are large fixed costs associated with production, right? If this is just some trading activity where there isn't a big fixed cost, there's no physical plant that needs to be installed, there's no employees in large scale that need to be employed, maybe moving from one country to another in a kind of a footloose manner following these tariff changes is an easy thing to do, right? But that is not true for many industries and perhaps not true for most industries.
Yeah,
and
because of this big uncertainty.
Big uncertainty that the tariff advantage might not even exist for that much longer.
So we shouldn't count our chickens too quickly.
Too quickly.
Yes,
Too quickly,
but
right.
on that point, let me conclude with what do you think about India? I mean, I don't know how closely you follow the Indian economy. We've had the advantage of good rains, early rains. But there is this global uncertainty that overhangs. We've had some very positive boosts coming. The fisc, taxes were cut. A good 1 trillion has been handed back to taxpayers as well. We've seen massive interest rate cuts as well, 100 basis cut in the last 3-4 months, and then there's going to be a cash reserve ratio cut as well. So interest cost of capital is going down. So how would you bet on India? Are we any closer to 7%, or will we still do worse than last year simply because of the global uncertainty?
I mean, certainly in the medium run, for all of the reasons you mentioned, and a few others in terms of all of our investments in digital infrastructure, physical infrastructure of the country, they're just very obvious, the improvements that you're seeing everywhere. In the medium run, I am very optimistic about India. In the very short run, what's going to happen this year, what's going to happen 12 months out and so on, it's a little harder to say. Given the range of geopolitical uncertainties, given the range of economic uncertainties, even something as simple as crude oil prices, right? A week ago, it would be completely understandable if someone had forecast a very large increase in oil prices, and it actually hasn't been realized. You haven't seen these increases in oil prices. So if that had actually happened, that would have been bad for India. The fact that it hasn't happened is good for India. These uncertainties are still very large enough that it's hard to say what the coming few months and maybe the year out is going to look like. I feel reasonably good about the Indian economy, but I think I should say I feel more strongly optimistic about the medium run than what's going to happen in the coming few months because of all of the factors we've just discussed.
Okay, well, we'll keep our fingers crossed since a very big geopolitical tension did not push up crude prices. Maybe we are only overestimating our problems and we will still get by with higher rate of growth. Thank you very much, Dr. Krishna, for joining us on Indianomics. That's it on this edition of Indianomics. More news and updates follow.
Market opens largely flat, contrary to the gap-up start suggested by the GIFT Nifty. It is IT and metals that gain, while financials and realty drag. The broader market outperforms.
CNBC-TV18's news break is confirmed. Akzo Nobel India surges with JSW Steel set to acquire the promoter stake in a deal worth 9,000 crore rupees at a price of around 2,762 rupees a share. JSW Paints has also announced an open offer to acquire the remaining stake at 3,417 rupees.
Hitachi Energy surges as it secures an order to supply 30 single-phase transformers to power grid. Analyst estimates that the order could be well worth over 1,000 crore rupees.
Petronet rallies as ICICI Securities upgrades the stock to an add from a reduced rating. Earlier, the brokerage has raised its target on the stock to around 330 rupees from around 250 rupees earlier, expecting steady improvement in performance till FY28. Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam, and it's a super start actually to the new series. Well in the green, the broader markets, that's the one that I'm talking about, looking very, very good. Hey, Mangalam.
Hi, Nigel. Yesterday, the broader markets were slightly skittish. We did have the advanced decline ratio right down in the middle, split right down in the middle. Today, portfolios would be feeling a lot better, even as the Nifty is consolidating around 9-month high levels itself, just under 25,600. The good part, the Nifty Bank, that has been, an important one this session so far because it opened mildly in the green, thereafter sold off, and that dip has been bought into, currently back near today's high so far in the morning and close to its all-time high as well for that frontline index. Good time to get in Manas Jaiswal for a quick technical check on the market. Manas, less than 3% away, around 2.5% away from all-time highs on the Nifty. All-time highs on the Nifty Bank, we're there already. Where do you see the markets headed? Near all-time high coming in the very near term on the Nifty?
Good morning, Mangalam. So I think yesterday's move is a breakout move because Nifty has broken the key resistance range of 25,200 to 25,300. Now, if you want to set the target of this yesterday's breakout, I think the target comes near 26,200. So I think Nifty can test its previous high of that, I think 26,200 only. So positionally, I think you can create long position even at current levels. If you can keep the stop loss below 25,300, then you can play for the target of around 26,200, 250. However, if you're talking about for 1 or 2 trading sessions, I think you should wait for some correction. On declines near 25,500, you can create long position. Stop loss should be around 25,400. And the next target comes near 25,900. But I am more bullish on Bank Nifty because in Bank Nifty, you can see a clear-cut breakout on the long-term charts. And the target of this breakout comes near 60,000. So from current levels, you can see almost 3,000 points rally in Bank Nifty. For trading purpose, I think even at current levels, you can create long position in Bank Nifty. Keep your stop loss below 56,900 and target would be around 58,000.
Okay, all right. Nifty Bank, a 300-point move is what you're expecting in the near term. Manas, what about individual stocks?
So I think for today, I think you can buy Indigo because Indigo has given a fresh breakout on the charts. We have seen some consolidation, but now since stock has given a fresh breakout, you can create long position here. The stop loss should be around 56.74 and target would be around 5900 on Indigo. And second is a buy call on Adani Energy because most of the Adani stocks are looking strong on the charts and Adani Energy has broken its 200-day moving average. So take a long position here. Stop loss should be around 879 and target would be around 925.
All right, take that point. So those are a bunch of stocks. Actually, Manas, we have you with us. Do you have a word on any of the PSU banks? They seem to be taking off right now. A big move is what we're seeing on Bank of India, there's Union Bank, Canara Bank. All of them have moved higher, including the likes of PNB as well. So, the entire PSU bank index comes up for you on the screen right now. The Nifty Bank actually has been led higher by all the PSU banks. Do you have any particular pick there?
I think one can look at two PSU banking stocks. First is Bank of Baroda, where stock has broken its 20-day moving average and given a confirmation of higher tops and higher bottoms. So in Bank of Baroda, one can create a long position for positional trade. Stop loss should be around 238 and target would be around 254. And secondly, the buy call on Union Bank. Union Bank has given a breakout, inverse head and shoulder pattern breakout on the intraday chart. So positionally, you can create long position over here also. Stop loss should be around 147. And I think the next target would be around 159.
Got it. Okay. All right. Manas, thanks a lot for that. Well, let's shift focus to our special segment where we get you a few ideas for profit from Money Control Pro. Sachin Paul of moneycontrol.com joins us to talk about a stock that he's tracking closely. Sachin?
Multimodal logistics provider Transport Corporation of India delivered a steady set of earnings in the final quarter of FY25. Revenues in Q4 FY25 grew almost 9% year-on-year, whereas the net profits grew to almost 13% year-on-year. On a segmental basis, the revenue streams were quite divergent. The freight business, on one hand, exhibited some weakness, primarily due to slowdown in product execution across capital goods, infrastructure, and the engineering sectors. The margins of the segment also are under pressure, primarily due to competitive pricing environment. On the other hand, the supply chain business continues to remain on a very strong footing and grew almost 15% year-on-year. The management expects this vertical to clock a steady growth rate in FY26 as well, and expects it to emerge as the largest revenue vertical over the next 12 to 18 months. The Seaways business also had a steady quarter thanks to benign fuel prices as well as steady capacity utilization trends. However, it expects the FY26 to be a steady revenue year for Seaways business due to dry docking of 2 ships. On the other hand, in terms of the capex, the company is planning capex in the Seaways business and it expects the delivery of 2 new ships in the middle of 2026, which should pave some recovery in terms of profitability going into FY27. Overall, company remains on a very solid footing and it expects a revenue growth of almost 10% on a YOY basis for FY26. Trading at around 19 times FY26 estimated earnings, which we believe the company's valuations are very reasonable for accumulation from a long-term standpoint.
All right, Sachin, thanks a lot for that. Well, on that note, though, we'll slip into a short break. On the other side, we'll be joined by the CFO of Electronics Smart India to discuss how demand's shaping up and how do they foresee the remainder of this year. Stay with us.
Welcome back. You're watching us here on Chartbusters. We've been tracking the markets. Midcap's doing fairly well. One of the stocks which has actually done extremely well over the last month or so is Electronics Mart. And this despite, there being some concerns over demand in the first quarter on account of uncertain weather and unseasonal rains impacting sales for ACs. What's going on in the consumer durable space? We heard from Vijay Sales yesterday. We heard from the analyst of Goldman Sachs yesterday as well. But let's hear out from the person who actually sells these electronics. Premchand Devarakonda, the CFO of Electronics Mart India, joins in. Thanks a lot, Mr. Devarakonda, for joining in. You had earlier said that, first quarter AC sales, some AC sales were impacted by unseasonal rains. Now we've come towards the end of the quarter so far. How does the business look? How has business footfalls as well as sales been in the first quarter?
Yeah, good morning and thank you very much for having me on your show. As I mentioned earlier, the first 2 months of this quarter for air conditioners is quite disappointing because of unseasonal rains and also early monsoons. But in the month of June, there has been little improvement in all categories. In fact, during the first 2 months also, the other categories did decently. And also they have shown decent single-digit growth. So as we are approaching the quarter end, this is going to be one of the, really not encouraging quarters. In spite of that, we are quite confident that having seen the growth, having seen the performance of these categories during the last 3 weeks, we have seen, we are quite optimistic that if you look at the first half year of this year, I think there would be definitely decent performance in all the categories.
So you hold on to the 12% revenue growth guidance and 6 to 7% same-store sales guidance that you had given earlier, right?
Yeah, that is what we have been targeting, and we're quite confident that that would be achievable.
All right, sir, just to quiz you a little bit more on what you said. Large appliances are around 45% of your mix, I think so. And ACs would come in that. ACs as a percentage of large appliances would be how much?
As a total percentage, it will be around 15%.
15%.
Of the top line. And if I take only the large appliances category, it will be around 30%.
30%. Got it. All right. That fits in then. So you're saying the remaining part of the business has done pretty well. Good to hear that. The NCR business is a smaller part of the business, but margins over there, are a little bit lower. How do you see the margin recovery in the NCR business? And for the company on the whole, what kind of a band should we work with?
NCR, we are new in NCR. So initially our our store launch expenses and advertisement expenses as a percentage of the contribution coming from NCR region is quite high. As a result, there were truncated margins from NCR. As the throughput from the stores, which we started in the last 24 months, has gone up remarkably. So this year, we are expecting that NCR would be break even at PBT level.
All right. So you will break even by when did you say?
It will be breaking even in the current year.
In the current year is where NCR will break in. But South business, which is a mature business, has 7% margins and nearly 6,000 crores in terms of sales. NCR is flat with about 500 crores in sales. What we are given to understand is that the total addressable market in NCR is a lot bigger than that it is in South. So what is your growth plan for NCR and how do you plan the revenue mix between NCR and South to change over the next few years? Because NCR, while it's a big market, I'm sure it's also a lot more competitive, which we can see in your margins.
Yeah, product mix wise is more or less same, both Hyderabad as well as NCR. Whereas the store growth potential is much higher as compared to Hyderabad. So in fact, in Hyderabad, we are averaging more than 70 crores per store. And in NCR, our target is much higher than that. So that is achievable in the near future.
So you have 28 stores in NCR right now with close to 500 crores in terms of sales. If you do about 70, 75 crores, you should have been doing a lot more in NCR, right, per store?
That's what, there is high potential in NCR. So in the next 24 months, we will definitely target about 50 crores per store from NCR. And it is achievable. In fact, a couple of stores are already on the path of achieving the targeted throughput.
Okay, what about the working capital days, sir? Over the last few years, I'm looking at it, from the mid-60s, it's moved to around 80. Where will this number stabilize at?
Sir, it will be around 60. So that is our target. We have to bring it down to 60. And also, if you look at the figures as on 31st March, obviously it is the start of the season. As a result, we will be having huge investment getting into these inventories. As a result, the number, working capital days look higher. But if you take the average for the entire year, it is below 60. And we have to maintain the working capital days around 60 days, and that is our target.
All right, so 60 is your working capital days target. You plan to open how many outlets in the next 12 months? I remember you were looking to open, what, 6-7 outlets in NCR this year. And how many outlets do you plan to open on an overall basis over the next 1 to 3 years?
This year, we're targeting 30 plus stores, out of which 6 will be in NCR, and the remaining will be in South Cluster. And next year also, we are having the similar target. And we might expand to the other regions like Western UP, Orissa. These are the other markets we are targeting in the near future, in the next 12 months, in fact.
All right. And what would your ideal mix of products be? Because large appliances, at one point I remember they were nearly 2/3 of your revenue, but everyone's looking to buy mobiles. Mobile doesn't do much in margins, right? So, I mean, how do you plan your revenue mix to be going forward?
See, revenue mix is not under our control. It is decided by the market demand. So, and second thing, like in case of mobiles, the churn is much higher as compared to large appliances. And over the next 2-3 years, I think the product mix, the sales mix will remain more or less.
All right, we take that point. Thank you so much, Mr. Devarakonda, for joining in. You are fairly confident of achieving that 12% revenue growth this year with 6 to 7% same-store sales growth, looking to maintain margins in that 6 to 7% band. A growth opportunity in NCR is still awaited. In fact, you are investing behind that, and you're looking at geographies like Western UP, etc. as well. Meanwhile, just keep an eye out on a couple of stocks as we're looking at. I'm looking at Angel One in particular, and a lot of these capital market plays as well, because news is that Jio Financials has actually applied for a broker's license, and that's something we'll watch out for, whether there is disruption coming in the brokerage industry or not on account of that. The stocks are off their highs, Angel One and the others. Jio Financial, on the other hand, has spiked to the high point of trade, up around 3.5%. Take a short break. But as we do that, remember to tune into all new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, economists, shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 and Prime at 12 noon for Global Reset, 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
Welcome back. Well, this market is showing signs that the dip wants to get bought into because from trading in the red, we have moved well into the green, and the Nifty Bank as well, from being down 100 points, is now up a good 100 points as we speak. But let's move on then and ask a part of continuing government action against online listing and sale of illegal walkie-talkies. The government sources tell CNBC-TV18 that the Department of Consumer Affairs has written to several ministries in view of security concerns arising out of the sale. This comes after notices sent by the CCPA to Amazon, Flipkart and other platforms. Abhimanyu joins us to fill us in with more details. Abhimanyu?
Walkie-talkies only of a certain specification and working on a certain frequency are permitted as per Indian norms, and any illegal sale of walkie-talkies which do not fit the bill has already been clamped down upon. Earlier, the CCPA, that is the Central Consumer Protection Authority, had issued 13 notices to several online platforms for listing and sale of these unauthorized walkie-talkies, and now the government is looking at a holistic way to curb such violations. Since this illegal listing and sale is still taking place, the Consumer Affairs Department has written to several ministries, which include the Ministry of Home Affairs, the Department of Telecommunications and the Ministry of Electronics and Information Technology. Now, these respective ministries will be looking at their respective domains as far as the violations pertaining to the illegal sale of walkie-talkies is concerned. The matter pertains to a security threat. Hence, the MHA has been roped in. Apart from that, the frequency which is not allowed for walkie-talkies to operate upon, that issue would be looked at by the DOT, and the structural part of the equipment which is being illegally sold would be looked after by the MeitY. It remains to be seen how early action would be initiated by the respective line ministries to ensure that there is a complete clampdown on any illegal listing and sale of walkie-talkies.
All right, we'll take that point. Abhimanyu, thank you so much for that. A bunch of stocks which are spiking right now. Stock of the morning definitely has to be Akzo Nobel, India. The deal has been done. The open offer price much higher than the previous close price. And even as the deal has been at a much lower price than the previous close price, we've seen the stock bounce back, maybe a change of parentage and change of growth direction, and the completion of the deal has a relief rally. But the other relief rally has come by on Asian Paints as well. That stock is up around 1.5%. Maybe the street believes that a new player with some money into Akzo Nobel may not dent the market share of the incumbents, as they have seen competition arising from Birla's earlier as well. So a big move is what we've seen on Asian Paints from lows. Remember, the stock has already corrected 30% from 52-week high already. The other stock we're looking at before we wrap up on this edition of Chartbusters is Nykaa. Held well in yesterday's trading session. The analyst meet continued, and this morning brokerages are happy with the growth focus of the company, up around 1.5% on that stock as well at the day's high. With that, we'll wrap up on this edition of Chartbusters. You stay tuned. Trading Hour comes up next.
Hello, good morning. You've tuned into Trading Hour, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. With me is Hormaz Fataki as well. Hormaz, happy Friday, and surely a happy week coming in for the Indian markets at least. And today also we're managing to hold on to that green, broader end of the market doing well. No complaining again.
No complaints, and has been the case over the last week or so. And 25,600 is where the Nifty currently is. It's a new high for the Nifty Bank, and we are what 650 points away from Nifty's own record high of 26,277 of September of last year. So within 9 months, we've made lows, we've come back from those lows, and now we are heading back towards those record high levels. But it is the Nifty Bank that is the one that has seen a new high in today's session. And the broader markets, which were underperforming yesterday, are the ones that are doing better in today's trading session. The mid-cap index up almost 400 points. The small cap index too trading fairly okay for itself. So the small cap index did well yesterday, in yesterday's session as well, 0.7% higher today. So the HDB Financials IPO, that continues to see healthy subscription. The QIB portion fully subscribed just a few minutes earlier. The retail portion also now nearing that 80% mark. The overall figures too heading towards that 2 times mark now for HDB Financial, and that has had an effect on HDFC Bank as well. Mind you, the stock is trading ex-dividend in today's trading session. Made a record high yesterday, but has now managed to recover from the lows back above the mark of 2,000. But the big news of the morning was the confirmation of CNBC-TV18's news break when Akzo Nobel now that stock, now I pull up that stock as well. That stock was up 10% at one point, still holding on to gains of around 8%. And that is after it announced earlier this morning that JSW Paints is set to acquire the promoter stake in a deal worth over 9,000 crore rupees. The initial stake will be done at around 2,762 rupees a share. Remember, Parth Jindal of JSW Paints had told CNBC-TV18 at the World Economic Forum in Davos in January this year that he would give it everything he has to acquire Akzo Nobel. Listen in to what he had said.
I think there's no choice. If JSW and the ambitions we've shown that we want to be a top 3 player in whichever sector we play in, if I have to do that, then I have to give it everything that I've got for Akzo.
How will you fund it?
It's going to be a mix of the family investing, and private equity.
And that was Parth Jindal himself talking to us about the deals coming in. But Mangalam is joining in with us. And Mangalam, now that the deal is done, tell us, how has that changed the paint industry dynamics now? What are we watching out for?
Well, a couple of things. This paint industry has been extremely colorful when it comes to news flow over the last couple of years. In particular, JSW Paints, of course, having acquired Akzo Nobel India, 74% of the promoter stake being acquired at 2,700 rupees per share, which is roughly 9,000 crores on a deal size. The stock is higher because they have also made an open offer, and that open offer is close to around 3,417 rupees per share. Importantly, what this basically does to the paint industry is something that we are tracking from here on itself. You look at the paint industry, look at all the top players in the paint industry as well, and look at Akzo Nobel. Akzo Nobel is the 4th largest paint company in India, and you would know it better as the makers of Dulux paints. Remember, 35% of their revenue comes in from industrial, and more importantly, they have been increasing their presence. While their market share in premium is more than the market share in popular, they've been at around 5,700 towns, and the 2-year target has been 8,000 towns. All of this before the acquisition was announced itself. So where they go from here is an important point. And talking about the paint industry, Asian Paints, 34,000 crores in terms of top line, sits heads and shoulders above everyone else. Berger at around 11,545, the 2nd largest player. This is the place where Birlas are eyeing market share as well. Kansai, Akzo Nobel, and thereafter you have Indigo Paints. Come Birlas. In FY25, Birlas launched Birla Opus, and they reached high single-digit market share in the 4th quarter as per the company. So if you look at the paint industry and look at high single-digit market share, it implies that their run rate in the 4th quarter could have been anywhere between 900 to 1,200 crore rupees. What is their stated objective over the next 3 years? Since their entire completion, they are looking at revenue target of 10,000 crores and aim to break even as well. Birlas aren't the only conglomerates. We have JSW Group as well. X of this deal, we had JSW Paints, and Parth Jindal has said FY24 revenue in the paint business was 2,000 crores. They have an FY25 target of 3,000 crores and FY26 target of 5,000 crores. The only fly in the ointment, nearly 60% of their revenue comes in from captive sources. So organic growth is what something we'll be watching out for. The paint industry is an 80,000 crore industry, of which organized is 65,000 crores. Growth estimate 12 to 13%. And over the last 60 years, top two players have had more than 50% market share, and which is what keeps all these conglomerates excited about this opportunity. What is it that drives growth in the paint industry from here on? Not just capacity, but more importantly, distribution, brand, and at the same time, what do you have in terms of tinting machines for the dealers, and then eventually capacity? Do you have enough to produce for the market? What is it that the street is looking for as the dynamics of the industry have changed? Expansion plans of incumbents and disruptors, both. What do Asian Paints, Berger, Indigo Paints, who was also among the ones who were running in for Akzo Nobel, do? What happens to the margins of the industry? Because we've seen margins compress as competition increases. Asian Paints and Berger has said that cost of sales have increased. And finally, from an investor standpoint, valuation multiples, they have derated. Asian Paints at peak was close to around 60, 62 times, now come down to around 40, 42 times itself. So that is something we'll be tracking. What does market share look like? Morgan Stanley had written, because of competition, the top 5 players will lose up to 300 basis points in market share. And the biggest loser of that would be Asian Paints. In fact, they expect Asian Paints to go ahead and lose up to 200 basis points of market share over the next 3 years because of increasing competition. Where does all of this put JSW Paints in? You'll have to look at growth with Akzo Nobel and X group revenue, the organic group revenue that they do going forward. The second thing we'll be looking at, how much more will they have to invest in the strength of branding, capacity, as well as distribution. And finally, from a shareholder standpoint, they were talking about a JSW Paints IPO. Now, will they do the Paints IPO, or will they reverse merge JSW Paints into Akzo Nobel itself or not, is something we'll be tracking very, very closely. Because of the disruption that we've seen in the industry, we've seen that impact on a lot of people's portfolios as well. Berger and Kansai are the only two stocks which are marginally in the green over the last 12 months, but all of these stocks are down anywhere between 20 to 33% from their 52-week high. And we spoke about valuation multiples derating, right? At peak, Asian Paints was over 60, now 41 times. Berger too was 50, 55, now 41 times. We have Indigo Paints, Akzo Nobel, Kansai Nerolac, all of them between 32 to 39. So a lot happening in the paint industry, conglomerates eyeing it. So it's a colorful news, or an array of color when it comes to news in this space.
Well, lending the color to a sector that gives us colors to our homes. Mangalam, thank you for that. In fact, you'd done a very deep dive into the paint sector a couple of years earlier as well. And this one is the one that you need to watch out for after the JSW Paints consolidation. In fact, earlier we spoke to market experts of what they make of this deal, and more competition now in the paint sector. Listening to what they had to say.
Maybe this disruption, as you mentioned, is perhaps, one good indicator that, Indian consumption story is pretty much intact. Yes, there are new players entering, and, for any segment, when there are new players entering, there can be some sort of a, market share, grab kind of competitive activities which plays out, and which is pretty normal. Paint as a sector, as you mentioned earlier, I think consumption play is pretty much, the core story. We have a nice combination of whatever I say, house durable, the house paints going on, maybe infrastructure is improving. So paint is structurally a good story. Competitive intensity can decide a little bit shift of market shares or margins, profitability, etc. But that does get captured in market valuations.
It's a 15-16% discount to CMP. And this is even when your Akzo Nobel was not trading at a premium to other players. So the pricing to that extent doesn't seem to be that high. That is one. The second, in terms of the industry dynamics, I think it's going to be the most fiercely competitive scenario than we have ever seen in the paints industry, because already we are witnessing a lot of competition coming from Birla Opus, and now Akzo Nobel, which was I would say an MNC, but they actually never tried too hard to gain market share or do anything which is very extraordinary. Now with they falling into the hands of JSW Group, which is very aggressive, and on their own they have been making quite a lot of efforts. I think now it will become much more competitive in the entire paint industry.
That's the complete wrap of the turn of events of the morning with regards to JSW and Akzo Nobel and the entire paint sector as well. 7.75% higher still. Akzo Nobel still above that open offer price of 34.17. The Nifty gaining some momentum, 60 points higher now on the index, 160 higher on the Sensex as well. Take a short break. On the other side, all things commodities, Manisha Gupta. Welcome back. Time for commodities then, and all the action encapsulated by Manisha. As always, she's joining us to put the spotlight this time around on metals, Manisha.
Well, yes, and I want to put forth a point here because when you look at the month of June, and we still have a couple of days perhaps remaining, but one trend is very clear here, and that is that gold has underperformed within the precious metal as a sector and within industrial metals as a space as well. So I just wanted to quickly take you through those numbers right now. If you look at the gold prices, they've gained 1% for the month of June. But when you look at silver, we've gained by 11%. Platinum, palladium, also called as PGMs, have gained much higher. So while you have palladium trading up by nearly 20% for the month of June, platinum seems to be outperforming the precious metal sector with nearly 29% of gains just in the month of June for that matter. Now talk about the base metal prices or the industrial metals for that matter. And just let me remind you that gold has only gained 1%, but copper is gained up by 9%, aluminum is up 4.5%, and zinc prices have gained up by 3%. So we are looking at gold kind of underperforming. Couple of reasons for that. One, you've seen the money flowing into various other asset classes. As can be seen, a lot of money was pushing or pumping, getting in and out of crude oil as well. And then equity markets have done slightly better too. The other thing is the dollar index decline, and even with that, we haven't seen money come in for this one, but the other commodities where you have actual use cases kind of do better. The street also believes that a couple of rate cuts from the US Fed already are baked into the prices. So while we may not be looking at 3,500 coming back in a jiffy, but we do not see the gold prices trading below 3,100 anytime soon. So that's the kind of range that we've seen come in for the gold prices. While the US Fed is still awaited, you have seen various banks like China, India, Brazil for that matter, Swiss National Bank, Bank of England, Eurozone, all of those cut interest rates. US is yet to done that, and that is something that the gold will keep an eye on. If there is a statement that brings gold out of its comfort zone, that is when you will see the gold prices gain. Otherwise, markets feel that with everything that is happening, it's already baked in case of gold prices. It's going to be a range-bound gold, but the opportunity absolutely seems to be coming in for the other metals.
Okay, Manisha, thank you so much for that, and thank you for giving us the latest update coming in the world of commodities, keeping the spotlight on metals today. But on that note, we're going to slip into a very short break. When we return, we'll discuss market technicals with Mitesh Thakkar and also his top trading bets. Welcome back to Trading Hour on CNBC-TV18. As of now, the Nifty is at 25,600 levels. Almost near the day's highest point is what the Nifty 50 is trading at. On that note, let's shift focus to some of these individual stocks that are in focus today. And first up, we'll start with Petronet LNG. That's in focus on the back of a brokerage note coming in from ICICI Securities. They've upgraded the stock this time from a sell to a buy call. Now, they've also raised their target price. What more are the details for this? Why are they positive on the stock? We have Sonal joining in with us. Sonal, welcome back, and great to see you here again. You're shining bright as well. And so is your sector, Petronet LNG.
Oh, it is. And thank you. It's lovely to be back as well. And what better to talk about the sectors which are buzzing in trade. Petronet LNG, that is stock in focus today. There is an interesting note coming in from ICICI Securities. As you said, the stock has been upgraded to an add from a sell. There are a couple of reasons why they like the stock. They met the management and they think the prospects for the company for FY26 to FY28 are great because of three reasons. One One, LNG prices are expected to moderate. There is expansion at the Dahej terminal that will happen by first half of FY26, and the completion of the Kochi-Bengaluru pipeline that will happen in this calendar year itself. There are concerns, of course, around the return ratios from the Petchem project and also the visibility on the Gopalpur terminal. That is something that they are watching out for. However, they have revised estimates to factor in 7% EPS CAGR over the next few financial years, and on the back of that, they have upgraded the stock to an add from a sell and raised the target price to 330 from 250 earlier.
Upgrades on the stock, upgrades in life. Sonal, thank you. And welcome back as well. And since we are in the Ek Se Hamara Kya Hoga phase, tell us more about Gail as well, for a note from Jeffrey.
Oh, yes. So Gail is well in focus. You remember, Gail is always in focus whenever there are revision in tariffs. And there is one tariff which is expected to come in from the PNGRB, which is the unified tariff. A board meet is expected to come by very soon. And that is where Jeffrey says it could be a game changer for Gail. Remember, Gail had filed for 33% increase in unified tariffs to around 78 rupees per MMBTU. While Jeffries expects a 10% hike, Gail expects it to be around 20% because there has been a reduction in the capacity of the unified pipeline by 6%. So if there's a 10% tariff hike, it could increase their EBITDA by 13%. If it's 20%, their EBITDA could increase by 26%. That is for the transmission segment itself. The return on capital employed, that would improve to 10 to 12% on calculated basis from the 8% mark currently. And if this actually happens the way Gail has requested it to be, it could lead to a 34% hike in their target price as well. They maintain a buy rating on the stock, but this will be the key thing to watch out for Gail going forward.
Okay, surely keeping an eye out on Gail as well. Thank you so much for that, Sonal. But let's focus and talk about the Pharma pack. We have Torrent Pharma that is in focus. This is also on the back of a brokerage note. Ekta is joining in with us to give us more details on this one. And what is JP Morgan saying? Ekta, good morning.
Well, yes, I am looking at Torrent Pharma. You know, JP Morgan has written a report on Torrent Pharma. They've upgraded the stock to overweight with a target price of 3,800. For the India business, strong growth momentum is expected to sustain. Brazil business, improved visibility, a low base is expected to support. When it comes to the GLP-1 opportunity, the potential to capture more than the fair share in India due to leadership in cardio-metabolic care could help. They could add around 100 to 200 basis points in annual growth. Brazil may benefit post mid-2026, not in the initial generic wave. In terms of financials, it's amongst the strongest cash flow generators in the sector. It's on track to be debt-free by FY27. Valuations are reasonable according to them.
Indeed. Ekta, thank you for that. An upgrade coming in for Torrent Pharma in a sector that is still poised for some impending tariffs from the Trump administration anytime now. 33.10. Torrent Pharma hasn't done much over the last 1 month, but still doing well for itself.
Almost any time now, but every day is a new story, right? Today we know that maybe it could extend in terms of the deadline as well. So that's also a possibility. You never know what's happening there.
You never know what's happening there, of course. And as long as it keeps the sector in the pink of health, well, nothing like it. Mitesh Thakkar joins in for a quick chart check this morning. Mitesh, good morning. Welcome back. And what's your call on the index now? We're taking a bit of a pause here as of now at 25,600. Do you see after the move that we had yesterday, there are enough legs to go to 25,700, 25,800? Or do you see a bit of consolidation at these levels? And of course, your stock recommendations.
Well, I think, good morning, we can test this 25,700, 750 zone. That's where a falling gap is. If you recall the way the markets fell back in September of 24, we got a big gap down around these levels of 25,750 to about 25,620. And I think that's the range which the markets might find difficult to cross. We are hitting close to that. So if somebody has long position, these are good levels to take profits on the index. Though on the stock side, a lot of stocks are breaking out. So I expect positive momentum over there. But between this 25,650, 750 range is, I would at least want to lighten up position and then see if I get a dip to buy into it again.
Okay. And Mitesh, what are your top bets?
On the stock side, I think Asian Paints is breaking out today, big, strong volume candle as well as price action. So buy here with a stop just below levels of 2,300 and out of 2,390 can be looked at. And the other one, which I have is a buy on Apollo Hospitals with a stop below levels of 71.20 for targets of 70 to 80.
By recommendation on Asian Paints is a sector that has been in action today. Mitesh, thank you for your views on the index and for sharing your top ideas as well. Take a short break, but just before we do that, remember to tune in to the all-new CNBC TV18 Prime. We're bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at noon for the Global Reset, at 1 p.m. for the Big C, and the Global Lens at 8:30 in the evening.
Welcome back to Trading Hour on CNBC TV18. We have the mid and small cap also that is managing to do well and holding on to strong gains in today's trading session. Some of the names that I want to talk about on the back of news flow there in focus. We have Mahindra Lifespaces. They've bagged a redevelopment project today, and this is in Mulund, and the gross development value is of around 1,250 crores. Though it's come off the day's highest point, look at it. It opened up in the green, strong gains, and then that one has come off. On the other hand, we have Hitachi Energy. That's also in focus. They have bagged an order to supply 30 units of 765 kilowatt of transformers from Power Grid Corp. On the back of this, we're seeing that the stock is buzzing in trade as of now, holding on to gains of almost 3%. Power Mech is another one that's in focus as well. And this is also, they are going to be setting up some grid-connected solar powers. And this is a PPA project with, this is in Bihar, 25-year revenue is going to be of around 159 crores, smaller one. But Power Mech is managing to hold on to gains of 4%. In the last few minutes, we've seen the further spike up coming in. And 4% gain trading at the day's highest point is what Power Mech is doing. A lot of these broader end of the names are also buzzing in trade today. So when you look at the mid-cap, you have something like IGL that's buzzing. We have HPCL that's buzzing in trade, as well as Dixon Technologies, obviously, like we spoke about before, on the back of a brokerage note. But to understand what's happening on the market fundamental front, we have Aniruddha Sarkar from Quest Investment Advisors, who is joining in with us to discuss just that, his top sectoral bets, what is he watching out for. Mr. Sarkar, good morning. Thank you so much for joining in with us. What are we watching out for? This week has been really good in terms of markets, so finally seeming that maybe some bit of a valuation correction would come in. That doesn't seem to be playing out. India has been quite resilient, at least this week. Now, in terms of valuation, what are you watching out for? What are the sectors? What is your outlook in terms of the market?
Yeah, hi, good morning. So I think, as you rightly mentioned, I think, definitely India has been extremely strong if you compare it to the rest of the world. But within that, I think what is helping to keep the markets up, or I would say what is helping the stocks to do well, is the pure fact that earnings are coming back. And that has been something which has been a big concern for our markets for the last couple of months, or rather, I would say for the last 6 to 9 months. Earnings was the big, I would say, the negative surprise, which kept the markets low. And after making a high in the month of September and October, I think, we are yet to go back to the old highs, but the way the markets and the earnings are shaping up, and thankfully with the way the international macros are shaping up, I won't be surprised if, investors are in for a positive upside.
Anirudh, good morning. Thank you for joining in. Now that we are at the cusp of another earnings season in just a few days from now, what are the pockets that you are watching out for that can spring up a positive earnings surprise this time around? Because for a lot of these experts that we speak to, they mention that the earnings recovery is still a couple of quarters away. But do you believe that this quarter will see some positive surprises?
Absolutely. Like, if you see the last quarter, after almost I would say 6 months, for the first time, we saw a good amount of earnings upgrades in different companies in the last quarter. As we begin FY26 with, from next month, we will have the first quarter FY26 numbers coming in. I believe that you should see some more earnings upgrades for good companies where I would say investors should keep an eye on. Now, having said that, market is always going to reward before the actual numbers come in. And to some extent, you are seeing some of those price actions also happening in different companies. And this is partly because of the numbers which are coming. You can see the business updates or the IIP data or the macro data. Now, if you talk about sectors where I believe the biggest positive surprise can come, you have a very good indication in the CapEx numbers. Now, if you see the whole of last year, FY25, the big concern was CapEx was a big drag. Partly you can blame it to elections and partly you can blame it to the base effect of FY24. CapEx, for the private CapEx, for the first time, the private CapEx has been more than the public CapEx in FY25. And this I'm talking about in absolute numbers. In percentage terms, yes, public CapEx has outperformed the private CapEx, but in absolute terms, the private CapEx has done better than the public CapEx. Now, this is going to get translated to all these companies who are supplying to all these companies where the CapEx has been happening. So I'm very bullish on the whole industrials and CapEx piece. as a whole. Within that, power sector is one big focus area for me because government capex and private capex is almost at all-time high in this particular area. As of yesterday, if you see, there were a couple of news items also with regard to different companies supplying their products to the government agencies. I think this is something which is a multi-year play. Apart from that, I would say something which continues to do well is your aviation and hotels. Again, the other play which continues to do well is your capital market play, and that's a very big opportunity across different sectors.
And this is capital market despite it running up so much as well. You still think there's value?
Absolutely. I think, the stocks have done well partly because the opportunity size is huge. Now, the thing is, India was always an underpenetrated market when it comes to, equity as a asset class. That has changed post-COVID. We have seen those massive numbers of demat accounts, mutual fund folios, etc., which has opened. But I think if India's disposable income, household income, and per capita income has to grow, there is no way but to see more and more household money coming into the equity market. And that is where your capital market plays across asset management companies, exchanges, platforms, wealth management, broking. All these will do exceptionally well from here on also.
Right. Also, what's your thought coming in specifically on the PSU side, PSU banks? I want to understand that, right? Because we've heard a lot of people say that, maybe now this is where we could see a bit of a run up. So if you had to pick between the financials or the banking side, would it be PSU banks, private banks? What are you watching out for?
It's a very old debate keeps happening, what to buy, private or PSU banks. I would say in the last 4 or 5 years, I have been more biased towards the PSU banks because that is where the value mismatch compared to the private banks was very high. But having said that, I would say that as of today, I'm balanced between the two, wherein PSU and private both can do well. But yes, if you ask me from a valuation gap, definitely PSUs continue to look attractive even as we stand today. Private banks, I think a lot of catch-up has happened in the last 1 year, and that's where private banks have outperformed the PSU banks in the last 1 year. So from valuation perspective, PSU banks looks much better, but from a growth perspective, I think private banks might do better than the PSUs.
Private banks might do better than the PSUs. Anirudh, I was just going through one of the previous conversations that you had with us back in September of last year, just before the market had hit a record high. You mentioned a couple of names as well. One space that you had mentioned about pharma, about 6 to 7% exposure that you had back in September to the pharma sector, and you had mentioned that you would increase your exposure to this sector. With the impending news developments with regards to tariffs or a potential delay, have you increased your exposure, and if you have maintained that increase, more importantly, and what is the road ahead that you see for the pharma sector considering the news developments lined up?
Broadly, I've maintained my exposure at the current level, which you mentioned. 6 to 7% is what I continue to have. We were evaluating different names out there, but I think, we replaced a couple of names by maintaining the exposure. Now, the fact for that has been the reasons which you mentioned, that there has been a lot of the news flow around how the Indian pharma companies will get impacted with what is happening on the tariff front. But having said that, I would say that the way it looks today, I think Indian companies are in a much better place compared to their counterparts in Southeast Asia, wherein Mr. Trump wants to reduce the healthcare cost in the US and at the same time wants to decrease dependence on Southeast Asia. So that is where I would say Indian companies definitely will benefit. But yes, the roadmap is not yet clear. And I'm, as of today, betting more on the domestic companies, companies which are domestic plays in India.
Okay. What's changed in terms of your view for the IT sector, right? That time we spoke, it was IT still looked decent. Now, you seem to be a bit more underweight on the IT pack. So I'm just trying to understand why so. What is it that has changed for the IT companies?
So IT sector, I think, I have been maintaining my underweight stance for a long time. And to be honest, the confidence is not coming when you look at the numbers, when you look at the commentary, or when you look at the deal pipelines. Simple fact that when there's so much of uncertainty on the home ground for the US and the European companies, how their companies' earnings will get impacted, whether there will be a recession, there are talks of AI, impacting the jobs. In fact, if you look at the jobs data in the US, that is quite alarming. So I would say that, all this is definitely giving a lot of concerns for Indian tech companies that, where the growth will shape up moving ahead. Having said that, valuation is something which looks attractive on the IT companies, but only concern is that growth needs to pick up. Pipeline needs to look much better. Until that happens, I would remain underweight on IT.
Remain underweight on IT. Of course, they'll be the ones that will start reporting results first up. One final question from my end, Anirudh. The other one is autos, right? There have been plenty of chatter around it with regards to the tariffs here as well. Now, as a looming tariff deadline, of course, there is a bit of sluggish demand trends that you're witnessing back home as well with passenger vehicles, the entry-level cars still struggling, the two-wheelers also being neither here nor there. Where in the auto sector does your preference lie? Within the four-wheelers, the two-wheelers, the tractors, commercial vehicles? Where is your preference?
So we are betting more on the two-wheeler side and the auto ancillary side, because the auto ancillary side, it actually opens up the opportunities for export. And I think that is where India can become a large export hub, because as I again mentioned, that if dependence on Southeast Asia has to go down, you need a replacement. And India, with its large auto ecosystem, is definitely one of those players who can take that position. Having said that, in the OEMs, I'm betting on the two-wheeler space, because that is where you will see a bigger opportunity, considering the tax benefits which will go into the hands of the middle class. And this is the category which typically goes into buying of the two-wheelers. And on the auto end side, I'm betting on companies which are into the export side.
Okay. Anirudh, thank you so much for joining in with us today and giving us an understanding in terms of your individual stock sectors that you're looking at, as well as in terms of the market as well. Thank you so much for tuning in. On that note, we're actually going to slip into a very short break. After the break, we'll talk about a couple of more names that are on focus today, Tata Power as well as Dixon Tech. Why are they buzzing? What's the reason? After the short break.
investing.
Welcome back to Trading Hour on CNBC-TV18. Nifty is where it is, 25,600, about that mark. But let's shift focus and get you a CNBC-TV18 exclusive. And for that, we have Ritu Singh joining in with us. Ritu, you're picking up some details coming in on the IndusInd Bank succession. What are these details? What are we watching out for now over here?
Well, for IndusInd Bank, the big question has been who takes over as the next CEO to clean up the books, to restore confidence and steer the bank back on track. Now, the Reserve Bank of India, if you remember, had asked the bank's board to submit a list of potential candidates by the end of June. And now our sources tell us that 3 serious contenders have emerged. The first is, as widely speculated, Rajiv Anand of Axis Bank. He has about 35 years of experience in the financial services field. He's been with Axis Bank since 2009, the group rather, and on the bank's board since 2013. And in his last position as DMD, he oversaw the wholesale banking and the digital banking functions. He has a background in capital markets, mutual funds and treasury as well, and is overall seen as a very strong contender. The second is Anup Saha from Bajaj Finance. Remember, he also comes with more than 3 decades of experience, 25 in financial services, 14 years at ICICI Bank before he joined Bajaj Finance in 2017, and only very recently was he elevated to the managing director position. He's also led businesses across credit cards, mortgages, auto loans, structured finance, and so on. The third candidate, according to our sources, is Rahul Shukla of HDFC Bank. Again, he comes with more than 30 years of experience. He was with Citibank earlier and joined HDFC Bank in 2018 and oversees a corporate book. And of course, in his last position, he took over as HDFC Bank's commercial and rural banking head, but is currently on a sabbatical from the bank. Now, while all 3 are seen as contenders, our sources indicate, Rajiv Anand and Anup Saha are being looked at very keenly by the board. We also understand that while IndusInd Bank board has held informal discussions with the Reserve Bank of India about these potential candidate names, it is yet to formally submit that list to the RBI. Now, typically, RBI takes anywhere between 4 to 8 weeks, sometimes even longer, to approve the bank CEO names. But in this case, our sources suggest that the regulator may fast-track the approval simply given the extraordinary circumstances at IndusInd Bank, where, we've seen a spate of top-level exits. There is a leadership vacuum following a series of accounting lapses that came to light.
Well, along with Ritu, the street is also keeping a very close eye on the developments at IndusInd Bank. As just Ritu broke the story, the stock has now surged to the highest point of the day, 3.5% higher on that stock, building onto those gains after Ritu's news break. Ritu, thanks a lot for that update. The other one that's doing well today, slightly off the highs though, is Dixon Technologies, and that is after a bullish note coming in from Nomura. Remember, yesterday there was a bearish note from Phillip Capital. On the flip side now, Nomura has come out with a bullish note along with its highest price target as well. Upasana is here with more details on this. Upasana.
In technologies, it is clearly a story of 2 tales. Earlier this week, Phillip Capital had given a sell rating with a target price of nearly around 9,000 per share, and today Nomura has given a buy rating with the target price of as high as 21,500. Now let us see what the brokerage is saying. It believes that the EMS industry is likely to be divided amongst players, and Dixon continues to command largest share here. In terms of ODM partnerships and customer stake like Vivo and Transient, this elevates the risk of customers shifting out, and even companies' backward integration will drive customer stickiness, is what the brokerage believes. Now, Dixon has been ahead of peers in adding more customers, and this offsets the risk of weak demand from any single customer, is what they believe. Now, in the near term, Dixon's export sales have seen a meaningful uptick, and brokerage believes that this ramp up is likely to make the company's overall export revenue on track for this year. Now, Dixon's largest client, Motorola, revenue monthly run-up rate has already exceeded the past peak, and it believes with this, the volume ramp-up, it is expecting around 11 million in FY25, and it can go as high as 16 million to 18 million in FY26 and FY27. Overall, it maintains the estimates of 45 units for smartphones in FY26, and it believes that the ramp-up in mobile volumes and approval of various new partnerships is likely to drive the stock forward in the upcoming session. So it has given overall a maintained a buy rating with a target price of 21,500 on the share.
Okay, Upasana, thank you so much for that. Dixon Tech managing to hold on to gains of almost 2.3%. Let's move on to the next stock that's in focus, and that is Tata Power. And this is after it seeks electricity distribution license, I beg your pardon, in Maharashtra. Vivek is joining in with us to give us more details of this front. Vivek, good morning. What is happening here with Tata Power?
Well, this is very, very interesting. We flagged off something very similar a couple of days ago, and this was Torrent Power looking to enter a couple of key areas in Maharashtra. So last evening, Tata Power too has said that they're looking to enter the parallel electricity distribution sector in Maharashtra. Remember, some of the other players include, the Maharashtra State Discom itself, Torrent Power. So what have they done? They have applied to MERC, which is the Maharashtra Electricity Regulatory Commission, to operate parallel electricity distribution in 10 areas. So they will get a license, they will be able to go ahead and provide power. Now, what did Tata Power tell us? The total consumer base currently for Tata Power is at 12.8 million customers. This is across Mumbai, Odisha, as well as Ajmer. Now, in case they do get these 10 additional areas that they're talking about, they will be able to cross the 15 million consumer mark, making them the largest private distribution player in the country. Remember, Tata Power has a very strong track record of going ahead and improving the operations of Odisha, especially where they managed to reduce AT&C losses quite significantly. JM Financial earlier said that this now opens up a new avenue of growth as far as power companies are concerned.
Vivek, thank you for that. Just before we take that break, we'll pull up IndusInd Bank, moving further higher now, 4% higher now after Ritu's news break. So keep an eye out on IndusInd Bank. There you can see very sharp spike at the highest point of the day, 870 on the stock. Take a short break. We'll be back very soon on the other side with more on the market. Stay tuned. Welcome back. And IndusInd Bank was the big talking point. Ritu is still with us. Ritu, you mentioned about the fact that there are three names in the fray. But what is the risk of the bank missing that June 30 deadline? Is there a risk of any of these candidates getting rejected? What do we hear from that?
Well, Hormaz, we've seen past instances where such cases have happened, where the Reserve Bank of India has sent back the list of shortlisted candidates sent by bank boards for revision for newer names to be sent. But in this case, what I can tell you is that the board of IndusInd Bank has been engaged with the Reserve Bank of India officials on this very list that they are finalizing. So given the fact that the Reserve Bank of India officials are aware, of the kind of names that the bank is looking at, it is unlikely that this list, when it is finally sent to the RBI, it is yet to be sent. When it is sent to RBI, if it will get rejected completely, there are three candidates that will be sent in order of preference. The RBI, of course, will pick from one of them. But Hormaz, if there's one thing I've learned from reporting on the Reserve Bank of India for the last decade or more is this: never second guess the Reserve Bank of India. But for now, our sources indicate that the chances of this getting rejected is highly unlikely.
So never second guess the RBI. Of course, that's the bigger takeaway. Ritu, thanks a lot for that. We'll be on this story over the course of the day, and that has caused that reaction in the stock price as well. 4.5% higher now on IndusInd Bank, moving to the highest point of the day after Ritu's news break that three candidates are in the fray to be the next MD and CEO of IndusInd Bank. Remember, Nomura had recently upgraded the stock. They had also mentioned that the bank, with all the efforts that they are taking, is likely to start off FY26 on a clean slate, and this might just end up being yet another positive trigger for the stock. You take your leave on this edition of a Trading Hour. From Winnie, me and the team that put this show together, thank you so much for watching. Halftime report on the other side.
Stocks gain with mid-caps leading the charge as hopes of a trade deal with the US rise. Utilities and energy are the big gainers while realty drags.
JSW Paints will snap up Akzo Nobel 74% stake in its India business for nearly 9,000 crore rupees, make an open offer to minority shareholders at 3,114 rupees per share. The deal will make it the number 4 player in a highly competitive paint sector.
After Adani and Torrent Power, now Tata Power bids for parallel electricity distribution in Maharashtra. The expansion will see it serve a total 15 million consumers, making it the number 1 power distributor in the country. Experts, however, say it may take 5 to 7 years to get going.
BlackRock has obtained the certificate of registration from market regulator SEBI to commence stock broking business, the move that can stir things up in the fast expanding business.
CNBC-TV18 has learnt of the 3 candidates in the reckoning to lead IndusInd Bank, and these names will soon be sent to RBI, which may fast-track the approval.
Good afternoon. You're watching us here on Halftime Report. We come to you live from the CNBC-TV18 Motilal Oswal studio, and what a day this has turned out to be. 60 points on the Nifty, 155 points on the Nifty Bank. Starting July series with a bang, the broader market is doing a lot better. We have around 1,800 stocks advancing for 800 stocks which are declining. But in terms of news flow, it has been one piece after the other. The big one, Ekta notwithstanding, has been the one in the paint space, where now we have clarity. Who is the buyer for Akzo Nobel? For a lot of time, for over 5 weeks or so, there was murmur that this deal is coming. Now it has come. JSW Paints goes ahead and buys Akzo Nobel. On the back of that, Akzo Nobel is higher, but all the others are higher as well, because there is this industry relief that has come by. Okay, the deal is done. Now let's focus on growth. Asian Paints, for instance, has moved to the high point of trade. Let's see how that pans out.
Okay, well, maybe enough space for all in the market. But nonetheless, let's in fact focus on that in just a bit. But I just wanted to point out with regards to the market, week to date will give you a good picture in terms of the momentum for the market. So if you look at the Nifty on a week to date basis, that's up around 2% odd. Compare that to the mid caps, which are up around 2.88%. But just look at how the BSE small cap index has moved on a week to date basis. It's gained almost 4%. It's up around 3.77% on a week to date basis. So that gives you the real picture in terms of the kind of risk on that we're seeing for our markets. And the India VIX, which basically gives you an indication in terms of the volatility, has fallen around 8.5% this week at current reckoning. So that's a couple of stats for you, and just summing up what how the risk-on momentum has been for the markets. But like Mangalam said, the big story that we're tracking today is CNBC-TV18's news break, which is confirmed Akzo Nobel India has surged with JSW Paints set to acquire the promoter's stake in a deal which is worth nearly 9,000 crores at 2762 rupees per share. Remember, Parth Jindal had told CNBC-TV18 on the way back in January that he would give it everything he has to acquire Akzo. Listen in.
I think there's no choice. If JSW and the ambitions we've shown that we want to be a top 3 player in whichever sector we play in, if I have to do that, then I have to give it everything that I've got for Akzo.
How will you fund it?
It's going to be a mix of the family investing, and private equity.
Okay, so those are some important statements which we got all the way back in January in terms of the interest for Akzo Nobel. But let's now go across to Rachna, who's been on top of the story to give us more details. Rachna, over to you.
Right. JSW Paints has officially sealed the deal to acquire a 74.76% stake in Akzo Nobel India for 9,400 crore rupees. This is a CNBC-TV18 Newsbreak confirmed. Now, this comes at a price of 2,762 rupees per share. That's a 16% discount to the market price, as we had indicated yesterday when we reported this. Sources tell CNBC-TV18 that this deal will be funded through a 2,000 crore rupee equity from the Jindal family, backed by stake and asset sales, while the remaining 7,000 crore will come in form of debt and structured credit, including financing from global institutions. But before the deal can go through, there are a few crucial steps left, starting with a mandatory open offer. Under SEBI rules, any acquirer picking up more than 25% stake in a listed company has to make an open offer to public shareholders. In this case, JSW Paints will offer to buy up to 26% more of Akzo Nobel India at a price of 3,417 per share,
which is a significant premium to the market price. Now, post-merger, JSW Paints will have a production capacity of up to 470,000 to 520,000 KL per annum, blending JSW Paints, Vasind and Vijayanagar units with Akzo Nobel India's plants in Gwalior, Bangalore, Mohali and Hyderabad. The employee headcount is also expected to be around 3,500 people, with an estimated revenue of over 5,000 crore in 2025, well in line with its FY26 growth targets, which was the 5,000 crore. With a 9 to 10% share in decorative paints market and becoming the second largest in industrial coatings, this move makes JSW Paints the new number 4 player in India's paint landscape. A transformative step and a bold bet by Parth Jindal to build what he calls the paint company of the future.
Okay, all right. Thanks very much for that, Rachna. So that's the big story that we're tracking. And as you can see, Akzo Nobel is the one stock which has actually surged around 8% on the back of this particular piece of news. It's at around 3,460 odd rupees. Remember that its 52-week high stood at around 4,649 odd rupees. So there is some kind of, way to go when it comes to further possible gains towards the highs that we've seen, on the best levels that we've seen in the past 1 year odd for that particular stock. But separately, like we mentioned, bigger stocks such as Asian Paints currently are quite unperturbed by this. In fact, Asian Paints is currently 1.6% higher. And on a year-to-date basis, however, it's not done much. It's still about higher by around 2%. So you'd have to say it's consolidated with a little bit of a positive bias. But for today, it's reacting to the news with a little bit of positivity. And so is Berger Paints, as you can see on your screen, up around 0.7%. So unperturbed for the current existing players. But let's go across to Mangalam. He's going to break it down for us and going to tell us about how exactly the dynamics in the paint industry change, considering that now this big deal is done.
Well, there have been so many paint players. JSW Paints already had its paint business and now it's gone ahead and acquired Akzo Nobel India. So these two companies were actually already in the market, but at the same time, now they will be in the market together. So that's something that we'll be watching out for. Just to run you through the numbers, 75% of the promoter stake being bought for almost 9,000 crore rupees. After that, there will be an open offer as well, which will come in at around 3,417 rupees per share. Let's tell you a little about Akzo Nobel. You and I would know it better as the makers of Dulux Paints. It's fourth largest paint company in India, having a higher market share in the premium end as against the mass and popular end. And they have been looking to, diversify their revenue as well. 35% of their revenue comes in from industrial business. And remember, 550 crore worth business is being sold as a slump sale basis to the international parent. They are currently in 5,700 towns in India. The 2-year target that they had laid out earlier was to reach 8,000 towns. What does this do to the dynamics of the paint industry? Asian Paints stands head and shoulders above everyone, with FY25 revenue being close to around 34,000 crore rupees. Berger, a distant second with 11,545 crores, is the second place where a lot of disruptors are eyeing their share here. Kansai, Akzo Nobel and Indigo Paints are the ones that we're looking at here as well. With Birla's entering this space, which they announced that they've reached high single-digit market share in the fourth quarter, it appears that their fourth quarter run rate was close to around 900 to 1,200 crores in terms of revenue. The company's long-term target for 3 years since completion of operations is close to 10,000 crores, and they aim to break even. JSW Paints organically, ex of Akzo Nobel, did about 2,000 crores in FY24 revenue. Their FY25 target was 3,000 crores and FY26 target 5,000 crores. Remember, nearly 60% of that comes in from their intra-group revenue. So organic revenue for them will be about 40%. Where they grow this will be crucial. And how much is the headroom? The total paint industry right now is close to 80,000 crores, of which organized players are 65,000 crores. The growth estimates for the industry is a little around nominal GDP, between 12 to 13%. And market share of the top two players has been over 50% for the last 4 or 5 decades. And that's how top heavy the paint industry is, and which is what excites all these conglomerates to come in. What is it that is the key driver or strength in the paint industry? It is not as much as capacity, because the industry is well utilized when it comes to capacity. It is distribution, the brand strength, and tinting machines that you have at the dealer end is something that drives industry growth and drives growth of individual players out here as well. What we need to track is expansion plans of both incumbents and disruptors in the marketplace and in backward integration as well. We've seen Asian Paints announce a lot of backward integration plants. The second thing is, are people selling at a lower margin to gain market share? Because Asian Paints too had mentioned that cost of sales is increasing. And the third thing, from an investor standpoint, will valuation multiples for the paint sector derate from here on or not? All of that depends on what JSW Paints actually does. What JSW Paints actually does will be the impact of, what people will see on the market share as well. Morgan Stanley had recently written, because of increased competitive intensity, the top 5 players will lose about 300 basis points of market share, of which Asian Paints stands to lose further 200 basis points. Now, for JSW Paints, how much more will they have to invest in capacity, in brand building, in strength, and building distribution is something that the street will most definitely keep an eye out on, because 9,000 crores is what they're coughing up. And they are actually looking at, raising this funds via debt as well. And the second part that the street will look at is how much are they going to grow with Akzo Nobel, ex their group business, where 60% of their revenues come in from group business itself. And finally, we'll be watching out for, from a shareholder standpoint, JSW Paints was supposed to go for an IPO. Parth Jindal has said in his earlier interviews as well. But now, will they reverse merge the JSW Paints business into Akzo Nobel itself? Or will they separately list JSW Paints at some point in time via an IPO route and then club the two is something we'll get an answer to. As far as the industry dynamics are concerned, the last 1 year, these paint stocks have been fairly depressed. They've been off their 52-week highs as well. And if you look at the valuation multiples too, they've come off. At peak, Asian Paints used to trade at over 60 times, now at 45 times. Berger, over 50 times, now at 41 times. We have Indigo, Akzo Nobel and Kansai trading anywhere between 32 to 39 times as well. So how JSW Paints plans to grow with Akzo Nobel is something that the street will be eyeing. But more importantly, will it come at the cost of margins and market share for the others or not, is the big question.
Okay, all right, Mangalam. Yes, absolutely. That those points are taken going forward. Let's see how they actually use this particular acquisition. And remember, the Dulux brand, which is owned by Akzo Nobel and which is really the big brand for them, is actually a 100-year-old brand that they would be acquiring. So just gives you a sense in terms of the kind of legacy that they'll be bringing on as well. Well, we need to take a short break. We'll get you more on the markets. Once we're back, we'll focus on IndusInd Bank, as sources say the bank may get a new CEO. That story up next. Welcome back. Well, for the markets, it's steady as she goes. So the mid-cap index is up around 0.6%. We have the advanced decline ratio, which is on the positive side as well. Let's discuss the big piece of news, which is basically on the paints industry and the acquisition of Akzo Nobel by JSW Paints. We have Prakash Diwan joining in to talk a little more about that. Prakash, hi, welcome to the show. Well, if you could just give us your broader sense in terms of this acquisition, and actually what would it mean to bigger companies such as Asian Paints?
Yeah, hi, Ekta. Thanks for having me on the show. So I think this kind of starts consolidating the contours of the sector's consolidation, which was happening, which had started with a lot of greenfield entries from Birlas, from the Adanis, from the likes of Astral on the fringes. Now, what's going to happen is Akzo Nobel had expressed its intent to move out of the country quite some time back, and there was an overhang of sorts. And who would be the suitor was always a big question. But it makes sense for a player like JSW to have come in and get themselves up to scale very quickly. So, which means that the industry only gets more stronger and competitive. Till the time JSW digests this acquisition and consolidates, because they are much smaller than what Akzo Nobel is, which means it'll take some time to absorb this kind of a large acquisition. You will have, so while they blink, you probably have the likes of Asian Paints and Berger getting some advantage on market share clawback. Not that significant, but it will give them some sort of time to get back into some of the market segments which they had lost ground on. But importantly, what it does to the industry is it raises the bar, it improves quality, competitive intensity, and for JSW, it's a acquisition which is fairly large. But I think we are seeing it in the context of the fact that they have a very large distribution network through the hardware route, steel, cement, all of that. So this becomes very easy for them to do it. Remember, Akzo was in 5,000 cities or towns, but on a standalone basis. JSW has enough and more to kind of back that up. So they will scale up very rapidly, is my sense. And I wouldn't be surprised if they end up in the next couple of years being in the top 3. So, yeah, lots of markets reshuffle and good for the consumer. Hopefully, it will kind of make sure that quality keeps improving. Nobody takes it for granted that the consumer will buy what you sell. I mean, all these years, Asian Paints has had this advantage of being very dominant, and that's never very healthy for the consumption side. But so that should change dramatically after this.
A two-part question here, Prakash. On the one hand, you have Birlas, which have done roughly 2,000 crores of sales in the first year. It's easier to get revenue in the paint industry than it is to get to profitability. So at some point, they'll be looking at profitability as well. Right. And secondly, when it comes to JSW, we understand that a large part of this deal will be funded via debt. The one thing that is good in the paint industry is the listed players right now is that all their balance sheets are devoid of any serious debt here. When you have a player which comes into the business with a fair amount of debt, does that limit the elbow room to compete very fiercely?
So let me address the second point first, Manglam. That's a very valid point. It's a significant acquisition which seems like getting to be funded by overseas credit funds and all. And that means that they will have to be fairly disruptive if they really want to improve things. As I said, they'll use their distribution muscle to change things. I wouldn't be surprised if paints start getting sold at points of sale which we've never imagined, in ways that we've not imagined, channels that have not hitherto been explored. So all of that will happen. That's one. And the moment they start reaching scale, which is, let's say, between the top 2 players, as you rightly explained, it's 50% market share still resides with the top 2. So there is enough room for the Birla Opuses and the JSWs to kind of compete for being number 3 or 4 or whatever quite rapidly, which means rapid is still 2-3 years away. And they could alter the debt profile with a potential IPO. See, let's not rule out the fact that they have always evinced interest, at some point expressed interest to do an IPO. And it could kind of make sense for them to do some sort of a equity reset the cap table in a way that the debt comes down, right? So they can't live with the debt forever. They will have to pare that down. And on the first question that you had, where exactly, like Birla is, for example, we don't have the exact numbers, but I know that they are looking at 10,000 crores, which makes them very close to merger. But for breaking even, they will also need to get scale. So once a company reaches about 22,000 crores of revenue, then you start having to do with, some margin improvement, some levers start emerging. But till then, you just have to get market share. So the market share never comes with a break even very quickly. So I would believe they will also want to make profits in the next couple of years, want to start breaking even. And same is going to be the case with JSW with a slightly longer timeline. So we'll of course wait to hear the plans and all of that, but it's too early. But what it does to the sector, as you rightly explained, is consolidation with much larger players now throwing in their hat in the ring. It's no more, fringe players. It's significantly large players at work with this scale.
Okay, that point is taken. But Prakash, we have another big story and we're going to request you to stay on for your thoughts on it. Let's in fact first get Ritu in to give us the news. IndusInd Bank may get a new CEO soon. Sources tell CNBC-TV18 that there are 3 candidates in the reckoning to lead the bank. Ritu is here with the details. Ritu, over to you.
Well, yes, Ekta, for IndusInd Bank, for the last few months, the biggest question really has been who takes over as the next CEO to clean up the books, to restore confidence and steer the bank back to growth. Now, our sources indicate 3 clear contenders have emerged, and these include Rajiv Anand of Axis Bank, Anup Saha of Bajaj Finance, and Rahul Shukla of HDFC Bank. Now, Rajiv Bajaj of Axis Bank has more than 35 years of experience in the financial services space. He's been with the Axis Group since 2009 and on the banks both since 2013. And in his last position as the DMD, he oversaw wholesale and digital banking. Interestingly, he recently announced his retirement from the bank and will be exiting Axis come early August, which will make him available to join IndusInd Bank if he is selected. And our sources do say he's seen as a very strong contender. Now, Anup Saha from Bajaj Finance also comes with more than 3 decades of experience, 25 years in financial services, 14 years at Axis at ICICI Bank before he joined Bajaj Finance in 2017, where he was very recently elevated to the position of managing director. He's led, credit cards, mortgages, auto loans, structured finance, and so on. So has varied experience there as well. Rahul Shukla of HDFC Bank, again, more than 30 years of experience. He has been with Citibank before and joined HDFC Bank in 2018, where he oversaw the corporate book and then later, of course, commercial and rural banking. And currently, interestingly, he's also on sabbatical from HDFC Bank. Now, while all 3 are seen as strong contenders, our sources indicate Rajiv Anand and Anup Saha are the ones that are being looked at most keenly by the board of IndusInd Bank. Now, we also understand that while IndusInd board has held informal discussions with the Reserve Bank of India about these candidates, it has not yet formally submitted the names, even with that June 30 deadline to submit the names to the regulator looming. Now, typically, if you see, RBI takes anywhere between 4 to 8 weeks, sometimes longer, to approve a bank CEO. But in this case, our sources suggest that the regulator could fast-track the approval process, simply given the extraordinary circumstances at IndusInd Bank, which is currently seeing a leadership vacuum.
All right, we take that point. Thanks a lot for that. 3 names coming up for the ones who are leading IndusInd Bank from here on. Prakash, the stock has seen a big gash, and it's largely on account of the news that came by with regards to erroneous calculations of losses, etc. Now, last week we had Nomura upgrade the stock. Brokerages are getting slightly constructive after the big decline. They believe that a lot of the weakness is priced in. Now, with the leadership change, do you think IndusInd Bank can turn a leaf and perhaps look attractive from an investment standpoint?
So, Mangalam, without getting into specific names, since I don't have much insights into who would kind of make it to the top post, but what the bank needs is urgent repair, right? There's no doubt. Nobody will even get into a debate that the bank needs repair and very urgently. You have a bank with a very strong franchise, very good presence, brand, presence and all. But you need to make sure that the balance sheet starts getting repaired. You need leadership, possibly with somebody who has turnaround experience as well. And once that happens, then you will see the path to recovery get unfolded. But whether to buy it at this level, you would have to buy it at the time where you start seeing the repair getting activated. Now, that would mean that whoever comes in, give somebody 6 months, 9 months, see the metrics change. That's the time to buy. Till then, it'll probably be a hope trade, So I don't think there's anything negative that's yet to kind of come. I mean, there are no negative surprises for that matter, which means that all the selling, all the panic is already in the price. But the build-up would need some sort of triggers, some sort of levers which the market very clearly recognizes. So I don't think just the appointment of a CEO will make that difference, because you need a CEO to steer the ship into out of the troubled waters. But how smooth the sailing is going to be will take some time to figure out. So we'll wait for that. But definitely the repair is a great sign. There's a great relief for a lot of people who probably are stunned by that fall from 1200 to 700 or whatever.
Okay, all right. Yes, absolutely, Prakash. Thanks very much for joining in and giving us your perspective. And thanks, Ritu, for joining in with your important story coming in for IndusInd, where the stock now is up around 3% but the road ahead and the kind of recovery that one will have to see after the new CEO comes on board will be something that the street will track. But as of now, we need to take a short break, but do stay tuned. We have a lot more coming up, especially on the paint sector. Stay tuned.
Welcome back, and joining us now is Kishore Runwal. He's MD at Anmol Jewelers. Mr. Runwal, the way we've seen the month of June pan out, it is silver which seems to be outperforming gold in sense of prices. Gold is up 1%, silver is up 9% for the month of June. Has it impacted the physical demand for silver in the Indian markets?
I see gold already consolidating at these rates, and now, but seeing the silver positions as of now in the month of June, we see a very strong holding at MCX at these rates. Silver is not following between $36.45. Nearly, it is running in a range of 36.2 to 36.5. We don't see. We have not seen a fall since last 10 days. So gold is consolidated at these rates, but I sense that in coming few days or weeks, we can see one more jump in silver where it can touch nearly $38.
How is it impacting the demand in the Indian markets then?
2025 is always is been very slow in the gem and jewelry market compared to 2024. The sales have gone down in gold, but silver is doing much better. Seeing the import levels this month, last month of May, where 460 tons of silver was imported in India. So seeing those records, silver is doing better than gold, and the demand for silver in the markets are fairly good and not that bad compared to gold. But markets as of now in the jewelry sector is going very slow.
That point is well taken. Mr. Runwal, also when we look at silver, the silver ETF seem to be doing well too. But in the physical markets, yet again, is it jewelry? Is it bars and coins? Is it artifacts, statues? I mean, what is doing better?
As of now, artifact markets is down. The bullion markets are steadily down. Investments, people are just watching to invest on silver because it is at a peak. Only I see silver jewelry market doing good due to the reason that gold markets have gold rates have hit very high, and the common man is going for silver jewelry.
Oh, absolutely. Mr. Runwal, while you do deal in silver in a very large way, would you say a lot of gold guy also are going for now standalone silver showrooms? Is silver increasing its footprints in that way too?
If you see in last few years, we have seen so many corporates, big corporates entering for silver standalone stores. There are so many silver standalone stores coming due to the reason that silver's demand in India is gone up. Silver jewelry demand is gone up. Silver articles is also doing good. Due to this reason, as gold markets is now become a matter of rich people, the middle class and the common man is now going for silver. We see so many silver standalone stores coming up, and in coming 2-3 years, I see a revolution in silver industry.
Mr. Runwal, also you talked to us about on how much of import that we've seen in case of silver in the last month itself. So if you talk about 2025, the calendar year, until now, the first 4 or 5 months, what has been the total import for silver?
If you see in 4 or 5 months, 2,090 tons of imports have been done as per Metal Focus reports. But last year in 2024, in the whole year, we had imported nearly 7,600 tons of silver in last year at all. So last year was the best year for the gem and jewelry industry. This year, we are in the midway. We have roundabout touched 2,100 tons of silver approximately. So we hope that in coming as down the lane seasons are there, festival seasons are there, marriage seasons are there. I think from here we will pick up more and more imports will be coming in India in silver in coming days.
All right, Manisha. Thanks a lot for taking us through that conversation. Kishore, thank you so much for joining in with your perspective as well. Take a short break. On the other side, don't go anywhere because we are covering the big deal that took place this morning. Abhijit Roy, MD and CEO at Berger Paints, joins in to discuss the paint sector at large, specifically post this big deal. Welcome back. Big deal of today. JSW goes ahead and acquires Akzo Nobel, a deal that was in the works for the last many months and the last few weeks. Now we have Abhijit Roy, MD CEO at Berger Paints, the second largest paint company in India, joining in at a time where a lot of the conglomerates are eyeing market share in the paint industry. Abhijit, two questions. First up, thank you so much for joining in. I understand that you came in from a dental appointment. So, you know, at a time when the industry is looking to plug some of the cavities and maybe get into root canals, etc., you're perfect to tell us about how the industry is likely to, react to this news. I asked this specifically because with Birlas, not a lot of people knew how they would compete on the ground. Here, you have JSW Paints, which has been there in the past, and you have Akzo Nobel, which has also been there in the past. So you're fairly well versed with their ways of working. So in light of that, how do you view this deal, especially for the incumbents?
So, Mangalam, nothing changes much, because these two players, as you rightly said, have been there in India already. Both JSW and Akzo have been operating in this market. We are more or less aware of their strengths and weaknesses, and we know what they are doing in the marketplace. So it's just a change of hands, possibly a change, in the management style that it is operating in. So from that perspective, there might be some small changes, but overall in the industry, nothing changes much. What does happen is that there is a consolidation which is happening now. So there are now 5 players in the industry. The top 2, Asian and Berger, remains. The 3rd, 4th, and 5th position is up for grabs, and that's where the competition will be intensifying a bit. Between Birla, JSW plus Akzo and Kansai.
That you're saying that the top 2 stays intact because Birlas themselves have explicitly said that they are eyeing the 2nd position. So I'll speak about the Birlas and how they have fared so far, because it's been almost 12 months since they've been in the market. But on JSW and Akzo itself, you say nothing changes right now because you are well versed with their management style. Together, do you think they'll be a little more aggressive? And if you could give us a sense on what their position is in the market when it comes to dealers' strength in terms of tinting machine strength, and how consolidated entity like that can impact players like you?
So as I said, nothing much changes. These guys have been there for quite a long time, I think. Probably, they will have to change their tactics a little bit. I expect a little bit more aggression from them. So as you can see from the figures which you have put up there, so out of the 4,091 crores of Akzo Nobel, about 3,500 odd crores is being merged with JSW now, because the rest will remain as powder coatings with Akzo. So that, when you add up to the JSW total, it's around that 5,000 crore mark. Which is where which is why I said that in the 3rd, 4th, and 5th position there will be a little bit of a skirmish there in terms of Kansai and Birla and JSW plus Akzo now. So that's where it is. We continue to focus on our growth opportunities that we see for ourselves. Last year also, in spite of Birla, we did manage to grow our market share, including Birla. If you take that into account, we had a growth in market share. We would prefer to remain focused on our own initiatives. I see a lot of opportunities there, and we are not very worried about this change.
Okay. Mr. Roy, while the 2 players remain the same and there's a structural change in terms of the ownership, there will be synergies, and I'm sure that there will be some focus in terms of trying to gain that market share. So in that context, how do you expect the competition to probably increase, and hence margins to probably be impacted on the ground for companies such as yours? Because you have spoken about intense competition in the past couple of quarters. So do margins get crunched even further? Are you anticipating that?
No, I don't think so, because frankly speaking, these both the people have been there for long years. Akzo Nobel has been there for 70, 80 years. And the team and the products and the structure remains more or less similar. JSW has also been there for now 6, 7 years. So nothing much changes on the ground. It's just that, yes, that there is likely to be a little bit more aggression possibly on the ground. But we are used to competition. We have seen much better aggression, even coming in from Birla earlier. And we have weathered the storm, as I said, we managed to grow our market share in spite of that, So it's not something which is very worrying for us.
It is not worrying for you when it comes to the number 3, number 4, number 5 players as well. But, being in the number 2 position makes you susceptible from competition coming in not only from below you, but above you as well. Because on the one hand, you are looking to grow your market share, despite competition, etc. coming in. The leader has lost market share, and brokerages believe that they can lose further 200 basis points as well. They are deep-pocketed, they are, there for a longer time, and they are equally aggressive, if not more. There are cases open in the court right now. Birlas have accused, Asian Paints for such tactics as well. So in light of that, how do you view competition for you and margins for the industry? Because not only are disruptors looking to get market share, but the incumbent, the leader, also is eyeing that incremental market share.
Yeah, so Mangalam, we have a dual role to play, here in the movie, the Game of Thrones, which is going on now. We have, a role of an incumbent and an insurgent combined together. So we need to protect, what we have already on the ground, which we have a large number of dealers, customers, painters, which we have to protect. At the same time, since we are the number 2 brand, and we are, well known across the country, across dealers, across consumers, across painters as well. So therefore, there is a massive opportunity for us to grow share. So that's something which we are focused on. We are quite confident that we will be able to deliver on that. We have delivered last year, as you have seen, in spite of all the intense competition which was there, and that was at the highest level. We managed to grow our market share, and not only that, we managed to remain profitable or improve slightly in terms of profitability as well. So therefore, we are not, very, very worried, as to what is happening, because this change that you have seen now of JSW and Akzo is actually not a major change. It's a very minor change in terms of ownership, because both the companies and the people and the brands and the products have been in the market for quite some time.
You in the past have looked at Akzo Nobel yourself, right? What made you pass this opportunity? Was it just the price?
Yeah, primarily the valuation, which we found, not worthwhile, because that much of money or even a fraction of that, if we spend judiciously on building up, because we have a strong brand of our own, right? So to, have another brand come in and, try to build that up, it will be a confusion in the market. It is better that we strengthen our own brand, strengthen our own distribution network, strengthen our own, people strength, and that should give us, much better mileage than acquiring this particular brand.
All right. So, Mr. Roy, what we gather is that it's business as usual for Berger Paints.
That's right, and we need to carry on with our own, business objectives, which we have set out for ourselves, and we carry on. We have, this plan is already there. We have built it in that, this is going to happen, more or less it was well known.
So in that context, if it's business as usual, Mr. Roy, I have a two-part question.
Yeah.
Are you then in a position to raise prices in the market because you're not fearing competition snapping at your feet? And secondly, when you talk about market share, you've been consistently growing. You were at around 22% as of the end of FY25. Are you anticipating further growth in market share?
So for the first question, whenever it is required, yes, we will be increasing prices as and when required. As of now, the prices of raw material are benign, and I don't think there is a need for increase in prices. But, we have certain brands which are market leaders in their own rights. And in all such cases, there is a possibility of increase of prices as and when required by us. Not all brands can be, we can have price increases. There are some commodities where we have to be competitive. Vis-a-vis the leader, we have to maintain some sort of a price parity there. And so therefore, those are items where price increases anyway never happen and will not happen in the future as well. So it's a mixed basket, but there are a certain number of brands where price increases can easily happen as and when required by us. As far as the second question is concerned, the objective is to maintain and grow market share as much as possible. We have our own initiatives which we have. For example, in the urban markets, we are doing something interesting, and we expect that our presence in some of the critical urban markets like Bangalore, Mumbai, Pune, etc., will improve going forward. So this is what we are focused on. Our distribution network expansion is on stream. We are expected to add 10,000 tinting machines across the country. Last year, we had installed about 8,000. So that's a massive jump in numbers. And we expect that we will be able to attain our distribution objective as well. So combination of these two factors, some product categories like construction, chemical, waterproofing, where we are doing quite well, we expect our growth momentum will continue. Therefore, we are not very worried about this.
Right. I have a two-part question, Mr. Roy. The first part is demand, because the last 12 months, demand was very subdued. And in that, competition was intense. So that impacted margins for everyone in the industry. So has demand seen an improvement? That's part one of the question. And in light of the current environment, part two of the question is, I'm sure at some point both, the Jindals and Akzo Nobel will come together to address the press, address analysts on what their growth path is. What would you like to hear from them, and what would you, take note of very specifically when they're speaking about their expansion plans? What is it that may worry you, if at all?
So the first question, competition has always been there, Mangalam, and I don't see that changing much. We will continue to focus, as I have said repeatedly, that our objectives are very clear, and I don't see any change in our objective and the way we look at the market. As far as the second question is concerned, what is worrying or not worrying, only time will say, right? But as far as we are concerned, we see that these two companies have existed in the market. They will come. They will obviously say that we can become more aggressive because the international had some constraints, and therefore we were not very aggressive on the pricing area, and maybe we will have some increased pricing pressure brought into the market. But we are used to this, and I don't think changes are going to make much of a difference. Ultimately, distribution, brand, these two are the ones which will play a critical role as far as the decorative business is concerned. And that's where we are focused on, and that's where we think that we have our own strengths and we can continue to operate in this market easily.
How's Birla's performance been in the marketplace right now? I mean, they've been claiming high single-digit market share at the end of the fourth quarter. Has that sustained? Have they been growing by leaps and bounds?
No. So it's been now static more or less for the last 3-4 months. It is true that they had been reaching that about 6.5% to 7% market share. That's where they were at the exit place in quarter 4, and they have remained at those levels for the last 2 months as well. From market information that we have, nothing much has changed after that.
And demand is improving right now, is it? Overall for the industry?
It is at the same levels, yes. So they are doing about 300 crores per month on an average. That's where last 5 months have been in that range of 280 to 310. That's where they have been operating. Nothing much has changed beyond that. So no,
I'm talking about the overall industry demand.
After that.
I'm talking about the overall industry demand. Is it a lot better than what we saw earlier?
Overall industry demand, has improved a little bit, not significantly improved. Progressively, it is improving. From April to May, there was marginal improvement, though May last few days it got impacted because of excessive rains. June has been slightly better than April and May. So overall, we are going to have a single-digit growth, as we had, in quarter 4, slightly better, possibly, or around that point, in quarter 1 as well. And going forward, we expect that second half will be better in terms of growth rate.
Okay, and you added 550 stores in the previous fiscal. What is the capex lined out for this year?
Our main capex will be the completion of the expansion at Hindupur and starting up of the Panagar plant. So not significantly high. It's around similar levels as was there last year. And it's all from internal generation, no debts, nothing, so it's clean, absolutely.
All right, Mr. Roy, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that is Berger Paints, a very confident Berger Paints, saying that there is just a shift or a change in hands in terms of ownership at this point in time, but it is business as usual for them. And you can see that sort of reflect on the stock prices today as well. There's no real big fear which is seeped in terms of the stock performance. Asian Paints, as you can see, up around 1.8%, and Berger up around 1%. So it is Akzo which has benefited the most with this close to 9,000 crore deal. We'll take a short break, but up next, more stocks. Stay tuned. Welcome back. Well, picking up pace for the mid-cap, so up around 0.7% currently for the mid-cap index. The advanced decline ratio is holding on the positive side, so around 2,380 stocks advancing to around 1,500 stocks declining. Just want to point out that a lot of volume traction actually seen in Bajaj Hindustan. So that stock has gained around 12.5% this week. It's doing well in today's trading session. And a couple of others which have actually done well this entire week is Northern Arc. So that stock is up around 17.5%. We have Bazaar Style Retail, which is up around 17% as well. So a lot of traction in specific stocks. It's a wrap on the show, but stay tuned. Business Lunch up next.
Stocks gain with midcaps leading the charge as hopes of a trade deal with US rise. Utilities and energy are the big gainers while realty drags. JSW Paints will snap up Akzo Nobel 74% stake in its India business for a near rupees 9,000 crores and make an open offer to minority shareholders at rupees 3,417 rupees per share. The deal will make it the number 4 player in the highly competitive paint sector. After Adani and Torrent Power, now Tata Power bids for parallel electricity distribution in Maharashtra. The expansion will see it serve a total 15 million consumers, making it number 1 power distributor in the country. Experts, however, say that it may take 5 to 7 years to get going. BlackRock has obtained the certificate for registration from a market regulator, SEBI, to commence stockbroking business. The move can stir things up in the fast-expanding business. CNBC-TV18 has learnt of 3 candidates in the reckoning to lead IndusInd Bank, and these names will soon be sent to RBI, which may fast-track the approval. Hello, good afternoon. You've tuned into Business Lunch, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in. As always, a good day coming in for the D Street today. We're seeing Nifty managing to hold on to those strong levels. 25,600 is what the Nifty is at as of now. Sensex 2 is holding on to very strong gains, both of them managing to hold on to gains of 0.3%. Slight bit of a decline in the last few minutes, but still almost near the day's highest point is what the Nifty and Sensex are trading at. Mid and small cap also seeing a bit of an outperformance on the mid-cap front, right? 0.6% of gain coming in for the Nifty mid-cap. Small cap doing good. 0.8% of gain coming in for the small cap as well. A lot of broader end of the stocks are seeing moves coming in. We have a lot of news flow that's coming on the paint sector. IndusInd Bank, that's the one in focus as well. But in this broader end of the market, Himadri Specialty Chemicals and GSPL, Mahanagar Gas as well as Gujarat Gas. These are some of the names I would like to highlight, given that they've seen a very, very sharp up move coming in today's trading session as well. 5% gains almost for Mahanagar Gas and Gujarat Gas as well. But let's move on and talk about IndusInd Bank. Like I was saying, that's a stock in focus as well today. And IndusInd Bank may get a new CEO soon. Now, sources are telling CNBC-TV18 that there are 3 candidates in the reckoning to lead the bank. Ritu is joining in with us to give us details on this front. Ritu, what are the details picking up? Who are the candidates that we're watching out for now?
Well, the biggest question for the last couple of months has been who takes over as the next CEO of IndusInd Bank to clean up the books, to restore confidence and steer the bank back to growth. And our sources indicate that 3 clear contenders have emerged. These include Rajiv Anand of Axis Bank, Anup Saha of Bajaj Finance and Rahul Shukla of HDFC Bank. Now, Rajiv Anand has more than 35 years of experience. He's been with the Axis Group since 2009 and on the bank's board since 2013. And last, in his position as DMD, he oversaw wholesale and digital banking for the bank. Interestingly, he's already announced his retirement from Axis and will exit the bank in early August, which will make him available to join IndusInd Bank if he is selected. And our sources indicate he is indeed seen as a strong contender. Anup Saha, again from Bajaj Finance, 25 years of experience in financial services, more than 3 decades overall, 14 years at ICICI Bank before he joined Bajaj Finance in 2017 and was very recently elevated to the position of managing director there in the month of April. He's led businesses across credit card, mortgages, auto loans and so on. So again, comes with a varied experience. Rahul Shukla of HDFC Bank, again, more than 30 years of experience earlier with Citibank and since 2018 with HDFC Bank, where he has overseen both the corporate book and more recently commercial and rural banking as well. Interestingly, he's also on sabbatical from HDFC Bank at the moment. Now, while all 3 are seen as contenders, our sources indicate Rajiv Anand and Anup Saha are being looked at more keenly by the board. We also understand that while the board has held informal discussions with the Reserve Bank of India about these potential candidates, it is yet to formally submit the names, even with that June 30th deadline to submit these names looming large. Typically, it takes anywhere between 4 to 8 weeks for the RBI to approve names, but in this case, we understand the process may be fast-tracked.
Okay, Ritu, thank you so much for that. So surely we'll keep an eye out on IndusInd Bank and when those, the final decision actually comes in. But let's move on and talk about Akzo Nobel, because that's a CNBC-TV18 news break that's confirmed. Akzo Nobel India surges with JSW Paint setting to buy and acquire now the promoter stake in a deal which is around 9,000 crore rupees. This is at a price of around 2,662 rupees a share. Now, do not forget and remember that Parth Jindal had actually told CNBC-TV18 in January itself that he would give it everything he has to acquire Akzo Nobel. Listen in.
I think there's no choice. If JSW and the ambitions we've shown that we want to be a top 3 player in whichever sector we play in, if I have to do that, then I have to give it everything that I've got for Akzo.
How will you fund it?
It's going to be a mix of the family investing, and private equity.
Okay, on that note, let's go across to Rachna also, who's here, who's been on top of the story as well to give us further more details on this front. Rachna, good afternoon. You've been on top of this as well, and finally, it's coming today.
Right, Winnie, it has been a CNBC-TV18 news break confirmed. JSW Paints has officially sealed the deal to acquire a 74.76% stake in Akzo Nobel India for 9,400 crore rupees at 2,762 per share. That's a 16% discount to market price, as we had indicated yesterday. Sources tell CNBC-TV18 that the deal will be funded through 2,000 crore will be coming in from equity from the Jindal family, backed by stake and asset sales, while the remaining 7,000 crore rupees will come from debt and structured credit, including financing from global institutions. But before the deal can get through, there are a few crucial steps left, starting with a mandatory open offer. Under SEBI rules, any acquirer picking up more than 25% stake in a listed company has to make an open offer to public shareholders. In this case, JSW Paints will offer to buy up to 26% more of Akzo Nobel India. This will be at a price of 3,417 rupees per share. That's a significant premium to the current market price. Now, post-merger, JSW Paints will have a production capacity of 470,000 to 520,000 KL per annum, blending JSW Paints Wasind and Vijayanagar units with Akzo Nobel's plants in Gwalior, Bangalore, Mohali and Hyderabad. The employee headcount is also expected to touch around 3,500 people, with an estimated revenue of over 5,000 crore rupees this year, which will be well in line with FY26 growth target, which was 5,000 crore rupees. Now, with a 9 to 10% share in decorative paints market and becoming the second largest in industrial coatings, this move makes JSW Paints the new number 4 player in India's paint landscape. A transformative step, a bold bet by Parth Jindal to build what he calls it the paint company of the future.
Okay, Rachna, thank you so much for that. That's going to be interesting to watch out for, a new player coming in the paint industry. But on that note, we're going to actually submit a very short break, and we'll come back with more news and updates after the break. Welcome back to Business Lunch on CNBC-TV18. Now let's get some updates coming in from the US. Now, US President Donald Trump could extend the upcoming deadlines for reimposing high tariffs on imports from other countries. However, the US Commerce Secretary said that July 9th will be the deadline for trade deals or reciprocal tariffs. This statement came on a day when President Trump hinted at a trade deal with India very soon.
But we're not going to make deals with everybody. Some we're just going to send them a letter, say, thank you very much. You're going to pay 25, 35, 45%. That's the easy way to do it. And my people don't want to do it that way. They want to do some of it, but they want to make more deals than I would do. But we're having some great deals. We have one coming up, maybe with India, very big one, where we're going to open up India. In the China deal, we're starting to open up China, things that never really could have happened. And the relationship with every country has been very good.
And as we get mixed signals from Washington, India's top trade negotiator has reached the US for talks. Parikshit is joining in with us to give us details on this front of where do things stand now. Parikshit.
India and US are discussing an early harvest deal which will cover $100 to $150 billion worth of goods traded between the two nations. But there is no agreement on critical areas just yet. And India's top negotiator, Rajesh Agarwal, is visiting the United States again for talks. India and the United States are yet to come to an agreement on steel, agriculture and automobile tariffs. Sources say the US-India early harvest deal cannot and won't be a one-way street because both sides will have to win. Where are things stuck? Well, India wants an exemption from 50% duty on steel imports imposed by the United States. But America is unlikely to give a concession to India here. Differences still remain on tariffs on automobile components. Also, US wants access not just for American cars, but large, heavy-duty trucks as well. US wants more access in agriculture and dairy, but India cannot allow US dairy and meat products as American farmers use blood meal as food supplement for livestock. India is also unlikely to allow any genetically modified crops into the country. The US is likely to maintain a 10% baseline tariff on Indian exports even if a deal happens. And if that is the scenario, India would impose a 10% tariff on American goods as well. India also wants tariffs on labor-intensive products to be reduced to zero. Government sources believe that there will be at least 100 product lines where tariffs may be reduced to low single digits or even zero. United States may impose zero tariffs on imports of some labor-intensive goods from India. This may be through a fixed quota of goods to be imported at lower tariffs and anything beyond that to be subjected to higher tariffs. US and India are looking to conclude an early trade deal before the 9th of July. Indian officials have said that there will be no compromise on national interest and the country is not desperate for a trade deal. Experts have said that India should not be worried about reciprocal tariffs in case a deal is not struck before the 9th of July.
Okay, Parikshit, thank you so much for the latest update coming in there. But now let's move on. And my colleague Abhimanyu also spoke to International Solar Alliance Director General Ashish Khanna on India's role and partnership with Africa 50 for solar implementation. Listen in to this conversation.
We have set up a global solar facility out of Gift City in India, where through the Africa Solar Facility, we competitively selected Africa 50, which is co-owned by 33 governments and hence is very credible face of Africa to be the fund manager. Two, we are having a lot of nimbleness in looking at individual countries and Africa. What are the blended finance and risk mitigation instruments that they need? To give you an example, in Nigeria, the Nigeria Sovereign Investment Authority has committed to finance $150 million of their own money in an equity fund based on a first loss of 15 million. So 10% financing from ISA is galvanizing almost 30 times of project finance. That's what I think Africa is really looking for.
Force multiplication is something which ISA even earlier has been targeting, and we looked at several of the projects which already have been financed and many of them are also successfully working. More so in LDCs in places in Africa, there are several places which are solarizing for the first time, and they are the places which already lack grid connectivity. Now speaking of the road ahead, you recently held a meeting with India's new and renewable energy minister too. What were the key takeaways from that meeting as far as solarizing places in Africa and also subsequently using it as a force multiplier for the entire ecosystem?
So we had a standing committee that is chaired by Honorable Minister of New and Renewable Energy, Mr. Prahlad Joshi. The co-chair is France. And we also have vice presidents for 4 regions. There were about 10 countries. But more importantly, as you know, ISA now has 124 countries as its members, one of the largest global South-led multilateral institutions. So the big message from yesterday's standing committee was an overwhelming support on how ISA is supporting our countries and how we can accelerate. We will do so through 4 pillars that were part of our strategy. The first is, as I discussed about Africa 200 million facility, how can we be catalyst for bringing in a lot more private sector investment, multiplier? Second, a lot of these countries need our help and also India's ability to bring a lot of capacity, because these countries don't have capacity. We have 16 centers of excellence in 16 countries that are now being connected with the digital expertise of India through a global capability center. Third, we will set up some regional platforms because our ability as convener is to set platforms. We are bringing small island states together as a platform. We are bringing One Sun, One World, One Grid, the Prime Minister Modi talks about, as another platform. And then we are selectively looking at 3-4 countries in each continent to develop a detailed 5-year strategy on how to implement solar. And finally, countries are asking us how to look at technologies and what kind of technology prioritization, manufacturing should be done. So we are opening up a new vertical on technology prioritization and technology roadmap.
On that note, we're going to actually slip into a very short break. Don't go anywhere. After the break, we'll come back with more news and updates. Thanks for staying tuned into Business Lunch on CNBC-TV18. Now, as the annual Jagannathan Yatra begins today, lakhs of devotees gather at the holy town of Puri to take part in the celebration. It is one of the major Hindu festivals celebrated annually in Odisha. The Rath Yatra involves a grand procession during which the deities are carried on decorated wooden chariots which are pulled by the devotees. The government has deployed of around 10,000 personnel of Odisha Police as well as Central Armed Police Forces for the 9-day-long Rath Yatra festival. Okay, with that, we're absolutely out of time on this edition of Business Lunch on CNBC TV18. Thank you so much for tuning in. Up next, you have Midcap Radar.
Good afternoon and welcome to Midcap Radar, live from the CNBC-TV18 Motilal Oswal studio. I am Vamakshi Thoria and with me is Vivek Iyer. Well, Vivek, very good afternoon to you. There is absolutely no doubt that this is a good-looking screen. All the ingredients are in place. You know, the tensions in West Asia have de-escalated. President Trump is hinting at a trade deal with India. So that sort of explains the kind of gains that we've seen not just today but over the last couple of sessions.
Absolutely right. Good afternoon. Vamakshi looking to end the week on a very strong note, and we've started off the July F&O series on a very strong note as well. Vamakshi, we've got a few important conversations lined up today. Let's start off with the top headlines. Well, stocks gain with mid-caps leading the charge as hopes of a trade deal with the US rise. Oil and gas along with PSU gas are the big gainers while realty drags.
CNBC-TV18 learns from sources Rajiv Anand, Axis Bank, Rahul Shukla of HDFC Bank, Anup Saha of Bajaj Fin are the three candidates in the reckoning to lead IndusInd Bank, and these names will soon be sent to RBI, which may fast-track the approval.
JSW Paints will snap up Akzo Nobel's over 74% stake in its India business for nearly 9,000 crore rupees and will also make an offer to minority shareholders at 3,417 rupees per share. The deal will make it the number 4 player in the highly competitive paint sector.
Jio BlackRock has obtained the certificate of registration from market regulator SEBI to commence stockbroking business. The move can stir things up in the fast-expanding business.
Torrent Pharma gains after JP Morgan upgrades the stock to an overweight rating with a target price of ₹3,800 a share. The brokerage firm says that it expects growth momentum to continue.
Well, 25,630 thereabouts is where the Nifty is at, approximately 3% away from its all-time high of 26,277. The Nifty Bank has managed to hit an all-time high today as well, and broader indices are actually leading the charge today. When we look at the Midcap Index, last I checked, it was up almost 0.7%. It has sort of cooled off, up almost 0.5%, but still doing quite well. Most sectoral indices as well doing quite well. All of them mostly are in the green, with Nifty PSU banks leading the charge. On the flip side, Nifty Realty this whole week hasn't been doing quite well. For now, the Nifty Realty Index is also down and out in trade, but lots of individual stocks are moving around in trade, and to highlight just those, we have Hormas to take us through a special segment, Midcap Movers.
It's the perfect Friday, the perfect week to round off the broader markets, even though there have been a slight cool off from the highs. But still, it's been a fairly good week for an otherwise outperforming broader market as well. You take a look at the top gainers then in that space, and you'd see Prime Focus after a block deal that took place earlier in the day, 20% higher on that stock. Himadri Specialty also at the highest point of the day. SML Isuzu is up 10% in today's session, and Godfrey Phillips too having a very strong session, up 9% in today's trade. Some of the other movers in the broader markets today, and so it's been that kind of a day for the gas names as well, the oil and gas names, particularly the gas stocks, MGL, Gujarat Gas, GSPL, all of them trading with gains of anywhere between 5 to 6%. On the flip side, as Vamakshi just highlighted, realty is not having a very good day. In fact, it has not had a very good week in general. And look at all of these names at the lowest point of the day, 1.5 to 3% lower on these names, from Oberoi Realty to Macrotech. On the volumes front, there are names like HEG that are doing the rounds today, 3.5% higher after that brief spike that you saw. It has cooled off from those levels. There has been a substantial hike in volumes. Raymond Lifestyle and Elcon Engineering too doing well for themselves on the volumes front. And lastly, stocks that are not doing well in today's trading session, some of them are bucking the trend. At Confidence Petroleum, it just won an order, and since then it has recovered slightly from the lows. But TD Power and Timex, ever since that OFS was announced, continues to grind lower, another lower circuit. Back to you guys.
Thank you so much, Hormas, for joining in and giving us a sense of all of the stocks that are moving around as far as the broader end of the markets are concerned. Well, we can do a quick market check. The Nifty continues to hover around the 25,600 mark. What's not doing so well today is the Nifty IT Pack. The Nifty IT Pack has seen a bit of a dip, especially a name like KPIT Tech, remember, which fallen almost all days of this particular week, especially after the profit warning that the company gave. But before we slip into a short break, we'd like to remind you to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and for the Global Lens at 8:30 p.m. Welcome back to Midcap Radar. Well, we are now shifting focus to the logistics and warehousing sector. We are now joined by Vineet Agarwal, who's the MD at Transport Corporation of India. Thank you so much, Vineet, for joining us. Well, first up, we'll have a look at the macro picture. Last couple of years, what has been the growth rate as far as India's logistics industry is concerned? Next 4 to 5 years, what is it that we're envisaging? And for your own company, can you outdo the growth that the industry sees?
It's always good to be back. You see, the logistics sector typically grows at 1.5 times GDP growth. So as we've seen the last few years, GDP growth has been quite good, and hence we've seen that we've been able to, the sector has grown quite a lot as well. It is now employing more than 22 million people across, whether it is from the trucking side to warehousing to ships to railways. So it's a large sector, large services sector, which is really the backbone of the economy in many ways. The sector will continue to grow. I think there are lots of very strong tailwinds. Clearly, GDP growth is one of them, but there's also a lot of other changes that we are seeing. For example, the growth of quick commerce, the growth of certain sectors as consumption trends change, as India gets a China Plus One strategy where more manufacturing shifts to India as well. So with all of those, there are massive amount of opportunities in the logistics sector, definitively for the next decade, if not longer. As a company, we are very focused on creating an integrated multimodal logistics solutions company. And we've gone a long way ahead in doing that. See, I think the factor here, most important factor, is how are we able to reduce the logistics costs for the country as a whole. And that makes us very competitive, not just domestically, but also internationally when we are exporting. And for that, one of the main reasons would be to move to multimodal as much as possible. That is, use less trucking, but more railways or more coastal shipping and so on. So we as a company have made a strategy where we move towards multimodal a lot. And a third of our revenues from virtually zero a few years ago is now coming from multimodal logistics. We intend to strengthen this going forward, as well as ensuring that we are building all the other capabilities around it, be it warehousing, be it cold chain logistics, be it any kind of specialized logistics.
Sure, Mr. Agarwal. Good afternoon. This is Vamakshi joining in. So you mentioned that the goal of the government is to bring down logistics cost as a percentage of the GDP. So currently for India, it's somewhere around 11 to 13% of the GDP. What is the kind of gap with the other countries, and when do you think this will narrow down?
There are several factors. I think in terms of the logistics cost, as I said, one of the more important factors is how do we move from something that is very highly intensive in terms of cost, road to other modes of transport. That's one. The second is productivity improvement. I think that's an area where not just government, but even the private sector or everyone needs to do work. Today, if you send a truck to a factory, it actually sometimes is waiting for hours to be loaded or unloaded. If we see the throughput at the ports, it's improved substantially, but there's a lot of work that needs to be done if we compare to the other countries of the world. If you look at our railway loading and unloading, it's extremely slow. Even the average speed of a rail movement is about 20-ish kilometers an hour. So once we look at cost, we have to look at all the parameters, shift to multimodal, improve productivity, look at standardization. Today, if you see that trucks are not standardized or even the pallets are not standardized, that would go a big way. And last, most importantly, is digitization. So today, the World Bank comes out with a report called the LPI, Logistics Performance Index, and we are at 38 number out in the world. This number needs to go up substantially. We made substantial improvements, but we still need to a lot of work more to move up that ladder.
Mr. Vineet, today we'll keep the conversation very short. We wish you all the best for FY26. We hope to bring you on the channel once again after the Q1 results are announced. Very interesting developments coming in as far as the logistics space is concerned, and this is one particular sector we need to keep a close eye out on. But we'll now slip into a short break. We'll get you more on the markets and focus in on IndusInd Bank, as sources suggest that the bank may get a new CEO soon. Stay tuned.
Welcome back. Still tuned into Midcap Radar, and the big story that we've been tracking for you here. Three key contenders emerging to take over as the CEO of IndusInd Bank. These include Rajiv Anand, currently the DMD of Axis Bank, who's set to retire from Axis in early August. Anup Saha of Bajaj Finance, who's recently been elevated to the position of managing director there. And the third one is Rahul Shukla of HDFC Bank, currently the head of commercial and rural banking at the bank and on a sabbatical as we speak, to discuss what this really means for IndusInd Bank and how the street will really view any of these three getting appointed as the next CEO of IndusInd Bank. I have with me Abizar Divanji, expert, joining us now to discuss this of Neostrat Advisors. Abizar, always a pleasure to have you. These three names, of course, this is still source-based and the names are yet to be submitted to the RBI. What do you make, of Rajiv Anand, Rahul Shukla or Anup Saha, being considered for the position, and how the street will view this?
The one good part is, as against the earlier restructured, so to say, banks, which is, say, Yes Bank or RBL, where we had a public sector person come in. If this news were to be true, then we are clearly looking at a private sector person coming and taking over IndusInd Bank as the MD and CEO. And I think that may be a good step considering where IndusInd is, because the franchise is alive. The business model needs a lot of governance changes. And as we had said earlier, I think the time that one needs to spend on governance will be far more, and governance will take a much forefront as against growth. But I think the difference here is that the private sector person coming in, I guess, will have its advantages in the sense that there will be a better focus on business growth also.
Okay, a private sector candidate will be seen as, better for the bank. But a quick word on, what the timeline of the appointment could be. In the past, we've seen RBI take anywhere between, 4 months to even 6 months to approve bank CEO names. Say in the case of Axis Bank, it was only 2 months, so it varies. But here we understand the bank has been in discussion with RBI already on the names, although it's not submitted the list yet. Could this expedite the process given the urgency of the situation here?
I personally think it will expedite the process simply because I think that the bank's management would have been, and the board especially, would have been in touch with the RBI on a fairly regular basis given the turmoil that it went through. And if that has been the case, I think there would have been a good understanding with RBI, and RBI's process would be much easier. The other thing is that all three of them have been in the bank financial services sector, having the same regulator. So the regulator clearly is aware and has a point of view on those people's track record already. It's not that you're getting somebody from the outside. So if that's not the case, and these are all reputed organizations, if you look at it. So at the end of the day, I think RBI would have a strong point of view, and it may not take as much time.
Well, but, what is the possibility of RBI? Because we've seen this in the past. Sometimes boards do send out these lists of 3 candidates, and RBI has often sent it back for new names to be submitted. What is the possibility of that happening, given that the board has already discussed these names, at least we understand, informally with the regulator?
In my view, the names that would be submitted, I think, would in a way be bounced off RBI. So I think that the chances of rejection here seem minimal. And also, it's not in the interest of time for this bank not to have a CEO quickly. So I think the board would have been responsible enough to actually discuss it with RBI. RBI would have been responsive in terms of giving their views on the candidates. And I'm sure that when a list is submitted, it may be a mere formality.
A quick word, Abizar, before we let you go. Rajiv Anand is on his way out from Axis Bank, so that makes it easier for him. But what about Rahul Shukla, who's on a sabbatical, and especially Anup Saha, who's only just been elevated to the MD position at Bajaj? How easy or difficult will the transition be for either of them?
I think transition for each would be the same. It's a question of, they will obviously have their own times as to when they can come out. An immediately appointed MD obviously would have taken a much different view. But if you look at the other two, I think they would pretty much have the ability to join as soon as their appointments are made available. So I think that I don't think transition or even timelines will be an issue.
All right, Abizar, we leave it at that. Thank you so much for joining us here with your insights on the 3 potential candidates for the IndusInd Bank CEO position. On that note, we're going to wrap up this special edition of Midcap Radar. Your stocks will take all the action forward, so stay tuned.
Hello, good afternoon. You've tuned into Your Stocks coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in as always. Looking at the markets right now, 25,600 above that level is what the Nifty is trading at, almost near the day's highest point, slightly just off bit that day's highest point. But yes, a good day coming in for the markets. Broader end of the markets, that's also performing well, better than what the benchmark indices are doing, especially the Nifty small cap. That is also doing, holding on to gains of more than 0.8% of 0.9%. Day's highest point is what the Nifty small cap is trading at as well. So yes, a good day coming in for the market, especially the broader end, and advance decline ratio today clearly in the favor of advances versus declines. But this is a show where we solve all your stock related queries, and to do just that, we have our experts joining in with us. Ashish of Wave Strategy Advisors, as well as Parth Shah of Tracom Stock Brokers joining with us to just do that. Ashish as well as Parth, thank you so much, and good afternoon to both of you as well. Let's get started with the queries for the day. We have the first query that's coming from Himani Khandelwal, who's writing to us from New Delhi. She's holding 100 shares of HAL. This is at a price of 4,122 rupees per share. So HAL, obviously, they're making a profit on this one. And they're holding 120 shares of Route Mobile at a price of 1,097 rupees per share. They're making a loss here. Now, wants to know whether to continue to hold both these stocks or look to sell this one. Parthiv, your view coming in on HAL as well as Route Mobile. HAL, obviously, the defense play is paying out right now. And, we've seen the run-up coming in. So does it merit actually booking out your profits for HAL? And Route Mobile, what's your outlook?
Good afternoon, Vinny, Ashish, and viewers. Firstly about HAL, I think if you look at the long-term trajectory from here, and I assume that the investor is having at least a horizon of another 3 to 5 years, I think one should definitely hold on to this counter. In terms of valuations, it is at around 38 times trail multiple. But if you look at the execution track record of this company and how they've scaled up the order book, I recollect last year, I think the order book was somewhere around 1,10,000 crores. And today, as we talk, the order book is almost 1,80,000 crore. And the management did highlight in the con call that, they have order book pipeline of another 1 lakh crore in the offing. And more importantly, I think the government's focus not only to focus on domestic orders, which is what we call as B2G orders, but also focusing a lot on the export-oriented orders. And the very fact that even from the European Union, we saw they want to up their defense budget from 2% to 5%, I think brings in a lot of opportunity for companies like HAL. I think the issues related to the tech transfer, related to the engines for the LCA, I think seem to be getting resolved, and I think there shouldn't be any problem on that front. But going ahead, looking at the various other products that this company is making in the defense space, I think the future is very bright. And also, we like the fact that they are nibbling also into the aerospace vertical, which also could be a big vertical going ahead. The execution and the management so far has performed very well despite being a PSU, and one of the rare defense PSU where the working capital cycle is little comfortable. So we certainly like this counter for the long term. Route Mobile, I think we are not very upbeat. There's a lot of competitive intensity coming up, and the company has not been able to deliver good results. So I think it's an avoid from our end.
Okay, Route Mobile is an avoid, while HAL, you're positive on this one as well. So Route Mobile, you would say, is just get out of the stock, and HAL, they can continue to look at it. Ashish, your view coming in for both the stocks as well, HAL as well as Route Mobile. Route Mobile specifically, given that last 6 months, it's just seen a downward trend. Is there any hope on the technical front that now maybe a bit of an upside is possible?
Hi, afternoon to you and all the viewers. If you look at Route Mobile, I think you rightly pointed out we have just seen a downtrend, and there is no technical reversal also that we can see. If you look at the weekly chart or the monthlies, even on the short-term daily chart, the stock has been struggling. At every rise, there is a sell-off that we can clearly see. So I think it's better to be out from the stock. There is a I think it's better to be into some other companies, or to name a few IT companies, something like a Birlasoft will be much better than a Route Mobile right now, and be out of the stock. As far as HAL is concerned, we can clearly see the stock has shown a very smart move from 3,000, now trading around 4,860 levels. The overall undertone is bullish for the stock, and we have seen some kind of short-term pressure over past few days. But I think that can be just over short term, and eventually the stock should move towards the level of on the upside towards 5,300. And also we are seeing some relative outperformance coming in from these defensive names again. So it's better to be holding on to HAL. 5,300 can be the target, and on the downside, maintain a stop loss for the stock at around 4,670.
Okay, keeping an eye on those levels over there for HAL and Route Mobile. Next query for today is coming from Somen Bera, who is writing to us from Jaipur. He's holding 15 shares of Indigo Paint and at a price of 1,150 rupees per share. So right now also the stock is trading around the buy price. Wants to know whether to hold or sell. Parthiv, you know, so much has happened today in the world of paints. We've seen that consolidation going on, increase in terms of competition that's coming in from Birla Opus as well in the last year. Now, does it merit actually holding on to Indigo Paints, or maybe just move to the leaders in the paint segment? What would you say?
I think this is one sector where not only the deal that we heard today in terms of the Akzo Nobel with the JSW, the deal size being almost 8,800 crore. I think we expect more consolidation to take place in this sector. And Indigo Paints seems to be one such company because, you know, if you look at the fragmentation of this sector, now there are top 4 players being Asian Paints, Berger Paints, Birla Opus, and now JSW Paints, because JSW Paints before this acquisition were already doing a 2,000 crore top line. And we believe that likes of smaller players like Indigo Paints, who initially did well, they had a differentiated product strategy, but have been really struggling of late. So there is a possibility that such smaller players might be nibbled by, the bigger ones. So that's the only hope. But otherwise, I think looking at the industry's competitive trend, I don't see a reason why Indigo Paint should also maintain the current multiple that it is getting. So it's a difficult call, but this entire sector will face some challenges because of the current competitive intensity. So I would suggest an avoid on Indigo Paints.
Okay, avoid on Indigo Paints. That's a view coming in from Parthiv. But, Ashish, your view also would be avoid. Should the viewer look to sell right now, or what should they do?
See, if you look at the entire sector, as Parthiv also rightly pointed out, whether it being Indigo Paints, Asian Paints, everything has corrected very sharply. We can clearly see that. And having said that, both Indigo Paints and Asian Paints, both compared together, I think it's better to be with the large cap name, because if a recovery has to happen, I think the large cap will play out much before then the mid cap and the small cap paint industry can start recovering. So my suggestion would be to avoid Indigo Paints. But at the same time, Asian Paints can possibly form a double bottom kind of a scenario where the stock is quoting at the levels which we have seen near in the year 2021. It is near at those levels again, and it's trying to bounce back from there. So there is a possibility that one can start nibbling across Asian Paints at the current levels, and we can aim for around 2,600 and eventually much higher levels in this stock.
Okay. Can look at other paint companies rather than this one actually right now, given that the sector is going through so much of a change and churn. Next query for today is coming from Pavan Mandala, who's writing to us from New Delhi. He's holding 1,000 shares of Ask Automotive, and this is at he got it during the IPO, so it is at around 282 rupees per share. He's been holding it for the last couple of years since the IPO time. Wants to know whether he should sell or book out his profits, is what he's indicating, or continue to hold the stock. Parthiv, your view coming in for ASK Automotive. Should they continue to hold this now, given that they've almost doubled their money?
Yeah, I believe the company's pedigree is very strong because it is one of the largest manufacturer of brake shoe and advanced braking systems for the two-wheeler guys, and they almost have a market share of 50%. So I think they have a very good OEM share and also in terms of the replacement market. So the fundamentals of this company seem very interesting. No doubt there will be regulatory changes even hindering the two-wheeler auto ancillary players. And we believe Ask Automobile has the capability of kind of upping its ante in terms of, the regulatory hurdles that come up. So I think being the market leader and having such good relationships with the two-wheeler OEMs, and more importantly, after a very long time, we are seeing the two-wheeler space kind of doing reasonably well. No doubt there is market share shift. People like TVS Motors are taking more market share. But overall, the industry, though tepidly, but is now showing green shoots of growth. Plus, we believe that post-monsoon, I think there should be more pickup with the rural economy also picking up, which is where we believe that Ask Automobile's current valuations can be justified, and I would suggest a hold on this count.
Okay. That's a view coming in on the fundamentals. On the technicals, what's your view coming in there, Ashish? What should the viewer do?
If you look at on the technical side, I think Ask Auto has given a strong breakout above 500 levels. It has formed a very classic cup and handle kind of a pattern, given a breakout of there, sustaining there. So there is a possibility of short-term dip, but use that as an opportunity to possibly buy more of the stock. We can expect a target on the upside at around 600 levels. That's the pattern target. And on the downside, the support for the stock is around 485 levels.
Okay, keep an eye out on the support levels over there for the stock as well. But on that note, we're actually going to slip into a very short break. But remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C and Global Lens at 8:30 p.m. Welcome back to Your Stocks on CNBC TV18. We still have with us Ashish Gyal as well as Parth Shah to solve all your stock-related queries. Let's move on to the next query for today then. This is coming from Shashank, who's writing to us from Mumbai. He's holding 400 shares of KPIT Tech at a price of 1,295 rupees per share. Long-term investor. Right now, the stock is trading around his buy price, just a slight bit of a loss on that front. But should he look to hold this or look to sell this one? Parthiv, which side are you on? Are you the one who's going to be saying that, yeah, IT is going to be doing well? Or are we expecting these mid-cap ITs to start, going down further? They've not done anything exciting. So where should the viewer go, and what's your view here?
We need to be very honest as an analyst. One of the worst words that I would like to hear from a management is cautiously optimistic. Doesn't give you any direction. So, but yeah, I think coming back to the mid-cap IT space, overall, we believe that this is the space which in FY26 will outperform, whether we talk of in terms of constant currency growth, whether we talk of in terms of execution, or in terms of total contract value. And I think a lot of this was evident from the Q4 commentary from a lot of managements in these mid-cap IT companies. And talking of KPIT itself, I think we saw that it has grown at a rate of 15% year on year. Margins have held up extremely well at 21.1%. And more importantly, I think they did a $280 million worth of deal closures, which is, I think, a fantastic growth. The company is also inorganically looking to acquire companies, and the last acquisition, the CareSoft business, I think that should add a lot of value in terms of growth inorganically in FY26. So overall, I think we believe that this is the year to definitely hang on to such good quality mid-cap companies, and we believe that FY26 should be a lot better in terms of performance than FY25.
Okay. Could expect better performances there going forward. But, Ashish, does it merit then to actually add some more of KPIT Tech? What would you suggest? Or should they hold, sell? What should they be doing right now, the viewer?
See, if you look at the IT sector as a whole, if we have to look at if the sector will outperform, because whether you look at KPIT or you look at TCS or Infosys, they have underperformed. But I think the economic cycle is turning. If you look at something like Stowell's pyramid, which suggests that during the falling interest rate cycle, the first sector that starts outperforming is financials. We start seeing consumer cyclicals there, and then slowly it starts picking up, and transportation, and then IT starts picking up there. So I think there is maybe a few more weeks of delay is possible, but I think IT is now getting there where the economy will start performing, and the interest rate cycle has continued that way. So KPIT, or whether you talk about TCS, you talk about Infosys, I think should be there in the portfolio. One should start nibbling now. These will be the leaders that will emerge maybe in a quarter or two, and then people will start talking about it. So it's better to start nibbling across these stocks on dips. And KPIT, again, the levels, if I have to talk about KPIT, there is a very important support for the stock, which is placed at around 1200 levels. And on the upside, eventually the stock can move towards 1500. But as I said, the cycle has to turn, which should happen in this quarter.
Okay, if the cycle turns, start nibbling. At maybe every fall is the word coming in there. You could look at it, and once everything changes, starts becoming hunky-dory for the IT sector, we could see an up move coming in there. But let's move on to the next query for today. We have Neelam, who's writing to us from Nagpur. She's holding 56 shares of Poonawalla Fincorp. Price is 454 rupees per share. Wants to know the future prospects of the stock. Poonawalla Fincorp, Parthiv, what are you keeping an eye out on here, and what should they watch out for? Is it merit holding for the long term, or maybe just a medium term outlook?
I think a lot of expectations from this company, and always a comparison with the market leader, Bajaj Finance, which is now sitting at a 5.6 lakh crore market cap. No doubt, I think so far the journey has been pretty good ever since the Poonawalla Group has taken over Magma Fincorp, the former player. And I think if we see in terms of the AUM and outperformance, I think that has been stupendous. They've grown at the rate of 42.5% year on year at the current base. And we believe that, I think, as per the management commentary, the outlook should be very, very strong. More importantly, I think we haven't seen any major delinquencies in terms of the asset quality. And going ahead, if they can maintain that, and more importantly, with the rate cut that we have witnessed, and going ahead, I think RBI also talking about further easing, that should benefit a lot of such NBFCs where in terms of their book and asset quality, I think they have a lot of fixed rate loans, which can benefit to help them in addition of the spreads. So our senses, I think, definitely hold on to this. Next 2 to 3 years look very good for such well-run NBFCs.
Okay. And Ashish, what's your view coming in, given that the stock has seen a good run up, right, in the last 6 months, 45% approximately is what and return would come in for the stock. So then does it merit right now, continuing to hold this one?
Yes, indeed, because if you look at the weekly charts, I think this is one of the biggest weekly candle that we have seen since around April 2025. That clearly suggests that the momentum is only increasing on the upside, given that the size of the candle between the high and the low is one of the biggest. So that shows there is no slowdown as of now. The daily chart looks good. The stock has given a breakout. Continue to hold on over here. This can be the third wave that is going on the upside. We can expect a target of around 500 and possibly higher. On the downside, the support for the stock is going to be around 430 levels.
Okay, keeping an eye on those levels over there. But that was the last query for today. So Ashish as well as Parthiv, sir, thank you so much for joining in with us on the show. And viewers, thank you so much as always for sending us your stock-related queries. Remember, you can always send us your queries and email us your queries on the email address that is at the top of the screens for you all right now. But with that, we'll wind down this edition and this week's edition of Your Stock on CNBC-TV18. Thank you so much for tuning in. But don't go anywhere. You have Closing Bell up next to take you through the last hour of trade.
go beyond market headlines to understand the reasons for the day's movers and shakers and get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Kospi seeing some bit of profit booking in today's session after the recent outperformance, 0.4% lower there.
The president can simply provide these countries with a deal if they refuse to make us one by the deadline. And
JSW Paints will go ahead and acquire the entire stake of Akzo Nobel India. The promoters were looking to sell, the foreign promoters, and that exactly seems to have happened.
Let's actually start with the paint stocks. Let's look at what color they're choosing. Asian Paints is flat. Let's pull up Akzo itself. Akzo's at 32.10.
Today also we're managing to hold on to that green, broader end of the market doing well.
Rajiv Anand of Axis Bank, he has about 35 years of experience in the financial services field.
Competition will be intensifying a bit, between Birla, JSW plus Akzo and Kansai.
Approximately 3% away from its all-time high of 26,277.
Well, that was the day so far. Hello and welcome to Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. We have Ekta with us, Mangalam, and myself, Nigel, as well for the next 60 minutes or so. Hey, guys, not a bad start to the series, right? We ended the June series with a bit of a flourish, and you'd like to start a new series, with some gains, and that's precisely what we're seeing.
Yes, we are seeing that gains. Hi, Ekta. The Nifty Bank, it did very well yesterday, saw a bit of a dip today, and it recovered from there, and the broader market is doing well. That tells you that all is well with the market right now, so far.
In the pink of health.
In the pink of health, yes, Ekta, please go ahead.
Absolutely, it is the pink of health today, and we're ending the week on a positive note if we do close in the green, which is very, very likely now. It's going to be the second consecutive week that we're going to close in the green, so we've got that momentum back. We've seen that the India VIX is down around 8-odd%, 9-odd% on this on a week-to-date basis, and we've got the small caps which have rallied as well, around close to 4-odd% already this week. So that gives you a sense in terms of the kind of momentum that we've seen this week, guys.
Well, that's right, Mangalam. And the big deal as well, we're going to discuss in further detail. We'll get to that in just a bit from now. But for the time being, let's get a quick check on how do you position yourself. Mitesh Thakkar is back with us. Mitesh, early morning, you got a bit of a pullback, very, very wee bit of a pullback. That dip quickly got bought into, and the markets are back at the high point of the day. And I wanted you to tell us not just about the Nifty, but the role of Reliance Industries. Because that, in fact, is the absolute opposite of what it was doing in the previous 6 months. The last 6 months have belonged to Reliance Industries. Where is it headed from here?
So, Nigel, good afternoon. I think Reliance is something which will lead. I think the banks which have done outperformance are now getting back to their normal performance or mild underperformance, and stocks like Reliance, which have slightly underperformed. If you look at the markets 3 months back, I think those are the stocks which are catching up. So Reliance, I'm very positive upon, looking at a target in excess of around 1,600 over here. And even on the trading call side, I have a buy on Geo Finance with a stop at 316 for targets of 340. And the other one is buy on Bharat Forge, which I would recommend buying with a stop just below 1290 for targets of 1350.
Right, and since you spoke about Reliance and the conglomerates doing well today, we have the Adani Group stocks as well, which have been well bid in trade today. Adani End, for instance, is up around 3.5%. We're seeing some traction in names like Adani Ports as well, holding up with gain of about 1%. And Adani Total Gas, which is up around 6%, so is Adani Green. So the entire Adani pack is moving. Is there anything that stands out here which is tradable, Mitesh?
So I had early in the day buy on Adani Enterprises, but the one which I like very strongly post that is Adani Ports. I think, a stock which had a very strong uptrend and then came down to its medium-term average around 1340, 1350 zone has bounced back. I think as long as the stock is above levels of 1420, good chance that it will see 1500 to 1530 very soon.
Okay, well, let's in fact get to the top story that we're tracking today, or at least one of the top stories besides paints. It is IndusInd Bank, which in fact may get a new CEO soon. Sources tell CNBC-TV18 that there are 3 candidates in the reckoning to lead the bank. Ritu joins in. now with all of the details and all of the details that she's picking up from her sources. Ritu, over to you.
Well, thanks for that, Ekta. Yes, we do understand that there are three strong contenders that have emerged that are being actively considered by the board as we speak. Rajiv Anand from Axis Bank, Anup Saha from Bajaj Finance, and Rahul Shukla from HDFC Bank. Let's start with Rajiv Anand, where he's got more than 35 years of experience in financial services. He's been with the Axis Group since 2009 and on the board of the bank since 2013. And as the deputy MD, he led the wholesale and digital banking portfolio. But here's the key detail. He has announced his retirement from Axis Bank, and come early August, he's going to step down, and that will make him available to take charge at IndusInd if he is shortlisted. But our sources also point out that he is indeed a strong contender for the job. Next, Anup Saha, again, 32 years of experience, 25 in financial services, including 14 years at ICICI Bank. He's led everything from credit cards to mortgages, auto loans and structured finance. And very recently, he was elevated to the position of MD at Bajaj Finance, which is, again, a sign of trust that he commands. And finally, Rahul Shukla, 30 years of experience. He began his career at Citibank and then joined HDFC Bank in 2018, where he oversaw the corporate banking portfolio and was now heading the commercial and rural banking division. Currently, he is on sabbatical, but very much in the mix. So, all these three names are under consideration, but our sources tell us the board is looking more keenly at Rajiv Anand and Anup Saha. Now, remember, the Reserve Bank of India has asked the board to submit final names by June 30th. And while the board has held informal discussions with RBI, no names have been submitted formally just yet. Typically, it takes RBI anywhere between 4 to 8 weeks, sometimes longer, to approve the bank CEO name. But this is not your usual case. We've seen a string of top-level exits after the multiple accounting lapses and irregularities that came to light. And so our sources indicate this particular appointment could be fast-tracked.
All right, Ritu, thanks a lot for that. So this appointment could be fast-tracked is the word coming in from your sources. We heard that from Abhizar Diwanji as well in this case, because they've been speaking for a while right now. Let's get in Mehboon Irani's view on this. Mehboon, thank you for joining in. Welcome to the show. Last week we got one brokerage upgrade the stock after a big gash that we've seen on the counter. Do you think a new leader, and specifically one coming in from the private sector, could change the fortunes of IndusInd Bank, especially at a time when financials are looking attractive, and in that this has seen a big decline from the top? Do you think everything is priced in?
Well, I've tracked IndusInd Bank for the last over 25 years, and allow me to state that I've gone on record once upon a time to state that it is one of the fastest growing banks when Mr. Romesh Sopti was in charge, and he was rated as one of the best bankers by many forums at that time. Now, there are various names circulating right now on the social media as to who the next CEO will be. June 30th is the date. According to what I understand, I always believe that the bank is as good as the CEO. RBI will want somebody who can ensure regulatory compliance and have a governance structure in place. That is certain. The new CEO will have the task of building up the top management team. Now, he will start with a clean slate. And why do I say that? Most of the old satraps, the top management team, have either retired or resigned. There are few in place. Hopefully, they will resign in the next 1.5 years. So no replacement has to be done. He has to set up a new team. But what he has to do first is set up a team, set up regulatory compliance, set up the governance, put it back on his priority list, and then slowly bring the bank back to the growth path which the bank had seen under Mr. Romesh Sopti's regime. Now the question is what happens to the stock? The market, in its wisdom, is looking at the stock with renewed optimism because of the names floating around in the market, most of them with a great reputation. We will need to wait and see as to who ultimately comes in charge. Now, what about the problems of IndusInd Bank? The problems of IndusInd Bank, the report which was placed after the CEO being asked to go away, the previous CEO, Katpalia. Now, that report still has some cobwebs here and there, but there are matters which can be sorted out. There are problems in the microfinance book, but which company in the microfinance sector doesn't have problems? So those problems also are well known to the market. So market says past is past. Now let us look at the future. The bank has a solid base, mind you, built from the previous management of Mr. Romesh Sopti and his trusted lieutenants like Mr. Ramesh Ganeshan. They had built up a solid team. Now that team, most of the people have gone, but the base is strong. Can the bank come back to its growth path? Answer is possibly yes. So if the market is looking at it with optimism, with a price to book value of just around 1 or less than 1, I think it is well in order. But if you ask me, I would like to stick my neck out after seeing actually who takes charge. But one thing is certain, the RBI will insist that whoever takes charge will ensure regulatory compliance and have a governance structure in place, because that is where the bank lost a large part of its goodwill and reputation over the last few months.
Okay, all right. Well, from one particular news break to another, CNBC-TV18's news break has been confirmed. Akzo Nobel India has surged with JSW Paints set to acquire the promoter's stake in a deal which is worth nearly 9,000 crores at around 2,762 rupees per share. Remember that Parth Jindal had in fact told CNBC-TV18 in January that he would give it everything he has to acquire Akzo. Listen in to that exclusive conversation.
I think there's no choice. If JSW and the ambitions we've shown that we want to be a top 3 player in whichever sector we play in, if I have to do that, then I have to give it everything that I've got for Akzo.
How will you fund it?
It's going to be a mix of the family investing, and private equity.
All right, so that's Parth Jindal, declaring his ambitions all the way in January. But let's go across to Rachna now, who's been on top of this story, and she's here to give us the details on it. Rachna.
Right, it is a CNBC-TV18 news break confirmed, and as you said, we started reporting it back in January, following it up all the way till now, when JSW Paints has officially decided to seal this deal and to acquire 74.76% stake in Akzo Nobel India for 9,400 crore rupees at a 2,762 rupees per share. That's a 16% discount to market price, as we had indicated yesterday. Now, sources tell CNBC-TV18 that the deal would be funded through 2,000 crore rupees coming in from equity that the Jindal family has pledged to stake in asset sales, while the remaining 7,000 crore rupees would come in form of debt and structured credit, including financing from global institutions. But before the deal can go through, there are a few crucial steps left, starting with a mandatory open offer under SEBI rules. Any acquirer picking up stake more than 25% in a listed company has to make an open offer to the public shareholders. In this case, JSW Paints will offer to buy 26% more of Akzo Nobel India at 3,417 rupees per share, a significant premium to current market price. Now, post-merger, JSW Paints will have a production capacity between 4,70,000 and 5,20,000 KL per annum, blending JSW Paints' Vasind and Vijayanagar units with Akzo Nobel's plants in Gwalior, Bangalore, Mohali and Hyderabad. The employee headcount is also expected to be around 3,500 people, with an estimated revenue of over 5,000 crore rupees. This is well in line with its FY26 growth targets. With a 9 to 10% share in decorative paints market and becoming the second largest in industrial coatings, this move will make JSW Paints the new number 4 player in India's paint landscape. So a transformative step, but a bold bet by Parth Jindal to build what he calls the paint company of the future.
Okay, all right. Thanks a lot for that, Rachna, and congratulations on that solid story as well that you put out first here on CNBC-TV18. Well, Mangalam, you want to weigh in terms of quick analysis on it?
Well, the deal has happened, but I'm looking at all the other paint companies. Typically, what happens is when a conglomerate gets in, you see, and that's what we've seen in the likes of all the other players as well. When Birla's announced, we saw a big gash in the paint stocks, etc. What is it that is happening right now in the paint stocks? Why are they buzzing as against, earlier? The first one is that the deal is done without any major price war amongst players. Multiple times there have been reports that, Berger was in the fray. At some point, Asian Paints looked at it. Then you had, even something like a Pidilite or an Indigo looking at it as well. But all of them have chosen to pass on due to valuations. And despite that, JSW Steel has gotten at a 16% discount to the previous close price, which tells you that there was no major bidding war. Secondly, competitive intensity. Now, that everyone is familiar with. Why? Because it's not a new player. JSW Paints has been around, Akzo Nobel has been around, so they know the strategies. And at the same time, even if they had to amp their strategies up a little bit, these companies have learned how to navigate through a competitive period, with Birla Opus coming in the last 4 quarters as well. The third part, when the demand environment is improving, the incremental share or sales is increasing, anyone eating into incremental market share does not worry the incumbents as much as against, earlier when Birlas came in at a time when demand was slowing down. So the incremental share went to Birlas at the cost of others. So in this case, if the industry is likely to grow, FMCG companies have called out an improvement in demand environment. We heard Berger Paints today as well. We'll play those bites shortly. They're saying that industry demand has improved in June. So on the one hand, everyone's navigated through competition. There hasn't been a major price war. Thirdly, demand is improving. The fourth most important factor is crude. It's below $68 per barrel. Geopolitical tensions have eased. So you have enough elbow room on your margin front as well to go ahead and compete even if the industry is seeing competition. But above all of that, price. Once the Birlas entered the fray, all the paint stocks were at a record high. Now from 52-week high, we've seen a big cut. Asian Paints is down about a third. Berger Paints, which has done an outperformance, is still down about 10% from its 52-week high. Kansai, Nerolac, Indigo, Akzo Nobel, all of them down anywhere between 28 to 30%. And the valuations have come off as well. So this is the reason why, despite this deal being announced, we haven't seen all the other paint companies or all investors looking to sell other paint companies, because they believe that this is something that they've been able to tame before, and now it's all in the price.
Well, that's right, Mangalam. It appears it's a win-win-win scenario, because good for JSW because they're expanding scope. Akzo wanted to get out, so they seem to have got a fairly okay deal. And Asian Paints is high by 2.5%, telling you that they don't believe there's going to be any kind of big threat because it's already, players that are in there. But Mangalam mentioned that, we have...
Just another word on Asian Paints as well. The stock has been an underperformer. The other thing was the supply overhang. Big 5% equity that Reliance had to sell. That is out of the way as well. So that is another positive. The only thing we'll have to watch out for from here, how aggressive will the JSW group be in the market? Because, for them, Rachna had pointed out that 2,000 crore is what they will put in terms of their own money. The rest will be structured debt. In the paint industry, everyone has a very strong balance sheet. So if they are entering the paint industry with a balance sheet debt of close to 7,000 odd crores, including the debt that they have on their books already, then will they have enough elbow room to go ahead and muscle through a price war or no? Something we'll watch out for.
But in fact, we had that interesting conversation with Berger Paints. We spoke to Abhijit Roy, and he said that it's business as usual. But let's listen in to what he had to say on decoding this entire deal and what it means for the paint industry. Listen in.
Changes much, because these two players, as you rightly said, have been there in India already. Both JSW and Akzo have been operating in this market. We are more or less aware of their strengths and weaknesses, and we know what they are doing in the marketplace. So it's just a change of hands, possibly a change, in the management style that it is operating in. So from that perspective, there might be some small changes, but overall in the industry, nothing changes much. What does happen is that, there is a consolidation which is happening now. So there are now, 5 players in the industry. The top 2, Asian and Berger, remains. The 3rd, 4th and 5th position is up for grabs. And that's where the competition will be intensifying a bit, between Birla, JSW plus Akzo and Kansai.
Maybe this disruption, as you mentioned, is perhaps, one good indicator that, Indian consumption story is pretty much intact. Yes, there are new players entering, and, for any segment, when there are new players entering, there can be some sort of a, market share, grab kind of competitive activities which plays out and which is pretty normal. Paint as a sector, as you mentioned earlier, I think consumption play is pretty much, the core story. We have a nice combination of whatever I say, house durable, the house paints going on, maybe infrastructure is improving. So paint is structurally a good story. Competitive intensity can decide a little bit shift of market shares or margins, profitability, etc. But that does get captured in market valuations.
It's going to get very competitive. We recently, and Jindal is an aggressive group. May not be great news for Asian Paints from a competitive intensity point of view, but overall from a sector perspective, it shows you that the prospects are pretty bright. So I think it will create more competitive intensity. Good for consumers. May not be that great news for all paint players in general.
Right, good for consumers, may not be as good for paint players. Well, the street doesn't seem to believe so. We are seeing some shares of the paint companies being bid up. Let's bring this back to Mehrbun. Mehrbun, you spoke about IndusInd Bank. I'm sure you've been tracking a lot of these paint companies as well for a while. There has been disruption. There is now more disruption in terms of existing players consolidating. Do you think it's a good time to buy some of the paint companies, or you will still wait until the dust settles here?
No, I think my answer remains the same for the last 7 years at least. On your channel, whenever I come, I mention that they're great companies, no doubt about it. Be it Asian Paints, be it Berger, be it Kansai, be it Akzo Nobel, great companies. Having said that, the fact remains that I've also stated that if you're asking me from an investment angle, the answer is clear-cut no. If I have my brother working in that company, I will say my brother is working in Asian Paints or Kansai. That's a different issue. On the stock price angle, again, the answer is clear-cut no. Look at the growth that these companies are attaining. The incremental demand is coming. I'm not saying no, but the capacity has also gone up, and so has the competition intensity. Now, in the midst of all this, I think I heard you stating that the stock prices have come off nearly 20-30%. That's a positive, no doubt about it. But at the end of it all, even today, the valuations are expensive. There were times when I've seen stocks in this sector quoting at 60 and 70 P. Now, if one starts imagining that stocks will go back to that P, I think one should go and fly a kite. Even at the present valuation, despite the fall in price, I don't think it's too much worthy to go and invest in these stocks. They're great companies again, but not worthy of investment. The competition is too severe. Oil prices come off sharply. Margins may improve. Is that reason enough for a lag up in the stock price? Maybe yes. So there could be a small rally because the stocks have corrected enough. So I'm not saying one should go ahead and sell off in a hurry, but to put in incremental money right now and expect anything more than a 5 to 10% rally is something which I don't think will happen.
Okay, well, yes, absolutely. One of the reasons possibly why these paint stocks have seen a fillip is because crude prices have declined for the first time, largest decline at least in the last 2 years on a weekly basis. That's what it's set for. But nonetheless, Mehrbun, let's move, or rather let's stay in the same realm and talk about what you do like in the entire FMCG space. Anything else in terms of a pocket that you would probably look at?
I would say that the entire FMCG space has come to a level where, you remember the time when the budget was presented, more money was put in the hands of the consumer, and the way the market gave a thumbs up to most of these FMCG stocks, thinking that demand will pick up. And now everything is petered out. The stocks have come to levels where you feel nice to buy them, own them, and feel that, okay, I will not lose money from the present levels. I think that is where the FMCG stocks are. And with hopefully a good monsoon around, rural demand picking up, I think quite a few of these FMCG stocks may end up seeing a higher price than seeing a lower price maybe 3 or 4 months down the line. That is the only way I can possibly talk of this entire sector right now.
Okay, all right, Mehrbun, always good to hear your thoughts. Thanks a lot for joining in and filling us in with all of those details. Well, for the time being, before we go to that break, just take a look at all these crude sensitives. They're on fire. OMCs, HPCL is now at the high point of the day. Big move out there. One of the factors that are helping the paint companies as well is the lower crude oil prices. And that's why you have a lot of these players. So for ONGC, it's actually a negative. For, the OMCs, pull them up. HPCL, BPCL, IOC, all of them are doing quite well. Paint companies and FMCG companies as well doing quite well. So good going on that front. Crude oil prices cooling off, good for the economy, good for the markets as well. Well, we'll slip into a short break. On the other side, Sanjay Parekh is waiting for us to give us his take on how does he see the market shape.
Welcome back. Well, steady day for the markets. 25,630 is currently where the Nifty is at. We've got a good advanced decline ratio on our hands as well. That is the HDB Financials IPO update. So the subscription for day 3 is on your screens. But nonetheless, let's get talking about the markets. We have Sanjay Parekh, founder and CIO of Soham Asset Managers, who's joining in now. Sanjay, hi, welcome to the show. Well, we seem to have got our momentum back this week. Do you think that we've, shrugged off the geopolitical concerns and now we're probably going to see a new leg of an upside for the Nifty? And if so, what are the targets?
Yeah, I mean, one thing is, of course, the risk has reduced globally, but, valuations are not cheap. So as the market rises, it gets tough for us because we are value seekers. Our strategy is growth at reasonable price, and now there is growth, but not at reasonable price. So we need to dig hard and look for ideas. There are ideas, but we really have to dig hard. On markets, on a top-down on Nifty, if you go by consensus earnings, even on 27 at 1300 to 1320, we're not cheap at around 19 times. So we need to be cognizant of that and, certainly be stock specific. But our point is that we need to have much higher margin of safety, be it the market or the stocks.
All right. With the market, you said that you got to dig hard, but there are some ideas. Can you throw some light on where these ideas are, and if you can take some names specifically, some sectors, narrow it down for our viewers?
Yeah, so I'll let you. We just discussed in our team that there will be ideas even larger cap and middle and small cap space, and we just have to dig them hard. So, last 2 months back we bought Pharma in the EMS space. Earlier, Polycap was also at a good price. We used to own InterArc, and we recently even increased that further. Or a pump company recently, we just got listed. Oswal Pump we added. So there are ideas, and these are all reasonable valuation, high growth, high ROC, high ROE, which works well for us, and reasonable on valuation. So it's just that, as I said, there are opportunities, not enough, but one will have to dig hard and look for them.
Hi Sanjay, good afternoon, good to see you in. Not going to talk about metals today, but what about the paint industry? Mangalam has been analyzing all through the day the big deal that's been announced. A smaller player got bigger because they've taken over Akzo Nobel, and then we have the JSW Group parentage as well. How do you see things shape up out there? Today you have a big deal that's announced, and it's not just the one that's part of the deal. The entire sector is higher. It's been a big underperforming sector, by the way. But would you look at getting into any of them?
Yeah, so Nigel, certainly you all have covered it very well today. So I don't know how much value I can add, but I'll just tell you how we think. So competition is going to remain intense, So you have Grasim as a player, and we own that. It is not going to sit with the market share it has today. It's a huge, if you take the capacity share, it's pretty large. So I think that intense competition will continue. This is one good consolidation. And the overall demand is yet to recover meaningfully. You got 1 month doing better, but as you can see, you take any parameters, still the slowdown is persistent. So I think the implied growth in Asian Paints has now come off quite well. So earlier, and we look at DCF for such companies, and in such companies, the DCF implied growth was coming at 17-18% long term, while they've not done in the last few years. Now it's come off quite well. So at the point, we certainly are on a watch. We don't own it, but we certainly will positively look if, the leader Asian Paints right now, we can look at adding at a price. But we're not at it yet, as yet.
Okay. All right. Well, Sanjay, the other bit of news which was that IndusInd Bank could probably get a new CEO. What's your take? Do you think that there's a long road to recovery there, but it could start with a change in the management?
It will be a According to me, it is a very, very big positive. First, all the three candidates are very good. Be it governance, their own pedigree, the track record, where they work. So it's going to be very big positive according to me. Secondly, I don't think further cleanup is required. At least I have that view. We own a bit. So if you take the book value, coming to the back to the book value, last 25, we ended at around 820 rupees. I could be off a little bit. Even if it takes a slow recovery, this year, let's say they end at 870, 880, and then the new person who comes in gets holds of the grip of the whole bank and gets back to growth. And then we're talking of book value at 970, 980, which will have maybe ROEs of 12, but could look better in 28. Now, that is where the re-rating can happen because it's the fifth largest bank and it will instill a lot of confidence to shareholders, employees, but also the deposit holders. So I think it's a very big positive. RBI has been very, very supportive, of course, on the backstage. And once the approval comes, I'm sure the worst is behind for IndusInd Bank.
Sanjay, you spoke about, entering Syrma SGS, you having looked at Oswal pumps as well, perhaps entering that too. And looking at Asian Paints right now, as you believe that, valuations have become a little more attractive than what they were earlier. Yeah. Where have you sold or lightened your positions?
Yeah, so, we have a very strict price value equation that we have. So we have from each of our companies, the value that we have for 27. And at times price have moved up quite sharply. So even in cases like we've discussed today, we would have trimmed our exposure, not Oswal, but in Syrma also where our weight was very high. So in certain cases, we do trim our exposure, but our core holding remains. So that is what we're doing that, in one of the real estate exposure we have again, which we like. So we want to have a core holding, but you can always trim a bit because that's important because when you have bad times, you do get a time to look and increase our exposure and volatility is quite high. So, as I said, we have a strict discipline that if the price far exceeds our assessment of value, we certainly will act either completely selling out or at least trimming a bit. And that's what we've done in a lot of stocks.
Any defense stocks that have trimmed a little bit? We have some news flashing on the screen. Mazagon Dock, they have approved the acquisition of Colombo Dockyard PLC for approximately 452 crores. Talking about trimming down, time to trim or defense, or you want to go on the offense on the defense stocks?
We missed it. We missed the defense rally directly. Of course, if you take a part of Larsen and Toubro, it's a very small part. So that's how we own it, but otherwise, direct exposure to defense, we missed it.
All right. Thanks a lot, Sanjay, for joining in, filling us in with all of those details. Wishing you a good Friday evening, solid weekend ahead as well, and we catch up soon. Well, that piece of news actually on Mazagon Dock has excited the stock. It's now moved to the high point of the day. Off late, any kind of positive news with sort of, shipyards, defense, stocks have just been flying away. And that's what's happened yet again. Well, time to slip in a short break. On the other side, Nimish is waiting for us. He'll tell us what he's picking up in D-Straight Chatter. We'll also get the technical calls from our experts. Welcome back. Markets in a good place. Starting off the week with a 90-point gain on the Nifty. So that's looking good. The Nifty Bank as well. Now it's catching up. It's up close to 230 points. In fact, the Nifty Bank is outbeating what the Nifty is doing in today's trading session. A couple of stocks on the frontline index itself. Pull up Nestle as well as Sun Pharma. Both of them were not participating earlier. Now they seem to be getting their act together. Both of them at the high point of the day. But it's that time of the show where we go to D Street Charter. Nimesh joins us to tell us what is he picking up. Nimesh, yesterday it was an expiry-related factor, so a good close to the series. Started off a new one, that too on a positive note. Tell us, what are you picking up?
Absolutely strong day for the market. Strong day for the markets. And again, the broader market seems to be outperforming. There's a lot of momentum in the broader markets as well. And again, the sense is while the flows are mixed with a positive bias, there is a bit of momentum back in the PSU basket. So the entire PSU names are buzzing. And within that, there has been a feedback for the last couple of days that there is institutional buying in the OMC stocks. So that's clearly showing up the kind of move you're seeing in HPBP and IOC. But today, I understand there is a bit of follow-up buying from larger HNIs as well into the OMC names today. So that explains a big move in the likes of HPCL. As I said, the momentum clearly seems to be with the broader market names. And also, Nigel, the other feedback is that come July 1st, the supply of paper will stop because of the trading window getting closed. And post that, there is a hope and a feedback that maybe you will see further momentum in the broader market because the focus will shift to the secondary market stocks. So that's the sense, and that explains for the last couple of days the broader markets, the mid-cap, the micro-cap stocks are relatively outperforming. So that's the overall sense. But clearly, the flow seems to be with the PSUs, and the momentum is clearly there after the big breakout that we've seen on the Nifty and the Bank Nifty.
Okay, all right, Nimesh. Yes, absolutely. Good momentum coming in for the markets. Well, we do now have Mitesh Thakkar who joins in to tell you.
No, I think let's go to Nimesh actually first because he would like to give us some interesting
stocks.
bits on the stocks.
Sure. Nimesh, go ahead. My apologies.
No problem. So the first stock on my list is 361 VAM. That's been consolidating with a positive bias of late, but I understand a very large long-only fund has been an active buyer in 361 of late. So that's the first stock on my list. The second stock is GMR Power. That's been buzzing in trade, good volumes as well. There is a large block, 1 crore plus shares got changed hands in today's block deal. I understand some large influential HNI investors bought in today's block deal. So maybe if there is a disclosure, that could be an interesting thing to track in GMR Power. The third name is Lloyd Enterprises. Again, a small stock within that Lloyd group, but that's been buzzing in trade today, up 10%. Volumes has also picked up as well. And in Lloyd Enterprises, there is a sense of some corporate development happening very soon. So that's the reason why that's buzzing in trade today. And the last one is IDBI Bank. I spoke about the PSU basket doing good. IDBI Bank stands out because of very strong buy flow. So again, looks like some large HNI investors are positioning again in IDBI Bank for a potential deal. So that's the reason why even IDBI Bank is buzzing in trade today.
All right. So those are a couple of stocks that Nimesh has gotten us. Now let's go across to Mitesh. Mitesh, what should one buy today for a reverse trade on Monday?
Yeah, I think the prior stocks are doing well. MRF has had a rally. Balkrishna is just trying to catch up. So Balkrishna Industries is a BTST. Keep a stop at about 24.45 for a 24.85 kind of a target to begin with, and then maybe even higher levels can be tested. And the other stock which I like, which is on the sell side, is CG Power, STBT, with a stop at 676 for targets of 616.
All right. Mitesh, just a word on Page Industries. It's been a big mover this week. There was a brokerage initiation that happened as well. They were hoping on the outerwear business of the company doing a lot better, them opening more exclusive brand outlets, etc. as well. But just from a chart check standpoint, it's a 50,000 rupee stock now. It's crossed that 50,000 rupee mark on an absolute basis. Page Industries seen a big move. A large part of that coming in just the last 10 minutes or so.
That's right. One, it's breaking into all-time highs. We also had a trading call, I think, yesterday on this one. A very smooth pattern, what chartists will call the cup and handle pattern, giving you a target of around 55,000 plus. So if somebody's bought it, hold it. In case you get a decline or pull back to about 48,500, 600 zone, that's your entry.
Okay, all right. We do have Petronet LNG, which is in focus after brokerage ICICI Securities has upgraded the stock from sell to buy and has raised the target price to 330. Sonal joins in to give us more details on this. Sonal, over to you.
Petronet LNG, that is stock in focus today. There is an interesting note coming in from ICICI Securities. As you said, the stock has been upgraded to an add from a sell. There are a couple of reasons why they like the stock. They met the management and they think the prospects for the company for FY26 to FY28 are great because of three reasons. One, LNG prices are expected to moderate. There is expansion at their Dahej terminal that will happen by first half of FY26, and the completion of the Kochi-Bengaluru pipeline that will happen in this calendar year itself. There are concerns, of course, around the return ratios from the Petchem project and also the visibility on the Gopalpur terminal. That is something that they are watching out for. However, they have revised estimates to factor in 7% EPS CAGR over the next few financial years, and on the back of that, they have upgraded the stock to an add from a sell and raised the target price to 330 from 250 earlier.
All right, that's about Petronet LNG. But Sonal, Gail also in focus after a note coming in from Jefferies. What is it that they're saying?
So Gail is well in focus. You remember, Gail is always in focus whenever there are revision in tariffs. And there is one tariff which is expected to come in from the PNGRB, which is the unified tariff. A board meet is expected to come by very soon. And that is where Jeffrey says it could be a game changer for Gail. Remember, Gail had filed for 33% increase in unified tariffs to around 78 rupees per MMBTU. While Jeffries expects a 10% hike, Gail expects it to be around 20% because there has been a reduction in the capacity of the unified pipeline by 6%. So if there's a 10% tariff hike, it could increase their EBITDA by 13%. If it's 20%, their EBITDA could increase by 26%. That is for the transmission segment itself. The return on capital employed, that would improve to 10 to 12% on calculated basis from the 8% mark currently. And if this actually happens the way Gail has requested it to be, it could lead to a 34% hike in their target price as well. They maintain a buy rating on the stock, but this will be the key thing to watch out for Gail going forward.
Well, thanks a lot for that, Sonal. Let's focus on Dixon Technologies. That one is higher in today's trading session. A couple of brokerages have written on the positive aspects post the recent correction, Nomura as well as Equirus. Upasana joins us to fill us in with some details from the Nomura note. Upasana, take it away.
Well, certainly it's a story of two tales when it comes to Dixon Technologies. Mind you, earlier this week, Phillip Capital has given a sell rating on the stock with a target price as low as 9,000 per share. But Nomura this morning has maintained its buy call with a target price of nearly about 21,500 per share. Now, the brokerage says that the mobile EMS industry is likely to be divided amongst players, but Dixon continues to command the largest share amongst these. Now, when it comes to in terms of client addition, Dixon has been ahead of peers in terms of adding more customers. This offsets the risk of weak demand from any single customer. In the near term, Dixon's export sales have seen a meaningful pickup, and on the back of this, it expects the export ramp-ups also to be on track for this year. Dixon's Motorola client, which is the largest client, their monthly revenue run rate has also seen a pickup in the past few months is what they are highlighting, and it expects the Motorola volumes to ramp up from 11 million in FY25 to 16 in FY26 and as high as 18 million in FY27. Overall, it maintains estimates of 45 million units in smartphones, excluding Vivo in FY26, and 64 million in FY27. And to sum up this, it believes that the ramp-up in volumes and also company's announcement on its new partnership with various clients can be the share price catalyst going forward. Hence, it is given a buy rating with a target price of 21,409 per share.
All right, take that point to Upasana. I know that's about Dixon Tech. It's off the highs right now, still sitting with gains. Just keep an eye on Bharti Hexacom. It's a big mover. It's 10% higher right now. It's done well, but not as well as today in this entire week. It's been flattish for the week, but up 10% right now. Bharti Hexacom is the stock that we're looking at. And giving the company on the way up, a bunch of stocks are spiking right now, actually. We, looked at Page Industries, but look at TBO Tech, Suzlon's moved to the high point of trade. Hyundai Motor itself is higher. So there is a fresh wave of buying in a lot of these names, which are doing well. One of which is Torrent Pharma as well. There's a note coming in from JP Morgan, Ekta.
Yes, absolutely. Well, they've upgraded the stock to overweight with a target price of 3,800. According to them, the India business is strong. The growth momentum is expected to sustain there. The Brazil business, there's improved visibility and a low base to support. Now, when it comes to the GLP-1 opportunity, According to them, the potential to capture more than the fair share in India lies with Torrent due to the leadership that they have in the cardio-metabolic care segment. It could add around 100 to 200 basis points to annual growth, and Brazil may benefit post the mid-2026 after the initial generic wave is done in Brazil. Financials, according to them, amongst the strongest cash flow generators in the sector, and they are on track to be debt-free by FY27. Valuations, according to them, are also reasonable. So that's on Torrent, stock up around 4%.
Okay, all right. Well, let's welcome our next guest. We have Hemang Jani, who joins us on the show. Hemang, good afternoon. Good to see you, Ben. Just a few minutes, and then we'll be off for the weekend. But let's get some analysis going. Mangalam just spotted a couple of stocks. Bharti Hexacom, I think, was one name that he was talking about that spiked up. Any view on this name?
Yeah, good afternoon, Nigel. Thanks for having me. So Bharti Hexacom, I think, as a mid-cap play, we do like that. I think because of the way they have really expanded their, geographies across, the network. And the fact that the ARPU also has seen about, 16 to 18% kind of an increase. So, despite the previous 2 quarters not being so good, there is a sense that because of the geographical expansion and a better ARPU, there is going to be a decent earning growth for this year. So we do like Bharti Hexacom as a mid-cap, company, and we have about 17-18% kind of an upside from current price point.
Do you track TBO Tech by any chance? It's a recent listing. It's into optimizing travel solutions for a lot of these players. I'm not sure if you track this or not, but that's another stock which is doing extremely well. Have you seen it?
No, Mangalam, not looked at that one.
Okay. Right. Well, Hemang, wanted to quiz you on Narayana Health. Just look at the way that stock has moved. It's up around 9% today as well. It's up 78% year to date. It seems to be firing on all cylinders. Give us a sense in terms of whether you would approach it, positively from current levels. Is it a buy?
Absolutely, Ekta. I think while the pharma sector was not doing well, healthcare as a space has done relatively better, and Narayan Healthcare is actually the best performing stock within that particular pack. I think primarily because of the fact that, you have seen that the company has expanded into newer geographies. Also, the operating performance has been relatively better than some of the other ones. So I do think that, if somebody is looking at, 18-20% kind of earnings growth for this year, Narayan would still give you a decent upside. And apart from that, we do like Max Healthcare, which again reported a reasonably good set of numbers. And, Apollo Hospital, definitely the performance was good, but I think the valuations are on a much, higher side. So Max Health and Narayan are the two, companies that we prefer within the healthcare space.
Right, Hemang, I think there's another smaller name, Uptown, that you track, and they're going to be considering a scheme of arrangement, I think, in the next week itself. It's one of those stocks that's moving on very, very large volumes. Any view on that name?
Nigel, there is a some sort of an arrangement wherein the company will be merging the West Realty Private Limited, 25 West, and once that is done, there is going to be a significant increase in their overall the realization, by about 7,500 to 8,000, because that particular project is in Bandra near Mount Mary, and the realization there is on a much higher side. And the total area could be around 6 lakh square feet, which can be expanded to about 8 lakh. So almost about 8,000 crore kind of additional revenue can be achieved once this particular arrangement is done. So which is why we are seeing action in Uptown, and we think that there is a case for a 25-30% kind of uptick in the stock even from current price point.
Interesting. Actually, from the last year's high, it's still sharply lower. But as Hemang is saying, he believes there is good upside from year on as well. One of those stocks that initially, had a lot of promise and then lost its way a little bit. But Hemang says maybe they're getting their act together as well.
Nigel, I'm just looking at the paint stocks once again because we've been discussing this through the day right now, and now they've seen another fresh wave of buying. So look at Asian Paints that's moved to the high point of trade, and Berger as well has moved higher. They said that they are not worried about this new development in the industry, and we listed out factors as well which could do well for the paint companies. The fact that demand environment is looking a lot better, they're now better equipped at handling competition. At the same time, valuations are a lot more compelling even as crude prices are lower. So these stocks, all of them flying away in trade today. With that, I think we'll step into a short break. As we do that, some good news for our viewers. India's business news leader now just a click away. So if you've missed any of the coverage that we've done on all the big news pieces today, you can get it on the CNBC TV18 app. You can get instant access to breaking news, in-depth article, all the updates coming in from the financial world at your fingertips. You can download the CNBC TV18 app from either the Apple Store or the Google Play Store, or just scan the QR code, which is there for you on the screen.
Welcome back. Well, a lot of stocks which are buzzing around. We still have with us Hemang Jani to talk about a lot of the stocks towards the close of trade. Well, Hemang, just wanted your thoughts on a couple of these banking stocks. You know, Punjab and Sindh is showing a good uptake. It's up around 7.5% at this point. On a week-to-date basis, also, it's not done too badly. How would you approach it?
Some of the smaller banks, can do well given the fact that you're seeing some kind of a stabilization in the spreads now that the the rate cut is behind us. But our sense is that, some of the larger private sector banks are better placed. If somebody is looking at not ultra large cap, but, something like a federal bank, definitely we think is, much better compared to going in for a smaller PSU banks or, very small banks, because whenever you see some sort of volatility in the interest rates or there is a bit of a slowdown, these banks can go through much larger de-rating. So more comfortable with the larger names like Federal Bank at this point.
Okay, more comfortable with the larger names like Federal Bank at this point. We did touch upon Torrent Pharma. That stock has seen an upgrade. Its target price, according to JP Morgan, is 3,800. How would you approach it?
I think some of these stocks have gone through a bit of softness for an extended period of time, partly because of the tariff concerns, partly because the US business was not really showing much of a traction. But now there is a sense that you will see, slew of product launches. Coupled with that, the possible impact of tariff may not be that bad. So I do think that Torrent Pharma, Aurobindo, which also has a significant, contribution of business coming from US, should do well because the stocks have corrected their quarterly numbers and the guidance also continues to remain good. So we are quite positive on that space.
Okay, all right. Any views in terms of what earnings season could look like? Starts July 1st is on Tuesday. What's your sense in terms of what the first quarter could look like?
So early days, I think the previews are still not over, Ekta, but it's not going to be materially different from the previous quarter. I think, particularly for banks, it will be a bit soft quarter because, you will have a small impact of the, spreads which will come under pressure. But overall, we think that the aggregate earnings growth we had last quarter was about 4 to 5%. And this quarter, again, would be something very similar. But a quarter after that, when you have a better impact of the better liquidity, lower interest rates, flows which are there. So probably we will have one more quarter where we will see a slightly better earnings picture.
Okay, all right, Himang. Well, we're going to let you go on that note. Thanks very much for joining in and giving us all of that perspective for today's day of trade. Well, overall, it turned out to be a session which, was positive for us. And the momentum has, in fact, continued for the past couple of days for us. So we have the Nifty, which is up around 86 odd points. We have the Midcap Index, which is up around 176 odd points. The Bank Nifty, which is gained around 0.3%. The Small Cap Index also has done well. The story really is not only about today, it's about the entire week because we had the entire Israel-Iran situation really ease off. We had crude prices which declined this week. So that really played out in terms of the Nifty and the Sensex and that relief rally that we saw for our markets. So on a week-to-date basis, that's probably what's more important to see. We had the small cap index outperformed entirely. So almost around a 4% gain for the small cap index. We had the Nifty, which was up around 2% on a week-to-date basis. It's the second consecutive week for the Nifty in terms of a positive closing. And the mid-cap index up around 2.4%. The advanced decline ratio positive for today. But overall, we also had the India VIX on a week-to-date basis, which declined significantly, giving you a sense that the market seems to be back into the buying zone and is more confident about the lack of volatility and maybe a little more stability for the markets. In terms of specific stocks, let's talk about today specifically. We had IndusInd Bank, which was the top gain on the Nifty on the possibility of a new CEO. We had Asian Paints, which in fact ended at the high point of the day despite consolidation taking place in the industry. Apollo Hospitals was up around 3% odd. Shree Cement, Ultratech Cement, all of these stocks were up anywhere between 2 to 3% odd. On the downside, we had stocks such as LTI, Mindtree, Wipro, a couple of these which were a bit sluggish. Remember that we did have news from Accenture this week, which probably soured a little bit of sentiment. Tata Consumer was down around 2% odd. Dr. Reddy's also lost lost out a little bit. For the broader markets, like I mentioned, good day, Punjab Sind, Bajaj Hindustan, GSK Pharma, a couple of the stocks on the gaining side, and Berger Paints as well from the entire paint industry, along with obviously Akzo Nobel. And on the downside, we had a couple of stocks such as Oberoi Realty, KC International, Hoodco, which declined a little bit. But on that note, it's a wrap on Closing Bell, but Editors Roundtable up next. Stay tuned.
Well, the market ends with gains for the second straight week over positive global cues as Israel and Iran announce a ceasefire. That continues to hold as well. Well, the Sensex and the Nifty were up close to 2% apiece this week, while the Nifty Bank continues to set all-time highs. Broader markets as well have outperformed. The Nifty small cap index rose close to 4% this week. Hello and welcome to a brand new edition of Editors Roundtable. I'm Nigel, and with me the editors, Nimesh as well as Mangalam. And we have Gautam Dugar as well of Motilal Oswal, who joins us in the studio today. Hi, gentlemen. All boys club.
All boys club.
All boys club today. And
a couple of them are teetotalers. So, barring you, I guess, so we can't even talk about or celebrate
We can talk about everything, like Gautam said as well, right? You can talk about whatever you want.
Yeah.
But that's all.
but good mood, right? Good mood. I mean, we are in great mood, obviously, because it's the end of the week.
Good momentum.
Good momentum. Markets are feeling good, Gautam. What kind of feedback are you getting? You throw bad news, and that's the perfect indication to allocate money. I think if we miss some of these bad news, then you'll wonder what to do. But otherwise, all dips are getting bought into.
Yeah, absolutely, Nigel. I mean, look, so much was thrown at this market. Geopolitics, crude, 78, 80. Every alternate day, you're getting some news on the global front. Some war or other is happening. Earnings were also, after a long time, we have seen a good earnings in fourth quarter. Very good quality of earnings we have seen. Spread, depth, absolute quantum of earnings were great. But market, as they say, always climb the wall of worry. And that is what is in demonstration in front of you in the last 15, 20 days. I mean, if you had told me a week back when this war started that after a week we will hit 25,600 and we'll be just 4 or 5% away from the all-time highs, I don't think anyone would have believed. So I think this market is giving you indication that a lot of things on the underlying basis are improving. Macro is great. Macro has been great for last 7-8 months. You look at the growth, you look at the inflation, currency has come back, your forex reserves are at all-time high, and RBI has reduced the inflation projections for the year. Right? On top of that, your twin deficits are under control. Very rarely I have seen such a strong macro backdrop for India in the last 10-15 years. On top of that, what was missing was earnings for last year, and now that earnings is coming back. So market is feeling good, I think, because next 2 years, if we see 12-15% earnings growth, then the room for wealth creation from here also is tremendous.
But Gautam, you rightly put out the points on the India macro, and they're looking very strong. But look at all markets globally, right? The US S&P is back to its near all-time high. The Israel market is an all-time high. So is India. So are the other markets as well. But at the same time, the gold is again at a record high. Normally, we've not seen gold going up, crude going up, equity going up, bundles going up. So from that perspective, what is that the markets is missing out from a global perspective? The gold is higher. Crude, of course, has fallen this week because of the whatever geopolitical news. But largely, how are you mapping up the global stuff?
See, look, I'm not an expert on gold. All I know is that central banks have been buying a lot of gold in the last 4-5 years. In the last 3 years, gold has had a tremendous run. And if you look at the movement of gold prices over the last 40-50 years, gold goes through this spurt of huge moments in 2-3 years, then lies flat for 3-4 years. We've seen gold doing nothing for 5 years between 2012 to 2017, even in rupee terms, despite the import duties going up, and dollar prices were down 20-25%. So don't be surprised if in the next few years you don't get much returns from the gold. I'm not predicting it. I don't understand gold much. I just take mark to market whatever the commodity prices are. But to your other point, very rarely you would have seen, maybe first time, that the 10-year yield difference between US and India is at its lowest in last 20 years. What does that tell you? That tells you that macroeconomic fundamentals of India are very strong and robust and resilient. And the predictability of those macroeconomic fundamentals is at its best right now. 4% inflation, when was the last time you saw projections like that? I mean, we have forgotten 10 years back, WPI used to be in 10-12%.
Yes.
CPI was 8-9%.
What you rightly pointed out, the predictability of macros, the earnings and everything is what giving a lot of confidence to the investors.
It's giving the premium as well. So the word that I use to describe the way this market has gone, and coincidentally, is the English word called juggernaut, which was derived from Jagannath Rath Yatra, because the meaning of Juggernaut means a force that continues to move on.
Propel it.
And propel it, and that's exactly what the Rath Yatra is as well. So that's the kind of market that we're currently in. If gold prices are supposed to stay stable for the next 4 or 5 years, that'll be great news for consumers, because they've been pushing off their purchases because of higher gold prices. And in turn, some of these gold companies as well, say Titan and all these players.
Absolutely. Look at it two ways. Gold prices, the Indians hold 24 to 25,000 tons of gold in their households. The kind of massive wealth effect it creates, and then the kind of tailwinds it creates for household consumption is something which is under-researched and under-debated, in my view, because we have rarely discussed the total wealth which is sitting in the household balance sheets in the form of gold. Because we don't know. Even this 25,000 tons estimates are very random right now. There is no precise estimate about it. Second, as Mangalam pointed out, gold prices going up in a steady manner is the best possible scenario for jewelry companies. Elevated volatility in gold prices is something which is not very conducive for jewelry companies, because then demand takes a hit. People postpone their purchases. What we have seen in the last 2 years is massive increase in gold prices, which has dampened the demand to an extent. And like with any commodity, the price impact is much higher on the underlying earnings than the volume impact. Whether you take metals, whether you take cigarettes, whether you take steel, whether you take gold. In commodity-driven, P&Ls, and gold is a commodity end of the day, price impact creates a very disproportionate impact on underlying EPS rather than volume impact. So 1% price increase may increase your EPS by 4 to 5% because it's a pass-through for most of these companies. They charge, making charges the percentage of underlying gold prices. But look at the same thing from a lens of 5 to 10 years. Every year you consume 800 tons of gold roughly. 550, 600 tons get consumed in wedding demand and rest is all adornment and gifting and all. So the demographics that we are sitting on in India, youth demography, weddings are going to happen for next 10, 20 years. And it's an $80 billion industry, out of which only 40% is organized yet. So whoever has a steady balance sheet and good brand, I'm not talking about Titan, it's obviously the benchmark player, but other non-Titan jewelry companies also have a very flourishing future in my view.
Okay, all right. Well, let's do a quick recap first of what went on during the week, and then in fact we'll continue with the show. Well, it was a good week actually for the bulls. The Nifty went home with good gains. The question is, how soon do we get to those fresh all-time highs? Because the Nifty Bank is making fresh all-time highs almost on a day-to-day basis. July as well traditionally has been a good series for the Nifty. So we ended the June series on a high. And July series, 90% of the last 10 years, we've gone home with gains, which is good. And on the Nifty Bank, 70% of the last 10 years, we've gone home with gains. So the bulls will say, well, we've got this covered. All-time highs is what we can see, which is just around 2.5% away for the Nifty. The good news is a lot of these large cap names, Reliance Industries, HDFC Bank, they went through a period of underperformance. They seem to be getting their form back and in style. Remember, these stocks have bounced back big time in the last 6 months or so, and they are leading the way. The Nifty IT index, we have the NASDAQ that's at all-time highs. The Nifty as well is close to all-time highs, but the index that's furthest away from all-time highs is the IT index. That's 15% away. So a bit of catch-up, if that plays out, that'll be the idea, because you have, the opening batsmen that are doing well, the one down as well, if it supports, then the markets will even go higher. And the macro tailwind is that crude oil prices have cooled off. Good for paint stocks. We have a big paint deal that was announced out there. Mangalam will tell us about that a little bit more. OMCs are seeing a lot of delivery-based buying, because now you have state elections that are a few months away. Crude oil prices have come in lower, and also valuations are fairly attractive. So those stocks are on the radar. Two big cues to track. One is what's going to happen on tariffs. The 90-day cool-off period ends on July 8th. Hopefully, President Trump doesn't have a negative surprise, and he's seen what happens in the past, so hopefully he doesn't go down that road. And the second factor is earnings. So that's going to be important to track. And Nimesh, on a day-to-day basis, has been telling us so much of supply that's coming in there.
That's getting over.
Now that is getting over.
Yeah.
So can we see the broader markets outperform even more from here on? Because that supply overhang, everyone's talking about 26,000 crores SIPs and the likes. You're having $1 billion being sold every day. And if this gets out of the system, maybe in fact the broader markets as well will feel good. So good times for the markets. But Mangalam, you track a lot of sporting events, the markets, films, everything. But one disappointment this week was, what was
the
that one?
India loss against England. I mean,
we were optimistic, but anyway.
I think, the young brigade will take it forward. They learn. And unfortunately, Bumrah is not playing the second game. That's what reports are suggesting. Really? So let's see how that happens as well. But whether Bumrah plays or not, the game is the capital market game itself. The news that we got on Friday, that Reliance has gone ahead, Geo Financial actually gone ahead and gotten a brokerage license as well. Do you think that is going to disrupt the other listed capital market players? Could this be a Geo moment for a lot of the brokers, etc.?
So I have a vested interest, obviously.
No, I understand.
Ample disclosures in place. I think, broking industry is already well disrupted. In the last 5-6 years, the kind of disruption you have seen from the discount broking players, I don't think anyone is afraid of whoever is coming or not coming, right? Look at the positives, 5 years back, exact 5 years back, when COVID just began in March 2020, we had 4 crore or 5 crore demat accounts. Today, as we sit, there are 20 crore demat accounts. Our in-house view is that in the next 3 to 5 years, you will have 30 crore demat accounts. So equity penetration is just about beginning. You look at mutual fund AUM, it is still 1/3 of the bank deposits. And that after 10, 15, 12 years of a continuous increase. I'll give you a data point. 12 years back, when I joined my current organization, August 2012, rather 13 years back, the total equity AUM of mutual fund industry of India was 2 lakh crores. Wow. Today it is 36 lakh crores. Yeah. And today there are at least 8 to 9 mutual fund houses who are individually managing more than 2 lakh crores. In fact, there are schemes which are running into 80-90,000 crores now.
One scheme which is having an AUM of 1 lakh crores.
Yeah. So the kind of opportunity that we are sitting in, this industry can absorb much more number of players. And like I was discussing with Nimesh before the show, I mean, it's not just broking. I mean, the whole capital market ecosystem, the AMCs, the exchanges, the brokers, and then there are so many intermediaries. So the kind of money that can be made in that space over the next 5 to 10 years, in fact, as a house, we've been very bullish. We cover the maximum number of all listed stock in the capital market space.
Which is why the question was directed to you.
Yeah, we put out a report in December 24. So we think there is a lot of room for wealth creation there. In a traditional BFSI segment, historically, we've always discussed banks. Then 5-6 years back, NBFC started becoming more relevant. Then 3-4 years back, when a lot of insurance companies got listed, we started discussing insurance. Today, I think that moment is for the capital market players. And the sizes will become big. A lot of capital market-oriented theme funds will also be launched in this industry in the next 3 to 5 years.
Gautam, we'll discuss the capital market theme in details. But, first, the big story of the week was the big M&A that got announced in the paint sector. Mangalam, no better than you to explain what it means for JSW and what it actually means for the paint industry as well.
We're speaking about the disruption in the capital market space and whether there is space for everyone here or not. There is definitely disruption in the paints industry that took place, and whether there is space for everyone else or not is something that we're discussing. A 9,000 crore deal that has happened, JSW Paints has gone ahead and acquired Akzo Nobel. So I'll just, first up, tell you the industry, what the players are doing and what the prognosis for the industry is as well. So let's start with, JSW Paints acquiring Akzo Nobel at close to around 2,700 rupees per share for the promoter stake. 3,417 rupees per share is what they've allowed for an open offer as well. But on Akzo Nobel, they're the 4th largest paint company in India. They're the makers of Dulux paints, and nearly 35% of their revenue comes in from decorative business as well. They have a high market share in the premium end of segment. Whereas JSW Paints, if you look at it, they've been in the market for over 6 years. FY24 is when they crossed that 2,000 crore revenue mark. FY25, they had a target of 3,000 crores, and FY26, 5,000 crores. All of this organically. Remember, 60% of their revenue comes in from intergroup business, so that's something we'll have to talk. If you look at the paint industry, the top 2 players have over 50% market share. Asian Paints last year did over 34,000 crores in terms of revenue. Berger, 11,500 crores. Kansai, 7,800 crores. Akzo Nobel stands in here. Add another 2,000 crores of JSW Paints, it becomes a 6,000 crore player on the whole. The paint industry worth nearly 80,000 crores right now. 65,000 crores is organized, expected to grow anywhere between 12 to 13%, with the market share of top 2 players being over 50%, and that's what the conglomerates are eyeing. What is it that helps in, the business to grow? Birla Opus launched last year itself. They have high single-digit market cap and market share rather, and 900 to 1,200 crore in terms of quarterly run rate. Can they continue this business or not? They have a stated target of 10,000 crores in terms of revenue and EBITDA break-even by year 3 of complete operations. What is it that the incumbents will need to do? Focus on distribution, brand, tinting machines, and capacity. Capacity, the least of them all. First 3 is most important. What everyone will be looking at, how the incumbents and disruptors expand, whether there would be margin contraction in the industry or not, and eventually valuation multiples. Are we likely to see another derating once this disruption comes by or not? All of that depends on what Akzo Nobel and JSW together do. We'll be tracking growth for JSW Paints along with Akzo Nobel, ex their own group, revenues. Secondly, how much more will they invest in capacity, branding and distribution? And thirdly, from a listed company standpoint, will they list JSW Paints business via reverse merger, or will there be an IPO for JSW Paints itself or not? Paint stocks have seen a correction of almost 30-35% from the peak. Asian Paints at some point was trading over 60 times, now at 45 times. Berger Paints 40 times. So there has been one leg of valuation multiple derating that has taken place. Will there be more or not? And that exactly is the question to Gautam. Gautam, the demand environment is improving. We're also seeing some sort of improvement when it comes to cost tailwinds. The companies have gone ahead and seen one round of competition. JSW and Akzo have been around, so it's not that competition is any old right now, any new for them. Do you think paint companies are better off now than what they were, say, about a year and a half ago?
Yeah, so they're better off than what they were a year and a half ago. Obviously, as you pointed out, valuation multiples have also derated, but they're not cheap by any means of imagination. Even today, after 5 years of massive underperformance, they're still trading at 40-45 times. And, when you have 2-3 big players entering an industry, we have seen this example in multiple other industries, that even if your business continues to do well, market tends to become a bit more cautious on the visibility of those returns, on the visibility of those margins.
So the PE gets contracted.
Yeah, so PE contraction happens. It's already underway. In the last 5 years, if you see, Asian Paints PE has contracted from 70 to somewhere about 45. Now, obviously, the growth has also shrunk. The premiumization, which was underway till 2020, 2021, has become actually a reverse trend. The putty and lower end paints have started outselling the distemper and other enamels and all. So we as a house don't have a very sanguine view right now on paints. In fact, many of the hallowed consumer companies, we don't have a very positive view there because the growth has become a casualty for one or the other reason. You look at consumer staples or paints, the growth has hardly been there for the last 3-4 years. In fact, I was just telling Nimesh that a company like Hindustan Lever, right after the GSK deal, they announced, I think, the GSK acquisition somewhere in December 2018. Yeah. And then March 20, that big block happened of 35,000 crores. Point-to-point returns, if you look at, between June 2020 to June 2025, it's zero. Yeah. Nifty has given you 20% compounding, right? Even today, as we speak, the expectations for next 2 years for some of these companies are maximum 8 to 10% growth. Now, obviously, there could be some contra-buying which can be done because the sector is underperformed. But somebody who's looking for growth investing in consumption, I think consumer discretionary offers a far better choice. And there are so many sub-segments which have evolved in consumer discretionary in the last 10 years that you can have your own picking. There is jewelry, there is hotels, there is apparel, there are so many other sub-segments. And there the growth is far better. And the other point which basically intersects with this is that the lower end consumption is still struggling for a variety of reasons. You will get 20 reasons if you ask 20 people. But the point is lower end consumption has been a big problem in India for last 3 years. You look at the volume growth of all these companies, barring 1 or 2 companies, they have not done well. And it's not a short-term problem, actually.
And the upper end is being eaten away by a lot of the premium players.
Absolutely. But Mangalam, that's like a new excuse.
Yes.
But you look at the last 10 years growth. Sure. Doing this exercise. Take last 10 years revenue growth of all consumer staple companies. There's not a single consumer staple company in India in the last 10 years which has given you 10% top line CAGR. Oh. I'm talking about top line, not volume.
Yes.
So you add volume plus price increase and still you don't get 10%. So this companies 5 years back were trading at 60-70 Ps. So those Ps have shrunk. Obviously, given the defensive nature of the businesses, the stock prices will not fall 30-40%, but they will time correct. And it will cost you huge opportunity loss. So if against Nifty you underperform 20%, against other sectors you might have ended up underperforming by 30-35%. Because Nifty 500 has given you 23% CAGR. Mid and small cap has given you 30-34% CAGR in the last 5 years. Because the earnings growth has kept pace. Nifty 500 profit pool has gone from 4 lakh crore to 16 lakh crores. Yeah. 4.7 to 15.7 lakh crores in last 5 years, which is a compounding of 30%. And the index has also given you 23% compounding.
And just to put that into perspective, 30% missing compounding for 5 years is a difference of 1 and 4. So something that has been compounding for 30% over 4 years
absolutely
becomes 4x.
Gautam is not interested in Mangalam. Paints and FMCG is making it clear there are better opportunities out there. You take a back seat for now. All right, I'll tell you what. Let's take that short break. Gautam briefly mentioned about capital markets, so we'll continue that discussion. Nimesh has put together a very exciting piece. Don't go anywhere.
Well, welcome back to Editors Roundtable. The NSE has been a big stock that's been talked about, though it's unlisted. But even in the unlisted market, it's been a big talking point among investors and for many reasons for it. In fact, the stock has rallied nearly 40-50% in a very short period of time. But the bigger thing is that NSE is now a golden goose for PSUs. Why I'm saying this, it'll come out on the table. Just look at the NSE stock price. It's currently trading around 2350, which means that NSE is now currently commanding a market cap of 5.5 lakh crores. That's right. NSE is commanding a market cap of 5.5 lakh crores at an average price of 2350. But as I said, it's a big golden goose for the PSUs. What I'm saying is the PSUs combined own close to 31% stake in NSE at this point in time, which means that commands a market that they combined can garner a market cap of close to 1.7 lakh crores if they choose to divest the stake in NSE. Of course, everything is not going to get sold very, very soon. But look at the top holders of NSE now. LIC is the biggest holder of NSE from the PSU basket. They own 10.7% stake, and at current market cap of 5.5 lakh, that's valued at close to 60,000 crores. The other big investors are Stock Holding Corporation, SBI Capital Market, SBI, the listed entity, State Bank of India. They own close to 3.23% stake, which at the current market cap can be valued at close to 18,000 crores. So if that has to get sold, maybe SBI doesn't need to do a QIP or fundraising going forward. JIC also owns close to 1.6%. But apart from these guys, there are also some insurance companies and smaller PSU banks that are holding stake in NSE. The Oriental Insurance, National Insurance, New India Assurance are some insurance companies. Bank of Baroda, the listed entity, owns some small stake. So has IDBI Trustee, as well as PNB and Indian Bank as well. So these are the few PSUs who are owning stake in NSE at this point in time. So combined, they own close to 31%. Now, as I said, the stock price in the last few weeks has gone up. The NSE stock price, what I mean, from 1600 to all currently is around 2350. Again, it's a bit of source base, but that's the average price that I've been told it's quoting at in the unlisted market, 2350 per share, which means a jump of nearly 46% in last few weeks. Now, there is a reason for it as to why there is so much of buzz in NSE. Largely, the anticipation is that maybe the NSE IPO is round the corner. And why I'm saying is because the sources are suggesting, we've reported a news-based story as well, that NSE has filed for a settlement with the regulator in the co-location case. And they're willing to pay as high as close to 11,000 crores. So that will be a big amount that NSE may settle for. But if this is the last thing which we understand is pending for a potential IPO of NSE, and that could clear the way for the NSE to go and list. Of course, it's all source-based, and we haven't got a confirmation from NSE on that. But that's been the key reason why the NSE stock price in the unlisted market has rallied nearly 50% from a low of 1600 few months back to almost 2350. And what this means, it's a good, NSE has become a big golden goose for the PSUs, and they can raise a lot of money if they choose to dilute stake. Gautam, I want to have your views. I saw a CLSA report as well in the morning. They spoke about SBI. Business-wise, they're in a sweet spot, but also it means that they can, raise some money if they choose to sell the stake in NSE. What's your broad sense on NSE if you track it? And generally, what's your view on PSUs as well?
So look, NSE, I won't be able to comment because it's still unlisted. But still, like we discussed on the capital market space, the room for penetration of equity and the expansion of equity cult in India is tremendous for the next 5 to 10 years. If we move from $2,700 per capita to $4,000 per capita, the kind of savings pool it will generate, it's unimaginable today. 15 years back when our founder Ramdevji wrote a wealth creation study on the next $1 trillion economy, when we were a $1 trillion economy, from $1,000 to $2,000, one of the benchmark point I remember is when you move from $1,000 to $2,000, you're not going to spend the incremental $1,000 on your basic needs. So maybe you spend $100 on roti kapda makan, but rest of the $900 will go on discretionary items. Yeah. Now, when you move from $2,700 to $4,000 or maybe $4,500, a lot of saving will also get generated. Yes. And Indians by nature are slightly conservative in their spending habits, right? So our view is that, and of course, you're seeing the pressure on bank deposit growth also. Why is that happening? Because the youth demography that is there in India, they are not interested in your PPF, NSC, bank deposits and all. They are starting with SIPs. They are starting with direct stock investment. They are opening demat accounts. So the whole architecture of capital market ecosystem, which is your AMCs to begin with, exchanges, brokers, wealth managers, and a lot of the intermediaries which are there, they can become pretty big in size. Now, the problem is, this is a very cyclical industry, right? So you will have a lot of intermittent jerks along the way, but at the end of the 10-year, you will be much higher than where you began. And I'll be mighty disappointed if we don't end higher.
But Gautam, from a viewer's perspective, what would be your top bets in the capital market space? What would be your key things to watch out for?
So look, we've had 4 or 5 stocks which is put out in the public domain as our top ideas. So Angel Broking, BSE, these 2 are part of our model portfolio. Aside of that, we like HDFC AMC, we like Nuvama Private Wealth. In fact, BSE we just downgraded because the rise has been phenomenal. Since the time we upgraded in December 24, the stock is up more than 50% in less than 5 months. So it is now trading at 53, 55 times, I think in FY27. So a little bit of cool-off is needed there. But the long-term story looks very intact to me. And there are many other stocks, aside of the 4 I mentioned, where returns can be made. The point one needs to remember is one has to be in it for long term. When you cannot come in for 6 months and then you flip out, because then the possibility of destroying wealth is also there.
You take that point, and finally, he said that Indians are conservative when it comes to spending. He's speaking about a particular generation, because if you look at some, as the per capita goes from 2,000 to 4,000, the spends on luxury increases massively, and that's what we've been seeing as well.
Exactly. You've seen the hotel sector, you've seen the jewelry sector, apparel sector, so many other sectors. While your traditional names are struggling with 0 to 2% volume growth, they are printing 20-25% top line growth.
Okay, all right, gentlemen. Thanks a lot. Thanks, Gautam, for coming down. We look forward to having you more often on the show. And gentlemen, it was a good one. Well, on that note, though, we'll wrap up on this edition of Editors Roundtable. Stay tuned to CNBC TV18. More news and updates on the other side.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty up 2% this week after a strong rally on Friday. The Nifty is now just over 2% away from its record highs. Crude oil prices are down 10% this week, the biggest 5-day decline in 2 years. JSW Paints set to acquire Akzo Nobel's India business by shelling out 9,400 crore rupees. The deal will make JSW the 4th largest player in the highly competitive paints industry. CNBC-TV18 reported last month that the deal will be signed by the end of June. Axis Bank executive Rajiv Anand leads the race to become the next CEO of IndusInd Bank. Sources say Anup Saha of Bajaj Finance and Rahul Shukla of HDFC Bank are also in the running. That's an exclusive. US and China agree on a trade deal framework. Beijing will allow rare earth exports after review. US will ease the rules restricting high-tech exports to China.
But we're having some great deals. We have one coming up, maybe with India, very big one, where we're going to open up India.
President Trump teases a big trade deal with India ahead of the July 9 tariff deadline, but the Indian government sources tell us no consensus yet on steel, agriculture and automobile tariffs. India's chief negotiator Rajesh Agarwal is in the US for talks. The Union Cabinet is likely to have waived spectrum dues worth 6 lakh crore rupees. Sources say the waiver will only apply to government departments like defence, railways and space. No waiver for PSUs and private players. Tata Power plans to expand electricity distribution across Maharashtra, seeks licenses across key regions, including parts of Mumbai, Pune and Nasik. Fintech unicorn Pine Labs files for an IPO worth 2,600 crore rupees. Existing investors include PayPal and MasterCard will offload stake as the company eyes a valuation of $6 billion. Well, let's go straight to the market action. Benchmark indices recording gains for the second straight week. The Sensex and the Nifty ended the week 2% higher. Broader markets outperformed with the Nifty small cap index up by 4%. So that's the Sensex for you, up by about 2% and a 2% gain coming in for the Nifty as well. The Nifty ending above 25,600 and it's now about 2% away from a record high. The Nifty Bank, meanwhile, also touching a fresh record high, closing above 57,400 for the first time. So strong close there for our markets this Friday afternoon. From equity markets to the commodity markets, prices of crude oil falling over 10% this week, registering the worst decline in over 2 years. Fears of supply disruptions in the Middle East have eased. However, oil prices markedly corrected today due to higher fuel demand in the US. But let's go straight to the big story. We told you first, and it is now official. JSW Paints is set to acquire Akzo Nobel's India business in a deal worth 9,400 crore rupees. The deal will make JSW the fourth largest player in the highly competitive paints industry. Shares of Akzo Nobel surging after JSW announced an open offer at a 16% premium. Rachna is here with more. Rachna.
It is a CNBC-TV18 News break confirmed. JSW Paints has officially sealed the deal to acquire a 74.76% stake in Akzo Nobel India. Now, this is for 9,400 crore rupees at 2,762 rupees per share. That's a 16% discount to market price, as we had indicated earlier. Now, sources have told CNBC-TV18 that the deal would be funded through two ways. First, where 2,000 crore rupees would be coming in equity from the Jindal family, backed by stake and asset sales, while the remaining 7,000 crore rupees will be in form of debt and structured credit, including financing from global institutions. But before the deal can go through, there are a few crucial steps left, starting with a mandatory open offer. Under SEBI rules, any acquirer picking up more than 25% stake in a listed company has to make an open offer to public shareholders. In this case, JSW Paints will offer to buy up to 26% more of Akzo Nobel India at 3,417 rupees per share. That's a significant premium to current market price. Now, post-merger, JSW Paints will have a production capacity between 4,70,000 to 5,20,000 KL per annum, blending JSW Paints' Vasind and Vijayanagar units with Akzo Nobel's plants in Gwalior, Bangalore, Mohali and Hyderabad. The employee headcount is also expected to be around 3,500 people and an estimated revenue of over 5,000 crore rupees in 2025. This is well in line with their FY26 growth targets. Now, with a 9 to 10% share in the decorative paints market and becoming the second largest in industrial coatings, this move makes JSW Paints the new number 4 player in India's paint landscape. A transformative step and a bold bet by Parth Jindal to build what he calls the paint company of the future. But it was earlier this year in Davos where he had said that he would do anything to get this deal. Here's what he said.
I think there's no choice. If JSW and the ambitions we've shown that we want to be a top 3 player in whichever sector we play in, if I have to do that, then I have to give it everything that I've got for Akzo.
How will you fund it?
It's going to be a mix of the family investing, and private equity.
Well, that's Parth Jindal speaking to me on going after Akzo Nobel, and today the deal has been closed. Now, paint stocks traded with gains after that announcement came in. How does all of this change the dynamics of the sector? Mangalam is standing by with the details. Mangalam, hugely competitive already with the entry of Birla and now JSW.
Let's start with, JSW Paints acquiring Akzo Nobel at close to around 2,700 rupees per share for the promoter stake. 3,417 rupees per share is what they've allowed for an open offer as well. But on Akzo Nobel, they're the fourth largest paint company in India. They're the makers of Dulux paints, and nearly 35% of their revenue comes in from decorative business as well. They have a high market share in the premium end of segment. Whereas JSW Paints, if you look at it, they've been in the market for over 6 years. FY24 is when they crossed that 2,000 crore revenue mark. FY25, they had a target of 3,000 crores. In FY26, 5,000 crores. All of this organically. Remember, 60% of their revenue comes in from intergroup business. So that's something we'll have to talk. If you look at the paint industry, the top two players have over 50% market share. Asian Paints last year did over 34,000 crores in terms of revenue. Berger, 11,500 crores. Kansai, 7,800 crores. Akzo Nobel stands in here. Add another 2,000 crores of JSW Paints. It becomes a 6,000 crore player on the whole. The paint industry worth nearly 80,000 crores right now. 65,000 crores is organized, expected to grow anywhere between 12 to 13%, with the market share of top two players being over 50%, and that's what the conglomerates are eyeing. What is it that helps in, the business to grow? Birla Opus launched last year itself. They have high single-digit market cap and market share rather, and 900 to 1,200 crore in terms of quarterly run rate. Can they continue this business or not? They have a stated target of 10,000 crores in terms of revenue and EBITDA break-even by year 3 of complete operations. What is it that the incumbents will need to do? Focus on distribution, brand, tinting machines, and capacity. Capacity, the least of them all. First 3 is most important. What everyone will be looking at, how the incumbents and disruptors expand, whether there would be margin contraction in the industry or not, and eventually valuation multiples. Are we likely to see another derating once this disruption comes by or not? All of that depends on what Akzo Nobel and JSW together do. We'll be tracking growth for JSW Paints along with Akzo Nobel, ex their own group, revenues. Secondly, how much more will they invest in capacity, branding and distribution? And thirdly, from a listed company standpoint, will they list JSW Paints business via reverse merger, or will there be an IPO for JSW Paints itself or not? Paint stocks have seen a correction of almost 30-35% from the peak. Asian Paints at some point was trading over 60 times, now at 45 times. Berger Paints 40 times. So there has been one leg of valuation, multiple derating that has taken place.
Changes much, because these two players, as you rightly said, have been there in India already. Both JSW and Akzo have been operating in this market. We are more or less aware of their strengths and weaknesses, and we know what they are doing in the marketplace. So it's just a change of hands, possibly a change, in the management style that it is operating in. So from that perspective, there might be some small changes, but overall in the industry, nothing changes much. What does happen is that there is a consolidation which is happening now. So there are now 5 players in the industry. The top 2, Asian and Berger, remains. The 3rd, 4th, and 5th position is up for grabs, and that's where the competition will be intensifying a bit. Between Birla, JSW plus Akzo and Kansai.
Well, that's Berger Paints on the changes that we're seeing in India's paint market. On to CNBC-TV18 exclusive. Axis Bank's Deputy Managing Director, Rajiv Anand, is a strong contender to take over as IndusInd Bank CEO. Sources tell us that 2 other finance executives are also in the reckoning. Ritu is here with more. Rajiv Anand, and who else, Ritu, the likely contenders to take over at IndusInd Bank?
Well, the big question for IndusInd Bank right now is who takes charge as the next CEO, someone who can clean up the books, restore trust and steady the ship after months of turmoil. And our sources tell us that the bank's board is actively considering 3 contenders, and that includes Rajiv Anand from Axis Bank, Anup Saha from Bajaj Finance, and Rahul Shukla of HDFC Bank. Let's start with Rajiv Anand, who's got more than 35 years of experience. He's been with Axis since 2009 and served on the bank's board since 2013. And as the Deputy MD, he's led the wholesale and digital banking portfolio. But here's the key detail. Rajiv Anand has announced his retirement from Axis Bank, and he's set to step down in early August, making him available to take charge at IndusInd if selected. Now, our sources point out he is indeed a strong contender for the job. Next up, Anup Saha, again 32 years of experience, 25 years in financial services, including 14 years at ICICI Bank. He's led everything from credit cards to mortgages, auto loans and structured finance. He's been with Bajaj Finance since 2017 and was very recently elevated to the position of MD. Finally, Rahul Shukla, more than 30 years of experience, began his career at Citibank and then joined HDFC Bank in 2018, where he oversaw corporate banking first and now heads the commercial and rural banking division, but is currently on a sabbatical. Now, while all 3 of these contenders are under consideration, our sources say the bank is looking more keenly at Rajiv Anand and Anup Saha. Now, remember, the Reserve Bank of India has asked the bank's board to submit the final list of names by end of June. Now, while the board has held informal discussions with RBI, we understand that the names have yet to be formally submitted. Now, typically, RBI takes anywhere between 4 to 8 weeks, sometimes even longer, to approve the bank CEO names. But in this case, it's not the usual case. We've seen a string of top-level exits, accounting lapses, irregularities come to light with a leadership vacuum at the moment. And so our sources indicate this appointment could be fast-tracked.
All right, Ritu, many thanks for joining us. The big global story: China has confirmed details of a trade framework with the US that seeks to allow rare earth exports and the easing of tech restrictions by the US. Beijing says it will allow the export of rare earth magnets to the US after review. On the other hand, the US will cancel a range of existing restrictive measures imposed against Beijing, including tech exports. With this, both nations have agreed to implement the framework that they agreed to in Geneva a couple of months ago. President Trump confirmed the agreement with China. He also teased a big trade deal with India, which he claimed will open up the country. All of this comes ahead of the July 9 deadline, when the 26% reciprocal tariffs are scheduled to kick in.
But we're not going to make deals with everybody. Some we're just going to send them a letter, say, thank you very much. You're going to pay 25, 35, 45%. That's the easy way to do it. And my people don't want to do it that way. They want to do some of it, but they want to make more deals than I would do. But we're having some great deals. We have one coming up, maybe with India, very big one, where we're going to open up India. In the China deal, we're starting to open up China, things that never really could have happened. And the relationship with every country has been very good.
Well, that's Donald Trump. Even as the US president teases a big trade deal with India, government sources say some hurdles remain. There is no consensus yet on steel, agriculture and automobile tariffs. Parikshit is standing by with the details. Parikshit, India's chief negotiator currently in the US, the 9th July deadline looms large. What's the latest now on the talks?
India and US are discussing an early harvest deal which will cover $100 to $150 billion worth of goods traded between the two nations. But there is no agreement on critical areas just yet, and India's top negotiator Rajesh Agrawal is visiting the United States again for talks. India and the United States are yet to come to an agreement on steel, agriculture and automobile tariffs. Sources say the US-India early harvest deal cannot and won't be a one-way street because both sides will have to win. Where are things stuck? Well, India wants an exemption from 50% duty on steel imports imposed by the United States. But America is unlikely to give a concession to India here. Differences still remain on tariffs on automobile components. Also, US wants access not just for American cars, but large, heavy-duty trucks as well. US wants more access in agriculture and dairy, but India cannot allow US dairy and meat products as American farmers use blood meal as food supplement for livestock. India is also unlikely to allow any genetically modified crops into the country. The US is likely to maintain a 10% baseline tariff on Indian exports even if a deal happens. And if that is the scenario, India would impose a 10% tariff on American goods as well. India also wants tariffs on labor-intensive products to be reduced to zero. Government sources believe that there will be at least 100 product lines where tariffs may be reduced to low single digits or even zero. United States may impose zero tariffs on imports of some labor-intensive goods from India. This may be through a fixed quota of goods to be imported at lower tariffs and anything beyond that to be subjected to higher tariffs. US and India are looking to conclude an early trade deal before the 9th of July. Indian officials have said that there will be no compromise on national interest and the country is not desperate for a trade deal. Experts have said that India should not be worried about reciprocal tariffs in case a deal is not struck before the 9th of July.
All right, many thanks, Parikshit. And the White House has indicated that President Trump could extend the July 9 tariff deadline. Press Secretary Karen Levitt said the date is not critical and could be extended at the president's discretion.
The deadline is not critical. The president can simply provide these countries with a deal if they refuse to make us one by the deadline. And that means the president can pick a reciprocal tariff rate that he believes is advantageous for the United States and for the American worker. And he will continue to do that.
Well, while the press secretary hinted at an extension, U.S. Commerce Secretary Howard Lutnick insisted that July 9th will be the deadline for reciprocal tariffs to kick in. So mixed messages coming in from the White House. Now, the U.S. Embassy in India has cautioned visa applicants against omitting social media information, saying it could lead to visa denial and future ineligibility. Now, social media posts by the embassy reminded visa applicants that they have to list their social media handles used in the last 5 years. The U.S. State Department has referred to each visa adjudication as a national security decision. Applications for students and exchange visas have also been asked to make their social media profiles public for vetting. The Union Cabinet is likely to have waived spectrum dues worth 6 lakh crore rupees. Sources say the waiver will only apply to government departments like the Department of Defence, Railways and Space. Ashmit is standing by with the details. Ashmit, so just to be clear, there's no waiver for PSUs and certainly no waivers for private players. What has been cleared by Cabinet?
Well, just the term spectrum waiver, it sparks a lot of interest. But again, that's an important clarification that you gave, that this is not for PSUs, this is not for private players. This waiver that has come from the cabinet, what sources tell us, is strictly and strictly for only government departments. Bear in mind, departments such as the likes of Defence, Space, INB, Railway are allocated spectrum on an administrative basis for their operations, for their communication requirements. The spectrum is allocated by the DOT, and therefore, as a result, they're required to pay the spectrum dues in question. Now, these dues date back to early 2000s, and because of non-payment, had swelled on account of interest, on account of penalty components compounding over the very many years, swelled to north of 6 lakh crore rupees. And that is the question that was put before the cabinet. One government department having to pay the other. The wisdom was seen by the cabinet that given that this is a situation where the left hand appears to be paying the right, the wisdom was seen by the cabinet to grant a waiver. This waiver, again, to clarify, is meant for these government departments for their spectrum dues on account of their interest and penalty components. Now we're given to understand that after this relaxation, they'll only be required to pay a minimal interest burden as well as the principal component. That is the main charge that has now been approved by the cabinet. But again, to reiterate, this is purely and purely for government departments, the likes of Defence, Space, Railways and INB, not for PSUs and definitely not for private players.
All right, Ashwin, many thanks. Now, Finance Minister Nirmala Sitharaman met with the heads of public sector banks today. The FM urged bankers to lend more and step up credit momentum. Government wants PSU banks to report higher credit growth this fiscal compared to the last year. The nudge from government to lend more comes after the RBI asked all banks to ensure 50 basis point rate cuts are passed on to consumers. Well, the 12,500 crore rupee IPO of HDB Financial Services has been oversubscribed on final day of bidding. As of 4 p.m, the HDFC Bank subsidiary issue was subscribed by more than 15 times. The retail portion was also fully subscribed with a bidding of 1.3 times. The portion reserved for qualified institutional buyers led the demand with a subscription of 51 times, while the portion of non-institutional investors was subscribed nearly 10 times. Fintech unicorn Pine Labs is gearing up to go public. The company has filed papers with SEBI for a 2,600 crore rupee IPO, offering a valuation of $6 billion. Existing investors like PayPal, MasterCard and Peak 15 will sell shares in the IPO. Former civil servant Amitabh Kant has joined Fairfax Financial Holdings as a senior advisor. Kant, who recently was India's G20 Sherpa, will play a key role in the company's investment strategy. Fairfax CEO Prem Vatsa said Kant has outstanding experience in many of the key areas that India intends to grow in the coming years. Tata Power is planning to expand electricity distribution across Maharashtra. The company has sought licenses across key growth regions, including parts of Mumbai, Pune and Nasik. This comes days after Torrent Power received initial approval for distribution in Maharashtra. Vivek joins us now to tell us more. Vivek.
Well, a couple of days earlier, we had highlighted about how you could see the entire landscape of the power sector as well as power supply in Maharashtra change. We told you about how Torrent Power was looking to get a parallel license as far as distribution of power in Maharashtra was concerned. Well, hot on the heels of that, Tata Power too is looking to enter the parallel electricity distribution sector in Maharashtra. They've applied to MERC, which is the Maharashtra Electricity Regulatory Commission, for operating parallel electricity distribution in 10 areas. What does this mean both for power producers, power companies as well as customers? Well, for power companies, it's quite simple. It opens up a new stream of revenue, while for customers it opens up competition, indicating that you could see more choices when it comes to who you buy power from, and hopefully also lower tariffs. Now, what is a Tata Power spokesperson telling us? Well, they are saying that the total customer base that the company currently has is at close to 12.8 million across Mumbai, Delhi, Odisha as well as Ajmer discoms, and they say that in case they do get these 10 areas of Maharashtra as well, they would be able to cross the 15 million consumer mark. Clearly, a positive development in case this fructifies as far as Tata Power as well as Torrent Power, if it does happen. What do analysts say? Well, analysts say that number one, this particular development is quite a new development as far as the power landscape in India is concerned. In fact, Bernstein says that these companies will have to compete with state discoms. And remember, they will also have to set up their own infrastructure. They will not be able to use the existing infrastructure, for which they will have to incur capex. However, remember, power is a regulated sector, and any kind of capex that companies incur where there is an equity portion of 30% and 70% is debt. On the 30% equity portion, they will receive an assured return in that range of 15.5% to 16%, which indicates, again, a fixed income stream as far as power companies are concerned. Remember, companies will also need to tie up new contracts for receiving supply of power, either from their own arms or from other arms that are active as far as the states are concerned. However, remember, given the high increase as far as renewable energy production is concerned, power companies now are able to source power at much lower costs.
Vivek, many thanks for joining us. And with that, it is time for us to wrap up this edition of Business 360. Do stay tuned to CNBC TV18. We've got plenty more coming up right after this short break. We're back in a moment.
Welcome to the Medicine Box. I'm your host, Ekta Batra, and today we are talking about something that is becoming one of India's biggest health concerns, obesity. The numbers are hard to ignore. Nearly 1 in 4 Indian women and men are now overweight or obese. Even our youngest are affected. The number of overweight children under 5 has jumped from 2.1% to 3.4% in just a few years. And here's what really stands out. We're gaining weight together as a family. Today, all adults are either overweight or obese in 1 in every 5th Indian home. A Lancet study now predicts that by 2050, 45 crore Indians, that's over a third of us, could be overweight or obese. And we may have one of the highest numbers of obese children in the world. This isn't just about how we look. Obesity is now being seen as a chronic disease. It often comes with a yo-yo pattern of weight gain and loss. And it plays a huge role in serious conditions like diabetes, heart disease, high blood pressure, cancer, and even Alzheimer's. In fact, 8 out of 10 people with type 2 diabetes are also overweight, a combination doctors now call diabesity. But here's what's new. For the first time in India, we now have access to 2 globally talked about drugs, Mounjaro and Wegovy. Launched just weeks apart, they've shown impressive weight loss results globally, and they're stirring up a lot of buzz. So the big questions are they the game changers we need? Who should take them? Are they safe? And what happens when you stop? We're joined today by Dr. Ambrish Mittal and Dr. Sonali Kagne. Welcome to the show.
Thank you.
Well, Dr. Sonali, let's kick off the show with you. If you could just give us the key differences between the 3 weight loss drugs that exist in India now. Wegovy, the injection by Novo Nordisk for weight loss, Rybelsus, which is the oral semaglutide by Novo Nordisk, and Mounjaro by Eli Lilly.
Okay. Wegovy and Rybelsus, the molecule is the same, which is semaglutide. The only difference is Wegovy is an injection which is to be taken once a week, and the oral tablet is to be the Rybelsus, which is an oral tablet. It is to be taken once a day. If we compare the weight reduction efficacy of these 2 molecules, Wegovy is much better for weight reduction as compared to Rybelsus. Both these, the semaglutide molecule is it belongs to the group of GLP-1 receptor agonist, whereas now coming to Mounjaro. Mounjaro is a dual GLP-1 and GIP receptor agonist, and it is also an injection form which is to be taken once a week. The weight reduction efficacy of Mounjaro is currently the highest amongst all the molecules which are available. So it is to the extent of 22% average weight reduction compared to 17% with Wegovy and around 10% with Rybelsus.
Okay. All right. Dr. Mittal, how do these drugs work at this point? Because a lot of the feedback that we've got is that it sort of reduces the noise in your brain when it comes to cravings, when it comes to hunger pangs. Tell us, how do these drugs work?
So all these drugs work via the GLP-1 pathway. GLP-1 is a hormone that's secreted from the intestine and acts on the pancreas as well as the brain. Whenever we eat food, there is secretion of GLP-1. Endogenous GLP-1 acts on the brain to control our appetite and satiety. It tells us when to stop eating. These drugs act through that pathway, and they act on the brain to tell us to stop eating and also to reduce our appetite. So the primary weight-reducing action of Ozempic or Wegovy or Mounjaro is via their brain action. There are other actions also, like slowing the movement of food in the stomach, but those are all secondary. The primary action responsible for weight loss is the brain action.
Dr. Mittal, now give us a sense. If somebody walks into your clinic with diabetes and say is overweight as well at this point in time, give us what you are prescribing to them based on different BMI scenarios.
So for diabetes management in an overweight or obese persons, GLP-1 drugs are the first line of choice now, more and more. And as they become more easy to use and more accessible. They should be offered to most patients with diabetes who are overweight or obese.
Okay, so would
If you
that
want
be
a BMI cutoff, yes. So those above 30, even without diabetes, would be candidates for these drugs. Those who have a BMI over 27 and have diabetes, you're talking about diabetes, so those above BMI 27 with diabetes will definitely be candidates and should be offered these drugs.
Okay, so somebody who has a BMI between 25 and 29 and is not diabetic,
correct,
would they be eligible for these drugs?
Ideally, we would like to look at the other causes, why they are gaining weight. We need to look into their lifestyle and try our best to, you know, kind of make them lose weight with these other modifications rather than jumping on to the these drugs. Because most of the times when they are in this weight category, some incidents would have happened recently or in this last 2-3 years or so, because of which they have started gaining weight. For example, in a woman, it can be a postpartum condition. For someone else, it is a sedentary job which has recently been changed. For someone whose job, the working hours are so long that they are not finding time for the exercise, or recently they have changed their eating habits or something. So there is some factor because of which they have probably gained the weight, or they were overweight to start with for quite some time, but they have never taken some effort to lose weight. And most of the times the awareness that this BMI of 25, generally we label them as healthy rather than overweight or obese.
Yeah.
So we have to change that mindset. Most of the time, if you look at average build wise, it looks like, okay, this person is normal. So we probably have to change that definition in mind. And this is probably the best time in the weight journey, where if you are aware that this is not my ideal weight and this is a little overweight, and if you just take care of small factors, you will definitely lose weight, and we need not jump for these medications for say.
Okay, so in that case, it's only lifestyle modifications. And what if that same patient comes back to you and says, you know, I tried, I lost 10 kgs after 3 years, I put it back on, now what do I do?
So if in that category, they have already tried everything.
And they still don't have diabetes.
Fine. If they have already tried everything possible, still they are unable to lose weight, and they have some other comorbidities, not necessarily diabetes, but some hypertension, obstructive sleep apnea, or they have, you know, weight-related issues, then in that case, we might consider for till the time they can probably, you know, continue their lifestyle and lead to a little weight loss, wherein they can just maintain the lost weight with the continued lifestyle modification.
Okay. Well, Dr. Mittal, what about somebody who walks into your clinic and has a BMI of over 40, is morbidly obese? What would you recommend to them?
So anyone who comes in with a BMI of more than 40, the first choice is always bariatric surgery. We've been saying this for years and years and years, but the problem is that most patients do not agree to go under the knife. So I think it's a huge task. And, you know, such patients keep coming back. We keep discussing back and forth, lifestyle, a different diet. Now, at least if they disagree for surgery, we can help them. Maybe we won't bring them to target. It's very important to understand that if you lose 5 kilograms or 10 kilograms, you're helping yourself a lot. You need not always reach your target body weight. So if patient is unwilling for bariatric surgery, I would certainly put them on the GLP-1 drugs. In addition to this, there are patients who have agreed for bariatric surgery, but where the surgeon wants a little bit of weight loss to make the surgery easier or less difficult. And in those cases also, we are using these drugs quite liberally in preparing patients for bariatric surgery. So there is a role in those over 40 BMI, but there, of course, the first line treatment is bariatric surgery.
Okay, Dr. Sonali, what about you? You know, somebody comes in and says 110 kgs. What would you recommend to them?
So again, as I discussed, we need to start from the beginning, find out the causes, and depending upon the choice, basically, as Dr. Mittal has rightly mentioned, that many individuals, despite their BMI being even, you know, 44, 48, also sometimes they do not agree for the surgery most of the times. So in those cases, we might put them on this.
So do these drugs work effectively on them?
Yes. So basically the individual variation would be there, but these drugs which have shown this significant weight reduction in in other BMI ranges, they will also have the effect in this BMI range.
Say somebody who is 110 kgs loses 15% on this particular drug,
correct,
whichever one that you prescribe, and that has to be taken over a period of time, I assume, maybe around a year odd.
So basically, we need to continue to use that medication in order to maintain the lost weight. It's not that we are using it for 1 year and then we are advising them to stop the medication, because as with any other weight reduction strategy that we use, be it diet, be it physical exercise, once we stop doing or taking that particular care, we tend to regain the weight.
So the weight will come back on once you stop using it.
Yes, definitely.
Okay. So just, I'll get back to that in just a minute. But this 110 kg person loses 15% of their body weight, comes down to say around, 93 kgs, best case scenario, say even 88 kgs. Then what happens? Do you continue prescribing the drug, and does the dosage of the drug increase?
Yes. So if we need to increase the doses to achieve the target weight, we will keep on increasing the dose to that extent which is, approved by the for the drug, for that particular drug. And on that maximum drug, we will look at the whatever weight the person is losing, and we'll continue that maximum tolerated dose to maintain the lost weight. And with time, the person might keep on losing the weight, and simultaneously the other lifestyle modification will also help for them to continue the weight reduction. See, the most important effect in this, someone who has been on a higher side on the weight and was unable to lose weight for some or the other reason for a very long period of time, once they start seeing the change in their body and they start losing weight, they become so motivated in following up with the diet, regular exercise, that they themselves would like to stop this drug over a period of time and continue the lifestyle modification, which I have seen in many of my patients. That kick for sticking to the lifestyle, that is given by these drugs. So as we call them as a facilitator for weight reduction, not in terms just of by the chemical nature, but because of the result that they are showing to the patients. So it is also quite useful in them.
Okay. But Dr. Mittal, this is not a magic pill. You still need to follow your exercise regime. You need to follow your diet. It's not a pill that you pop and then, the weight just melts off, is it?
Yeah, absolutely. And I think I strongly second what my colleague said. Basically, the fact is that people are frustrated because they've attempted all lifestyle measures and have not succeeded in losing weight, or if they did, it came back. Now, when they see changes in their weight with the medication, they become motivated. And I have many patients like she's describing, where once they get this result of 10 kg weight loss, it motivates them to follow their lifestyle much more intensively and to try that weight. But remember, again, weight loss drugs, Ozempic, Wegovy, Mounjaro, are all part of a program for weight reduction. It's a journey. They are not standalone drugs. You start taking the medication and lose weight, don't do anything else. You will lose weight if you just take the medication. And that's a bit of a risk, because you're just going to lose muscle along with fat, all those things. But if you are exercising regularly, taking the right diet, enough protein, enough fiber, enough hydration, you will get the maximum benefit from these drugs. Plus, you'll be able to reduce the drug dose as you go along, and some of you may even be able to go off it. So the key
part is... When you go off it, Dr. Mittal, just to interrupt you there, when you go off it, how do you sustain without the drug? Because it's going to be, a little more harder to do the exercise and to maintain the diet, because you had that additional push from the drug, but now you don't.
Absolutely, and that's the real question here with the use of these drugs. There is a certain category of patients, older, diabetics, overweight, where it's clear, like all diabetes medication, this is a lifelong medication. So no discussion. We start insulin injections, you take them lifelong. So similarly, if you're a 55-year, 60-year-old diabetic who's got onto this, very likely you're going to use it lifelong. And we do tell patients that you might need it lifelong. The issue will be about people who are just using it for just weight, and especially younger people. People who are in their 30s or 40s, how can we say it's going to be lifelong? Within those who are not very obese, who fall in borderline BMIs, or just at 30, 29, and who work very hard and brought their BMIs down, we will try and taper gradually. What I'm currently doing is, most of my patients who started some time back are now on a maintenance dose or a very low dose of medication. And once they are stable on that dose, not putting on weight, I try and take them off. This I'm talking again of relatively younger patients who are not diabetic. For someone who has diabetes, it's an anti-diabetic drug. So it's pretty fair to use it lifelong.
Okay, what about the factor about side effects? What are the side effects that people need to be aware of? We've spoken about how, or it's publicly noted about, nausea, etc. But I'm going to just drill down on the more serious side effects which have been recorded. For example, there's a recent study which was published by JAMA linking GLP-1 drugs to age-related macular degeneration, and there are eye conditions that it's been linked to. How comfortable are you with that, Dr. Mittal?
So I think that's the single biggest question with these drugs at the moment. Firstly, clinical trials have not shown that. The data that's being presented, and I read the JAMA paper, is basically about large numbers of patients who have age-related macular degeneration or NAION, and they found that within those patients, the number of patients taking GLP-1 drugs was higher. Okay, so the association is not firmly established. There are plenty of studies showing no association. Having said that, we have to be alert about that. We cannot just dismiss it. Any signal should not be taken for granted. So therefore, as a precaution, I am advising eye check to all my patients before initiation of the therapy and once a year. That's the best we can do at present. If at all this effect is found, this side effect, I think it's exceptionally rare, and we really don't know the final answer yet as to whether it's really there or not.
Okay. Well, Dr. Sonali, there's a black box warning for thyroid tumors. How seriously would you take that? It's been found in animals and not in humans in terms of the clinical studies, but we don't have long-term data on that.
Correct. So basically these GLP-1 receptors, they are found in a huge number in the rodent's thyroid gland. Whereas if we compare it with the humans, we don't have the GLP-1 receptors, those many on the human thyroid. And therefore, like sir said, we have been using these drugs from last 20 years, but we could not find a significant increase in the number of this medullary thyroid carcinomas with the use of these medications as of now. Although we do take that in consideration if someone is been on these drugs and comes with the suspicion of that thyroid swelling or tumor. In that case, we might evaluate. And so because it's not seen in the trials in humans yet, there is no even the screening protocol that we should keep on screening the patients for these cancers.
Okay, so as of now, the rewards outweigh the risks, you would say, for thyroid as well as eye conditions?
Yes. Yes.
Okay. What about the muscle loss? Because that's, some people lose as much as 25 to 39% of muscle loss. In any case, Indians eat less protein and don't hit the gym on a regular basis for weight training. Is that a condition that you think about twice?
Yes. Basically, that is the most important factor to be taken into consideration, and that is why we should not just consider this medication as just a magic pill. And as we were discussing, it has to be a part of the a broad spectrum obesity program where we are all ensuring the high protein diet, ensuring the muscle strengthening, the weight training exercises along with these drugs and the lifestyle modifications, so that we can minimize the lost weight. Obviously, as you rightly said, when we are getting the benefits in terms of reduction of the comorbidities along with the weight loss, we are considering this medication irrespective of the lean muscle mass which we are muscle mass loss which we are seeing. But for that, we have to be always proactive in terms of preventing that lean muscle mass.
Okay. Well, I have a couple of viewer queries, and I'll just request you to keep your answers extremely brief for this. Dr. Mittal, about the misuse, the fear is that, people are fearing that their children could misuse the drug as they become teenagers, or that population wants to lose around 5 kgs, take the drug, stop the drug. Do you think that's a key risk, especially with the fact that semaglutide is now going to become generic and is going to be much more easily available?
Well, I would like to look at it positively. I think my patients have more options, and I think that if it becomes cheaper, it has, even greater number of people have access. But you're absolutely right. I agree. The potential for misuse is high. And we really need to regulate the sale of these drugs very tightly. Otherwise, yes, this kind of misuse is very much possible. In fact, I'm getting a lot of requests from people who are just like, a BMI of 24 and they want to be 23, something like that. So we need to be cautious.
Okay, Dr. Sonali, how do we address the larger issue of obesity in India? When your patient comes in, what is the first line of recommendation for you to the patient?
So I always start my consultation with the basic questions about all the lifestyle factors that we take into consideration, right from the diet, the exercise, their sleep hygiene, what time they get up, how long they watch the TVs or they have been working on the screen, and what are the how is the environment at home in terms of domestic environment, the socio-economic environment, and all those things needs to be considered because they are again equally contributing to the weight issue.
Okay, all right, Dr. Mittal as well as Dr. Sonali, thank you very much for joining in and giving us all of this perspective. Dr. Mittal, I do understand that you've written a book on weight loss drugs, so I'm sure that would be helpful as well. But thanks very much for joining in on the Medicine Box and talking to us.
Hello and welcome to Global Eye. I'm Parikshit Luthra. The Trump administration continues to crack down on immigration. US visa applicants are now required to list all social media usernames or handles of every platform they have used from the last 5 years on their form for background checks. The US State Department referred to each visa adjudication as a national security decision. In a post on social media, the US Embassy in India cautioned applicants against omitting social media information, saying that it could lead to visa denial and future eligibility. Earlier, the US Embassy also asked those applying for student visas to switch the privacy settings of their social media accounts to public to facilitate vetting. How is this move expected to impact visa applicants? Joining us now to discuss this is Piyush Kumar, Regional Director, South Asia, Canada and Latin America at IDP Education. Thank you for being with us. Piyush, let me begin by asking you, how has this changed the time taken for processing visa applications for students?
Well, if you talk about India, I would say currently the visa applications are in a pause mode. So what I mean is that the students who had not got the visa interview slots, currently the visa interview slots have not been opened, and hence, obviously, till the time they get opened, the processing will not begin. For students who had already submitted their visa applications and had got the visa interview slots, for them the time taken has not changed. It is just what it always used to be, which is for US, which is pretty good. But if a student has not yet got the visa interview slot, then they are waiting for quite some time. I think it's almost like more than 3 weeks since the pause was done, and we are still waiting for the government to lift it. Although the US government has announced that they are going to lift it, but in India we have still not seen the visa interview slots open up.
Right. Now, when it comes to the social media vetting policy, over the last 2 to 3 weeks, we've seen different updates to that. One which says that switch your privacy setting from private to public, give all the social media information, all your handles from across platforms in the last 5 years to the US government. If there is anything objectionable, your visa application can be rejected. Is there any clarity on the kind of content a prospective applicant should not be putting there on social media?
Absolutely. One interesting thing to note is that this requirement is not new. Actually, if you look at the DS-160 form, which is the visa application form, the requirement to declare your social media handles has been there since 2019. But it is only now that it looks like that the US government is very serious in implementing this policy. And hence, this is the first time they have asked their students to change their profile settings to public, declare all the social media handles which they have been using for last 5 years. And what we understand is that the US consulate is looking for evidence which could be related to any potential fraud, any inconsistency in their profile, and most importantly, any post, comment or like which they would consider potential threat to national security. So students should be very careful about their posts, comments, likes, and even things like their profile names, which are going to be scrutinized for anti-Semitism, anti-US, hateful, politically motivated or threatening material.
Right. I would also like to ask you, when it comes to vetting of social media accounts, like you're saying, it's happening more aggressively right now. And there could be cases where you may be rejected. And it is also saying, the advisory is also saying that even after you get your visa, you will continuously be monitored. So even if you go to the US, you have to be very careful about what you're posting.
Absolutely, that is absolutely correct. So just because a student has got the visa successfully, it doesn't mean that this process has ended. So during their entire course of study, so right from going to the US when, for example, at the port of entry, the same questions could be asked, right? So they may still want to see your social media profiles. Some questions still could be asked. We know for a fact that some of the questions which are getting asked is, what is the student view about the Israel and Iran war? What is their view about, what do they think about America as a country, right? So these questions are getting asked. So, what is going to happen is till the time you are in the US, during that entire period, the students need to be very careful about what they are posting or commenting on or liking what kind of posts, etc. The US government is very clear that they would not allow anything which is against their declared national policy.
Right. Does this apply only to J, F and M visas, which are either exchange programs or student visas, or does it apply to all categories?
It also applies to, I would say, long-term non-immigrant categories. Like, for example, it could apply to H-1B, L-1 kind of visas also. So it's not only limited to student visas.
Right. Does the student have any recourse in case the visa is rejected? Because the advisory from the US government also says that this is a privilege, not a right.
Well, the only thing which the student can do is to reapply, right? I mean, when the US consulate rejects the visa, they would typically give a reason why the visa is rejected. So I think the students need to go and relook at their visa application, check what exactly is the reason being mentioned, and maybe take corrective action and then reapply. That is the only thing which you can do. As you rightly said, the US government is very clear that it's a privilege, not a right. So I would advise the students to be careful, do it right the first time. But in case if you unfortunately get your visa rejected, do have a relook at your profile and look at the reasons what have been mentioned and take corrective action and then reapply.
Right. My final question would be, would you now advise students who are looking to go to US to possibly consider other locations as well, considering there is a pause on fresh interviews, there is so much of social media vetting, and there is uncertainty about the visa process in India?
Well, this is again something which frankly depends on the students. There are many students, see, we actually engage with thousands of students. There are many students who are very, very clear that they want only to go to the US because of the quality of education. We all know that US has really got world-class institutions. So there are students who are very clear that they would want to go to the US only, and they are even willing to defer their intake by 1 year if need be, if they don't get visa on time. But yes, there are a certain category of students who have started thinking about other destinations, like for example going to the UK or Australia or Canada. So yes, depends on the students. There are people who are very clear about the US. There are people who are also willing to look at other destinations, considering that these other destinations also have some really world-class institutions. So we see students in both categories. We are not advising anyone not to go to the US because there are still a large number of students going to the US and things are very fine. As you know, a very large number of Indian students are currently studying in the US and things are absolutely fine with them. As long as students are not indulging in any activity which the US government thinks is breaking the rules and regulations of their visa, I think things are fine.
All right. Thank you very much, Piyush, for joining us. That's indeed an important conversation, and students should listen to this, especially if they are looking to go to US for education. Let's move on and focus on India-China relations. And we're going to look at two issues today. China has halted its specialty fertilizer shipments to India in the last 2 months, while continuing its exports to other nations. These fertilizers are crucial for enhancing yields of fruits, vegetables. Chinese officials are reportedly avoiding inspection of India-bound consignments. This has effectively blocked exports through procedures. 80% of India's requirements for these fertilizers come from China. Beijing has also restricted the export of rare earth magnets to other countries, including India. And even though China has started releasing magnets on a case-by-case basis for companies in Europe and US, they've not released any consignment of magnets for India. Now, taking this discussion on fertilizer forward, I'm now joined by Rajiv Chakrabarti, National President, Soluble Fertilizer Industry Association. Thank you so much for joining us, Rajiv Chakrabarti. Let me begin by asking you, China was always blocking the supply of specialty fertilizers, but has this now completely come to a halt? What has changed?
Thank you, Parikshit, for having me in this show. For the general understanding of the audience, I would like to give a brief introduction of specialty fertilizer in India. Specialty fertilizer is different from the subsidized fertilizer. In India, fertilizers are governed by Fertilizer Control Order. There are two categories of fertilizer. One is subsidized fertilizer. In this category, there are products like urea, DAP, SSP, and all. For these products, India is self-sufficient. For the specialty fertilizer, which is non-subsidized, there are four categories of fertilizers. One is soluble fertilizer, which is the primary nutrient supplier, the organic fertilizer, micronutrients, and biostimulants. For these fertilizers, we are dependent on external sources. India started using water-soluble fertilizer in 1993. The major recognition came in 2002 when the government listed water-soluble fertilizer in FCO, and then onwards, this revolutionary fertilizer started showing its results. It can be seen from the growth in grape cultivation and the success in grape cultivation. It's a great story that is to be narrated and it is to be followed everywhere. Now, the specialty fertilizers are some fertilizers which are actually replacing the subsidized fertilizers. So it is why it is so important, because it is very high yielding, low in residue, high in quality. It makes the fruits and vegetables exportable, longer shelf life. It is very nutrient rich, and above all, it is highly profitable for the farmers. Yes, you are correct. Right. China has been putting ban on restrictions or delaying consignments for quite some time. We as an association have been negotiating with CCPIT and other organization in China to get the supply sources stable. This time China has restricted it in a different mode, and it is very sudden. So consignments are not coming to Indian ports.
Okay. Have you taken this up with the Indian government so far? Can we also link it to the rare earth magnet issue? China, for the last 3 to 4 months, is not releasing rare earth magnets to India. This is a worldwide policy, but in India's case, they're not giving licenses at all. Have they stopped fertilizer, specialty fertilizer exports to all nations, including India? Or here, there is a specific treatment for India itself?
Earlier, there was delay for all nations, but this time, some consignments are going to other nations, but not to India. They have not issued any written explanation for this, but we have understanding that this CIQ arrangement, which is inspection arrangement in China, which is not getting approval from the Chinese authorities. So we are preparing a couple of things, because we understand that this can be a problem for the supplies. So we have been doing a lot of things at our end. I mean, approaching various other suppliers outside China, and then organizing trade fairs and direct communication with associations abroad. We are also contacting the embassies, Indian embassies overseas. They are also helping us.
Rajiv Chakrabarti, what I'd also like to understand from you, how badly are we getting impacted with the absence of these specialty fertilizers from China, which are the particular sectors within India's agricultural framework which are getting directly impacted, where production could be impacted in the next few months?
In the Kharif season, there is not much consumption of specialty fertilizer. This is the time for subsidized fertilizer only. The actual consumption starts from September onwards. So we have 3-4 months where there will be not much consumption. But then for the next season, we need stable sources of supplies. Now, about impact, what happens? These are very high yielding fertilizer. This makes the precision farming possible. So what happens when the prices of fertilizers goes up, specialty fertilizer, then farmers switch from specialty fertilizer to the traditional fertilizers like urea and DAP. This process actually decreases the yield. When the yield decreases, obviously the prices of vegetables and fruits goes up. I think this has happened in the past also. And this was one of the reasons why these tomato prices increased in 2024. The impact is like that only.
All right, so there could be a possible price increase because of low crop yields. And let's see how things will turn out over the months to come. Thank you very much, Mr. Chakrabarti, for joining us. We're taking a short break, but coming up on the other side, Defence Minister Rajnath Singh met his Chinese counterpart on the sidelines of the SCO meeting in Qingdao. The Defence Minister has also urged for bridging trust deficit between Beijing and New Delhi post the 2020 border clashes. We speak on that and much more with India's former envoy to China, Ashok Kanta, on the other side. Welcome back. Defence Minister Rajnath Singh met his Chinese counterpart Admiral Dong Jun on the sidelines of the SCO Defence Ministers meeting in Qingdao. Singh's visit was the first to China by an Indian minister since the Ladakh border standoff in 2020. The Defence Minister stressed the need for both nations to sustain a positive momentum in ties and avoid adding new complexities. He called for a permanent solution of border demarcation by rejuvenating the established mechanism on the issue. Singh also briefed his counterparts about India's Operation Sindoor against Pakistan's terror networks. The meeting took place after India refused to sign a joint statement at the SCO meeting as it diluted the country's stand on cross-border terror. This was because the document failed to mention the Pahalgam terror attack but included the Jafar Express attack in Pakistan. The meeting ended without a joint communique due to Minister Rajnath Singh's refusal to endorse the statement. Addressing the SCO meeting, Rajnath Singh reiterated India's firm stand against terror and said that peace and prosperity cannot coexist with terror. In a veiled reference to Pakistan, the Defence Minister said there should be no place for double standards at a multilateral forum. Joining me now to discuss this and more is former Indian Ambassador to China, Ashok Kanta. Ambassador Kanta, thank you very much for being with us. I'd like to begin by asking you, what is the big message that Rajnath Singh tried to send out to the Defence Minister of China on achieving de-escalation at the border?
Basically, we are reiterating a message we have been sending to China ever since we had Chinese transgressions in eastern Ladakh, leading to the status quo being disturbed. We have been conveying to them that the relationship can be taken forward on the basis that neither side will seek to unilaterally disturb the line of actual control. As you know, we have formal commitments from both sides reflected in many agreements. So Raksha Mantri was telling his counterpart, Defence Minister Dong Jun, that that's the minimum expectation from our side. As Minister of External Affairs has stated repeatedly, state of the borders reflect the state of relations. This linkage, sometimes the Chinese side does not accept, but we are quite firm on that.
And what is the current state of play at the India-China border right now in terms of larger relations? China is also putting informal economic sanctions on India with rare earth magnets.
What we have achieved after a period of sharp deterioration in relations following what happened in Eastern Ladakh in 2020, we have managed to stabilize the borders through a disengagement that has happened. But the subsequent processes of de-escalation of troops and de-induction of troops hasn't even started. So border areas are not normal at this point of time. We have heavy deployment from both sides. It's risky, which is not desirable. So that's one area we have problem. Secondly, there are a whole lot of other issues which are there. You referred to recent decisions by China to impose restrictions on export of certain items to India and others. For instance, rare earth magnets, which are very important for the auto industry. We are facing difficulties. And there are other areas where we have large dependencies on China, and China has a habit of weaponizing those dependencies. So I would say that today we have started the process of rebuilding relations, but we have a long way to go. A reset of ties is not obviously on the horizon because of problems which exists in the relationship.
We have seen Pakistan getting support from China during the Indo-Pakistan conflict. How is China challenging India in the region?
Operation Sindoor, especially the Chinese behavior during 87-hour conflict caused a lot of anxieties in India. During past conflicts in 1965, 1971, or 1999, Kargil, they had extended diplomatic support to Pakistan, but they never got involved
in the battlefield, so to say. This time, we see evidence of battlefield collusion, apart from the fact that 80% of inventory of Pakistani army now is of Chinese origin, which were deployed against us. There are other indications that Chinese were actively supporting Pakistan. For instance, Peto satellite navigation system was deployed. Possibly they were sharing satellite imagery with Pakistan. And also, one can see the element of, sort of interoperability, sharing of doctrines and tactics. So what we have today are really not two-front situation, but one front with Pakistan, reinforced by China. And looking ahead, we are worried that the Chinese will double down on their military support to Pakistan, not only through provision of military hardware, but in other ways as well.
Defence Minister Rajnath Singh did not sign the SCO declaration because it diluted India's stand on terror. What does this say about the current nature of ties between India and China?
Parichit, that illustrates, kind of problems we have in the relationship. China is the current chair of SCO and was hosting this meeting. As chair, you have a fair amount of control on the outcome document. They not only allowed reference to developments in Balochistan with certain implicit insinuations, but could not persuade Pakistan at least, or perhaps they wanted to go along with that themselves, a reference to Pahalgam. There can't be a more open and shut case of terrorism. 26 innocent persons being killed in cold blood after ascertaining their religion. This was an act of terrorism. China not going along with that was not helpful at all, as their behavior during Op Sindhu was not helpful. And I think Raksha Mantri did the right thing by conveying that they will not be part of the joint statement. And since in SCO, joint statements are based on consensus, so there is no outcome document. But let me add that this is not limited to SCO. I think there's a broader pattern of relationship where China has not been helpful to us in furtherance of our aspirations, in addressing our concerns and interests, including in our neighborhood in South Asia and now increasingly in Indian Ocean region.
All right. Thank you, Ambassador Kanta, for joining us. With that, it's a wrap on this edition of Global Eye. Thank you for watching. Goodbye.
Welcome to a special edition of Indianomics. The world is in the midst of several global skirmishes. There is the huge Middle Eastern conflict, two of them actually, in Israel and Gaza, and Israel with Iran. We also have, of course, the major global trade war going on. And today I have with me an expert who will be able to disentangle and help us understand all these skirmishes and questions far more clearly. I have with me Martin Wolf, the chief economics commentator with the Financial Times. Needs no further introduction. Just a word of thanks to the NCAR for allowing us to make this happen. Mr. Wolf has been invited here for their India Policy Forum. Thank you very much, Mr. Wolf, for joining us.
It was a great pleasure.
Well, first up, we're all fixated with July 9th. The April 2nd reciprocal tariffs took all stock markets down. Now we are just a few weeks away from July 9th when supposedly those reciprocal tariffs will reappear. Hardly any country has been able to sign anything with the United States. So should we expect another major downturn and crisis, or will it be taco?
First of all, I think the crucial thing is I don't know. And I have a very strong suspicion that nobody knows except possibly Donald Trump, and I suspect he doesn't know either. So we're making guesses. So there are things we know. It was never going to be possible. It was absolutely inconceivable that America would be able to reach deals which were concrete deals within that period. It's never happened in the history of trade policy. It normally takes years to complete a trade deal. Think of how long India and the UK have been doing it. Many, many years. The idea that you could do it with 200 countries or even 100 countries in 3 months was complete fantasy. On the other hand, I think it's also inconceivable after the tremendous shock and the relief when he withdrew these tariffs and the subsequent huge shock, the one big shock of the China trade war, which he also stopped. It seems to me inconceivable with all that's going on in the world that Mr. Trump will want to start this panic over a level of tariffs which will basically stop world trade. So my assumption is they will announce one or two successes, which will not be completed deals, but indicate things are going in the right direction, and that they are negotiating seriously. And they will say this particularly vis-a-vis important countries like India. They've already basically agreed with the UK. I suspect that will happen with the EU and a number of Japan, other important allies. And they will say, we are negotiating with these countries, will continue. I suspect they will also sort of forget about a lot of the smaller countries. They will just have a 10% tariff because that's already much higher than before. And they will never really pursue negotiations with Lesotho and all that. And so we'll just get used to the idea. These negotiations are going on. At some point, they will or will not be completed, but trade will basically go on, even though, of course, even as things are, average US protection is very important, is higher than it has been at any time since the 1940s. So it's very protectionist and it will affect world trade. But I find it inconceivable that they're going to impose or reimpose all those tariffs. So I'm relatively optimistic that peak craziness, still the cost, but peak craziness has passed.
Well, that's what the financial markets are banking. Let me first get the India questions because that's what our viewers will want to hear from you. Do you think India looks in a particularly advantageous position because of Donald Trump's and America's dislike of their dependence on China? It looks, almost axiomatic now that India may have maybe 10, 12, 15% tariffs after the negotiation, but China will be at 30, 35%.
Yeah.
It doesn't look like it will be any less than that. So does that big 20 percentage point tariff difference make India an attractive destination for textile companies, for Nike, for Adidas? Will investments come?
Yes. There's an upside and downside. Mr. Trump has reintroduced what trade policy analysts call discrimination into trade policy. And this is one of the most obvious ways in which he's broken fundamental principles of the WTO. But if you have the benefit of discrimination in your favor, That's obviously good for you. So potentially this gives India an opportunity to expand its exports of products which compete with what other developing countries can supply, and make it a more attractive base for foreign direct investment, particularly by US firms. And this is reinforced by the sense that the Trump administration and America more broadly looks more favorably on India politically than it does very clearly on China. So these are assets for India. The questions, however, are always the same. One, do outside investors find India a really attractive place to put investment? And that depends on the quality of infrastructure, the quality of labor, the way Indian legislation and labor markets works. Do they feel this India is now a place we can operate increasingly as we can in China? And I would say that's beginning, but we're not there yet. So there's the domestic base. And then, of course, the other thing is they have to say to themselves, okay, we've seen all this instability in trade policy. If we're going to set up a new factory, that's a big investment. We will need 5 to 10 years to get it back. So we don't need to know just, do we have the preference today? We have to know, how long will it last? Now there's a reasonable bet that India will be favored over this period. But trade policy can change, as we've seen. So the investors will. So the big thing that Trump has done in trade policy by breaking all the rules, he's injected profound uncertainty. What you're seeing and what you're getting here is based on the whims of one man. I would say India is in an advantageous position. It's an important country. The Americans recognize this, but you also have to recognize the president is a very impulsive and unpredictable man. So I would say you can't be completely sure of it. And that is, so that I emphasize, the fundamental resource of a developing country is its competitiveness. Relying on tariff privileges rather than being actually the least cost producer in the world, which is basically what China has become, is a bit risky, and I wouldn't push it too far.
Fair enough, things are moving in the right direction. We've seen a reduction in taxes, a reduction in interest rates, cost of capital coming down. I mean, there are several things working.
There are a lot of things that have happened. India is incomparably more competitive than it was 20 years ago. This is obvious, but that remains very important. You cannot just rely on the idea that America doesn't like China, will lock it out of its markets forever. Things can change.
Okay. Well, I must get the all-important dollar and yields question out of the way before I come and discuss China and Middle East with you. The dollar has been consistently falling, and that appears to be because of a dislike for US treasuries and the high yields. Do you think this is going to be the trend, considering that there is this big, beautiful bill, and that will mean more treasury issuance and therefore higher yields?
Well, I don't think you should just look at treasuries. The US has a very large current account deficit. The main counterpart of the deficit is the fiscal deficit. And so they are linked. Yes. What this means is there has to be a very large net purchase by the rest of the world of US assets. Now, one of the interesting things which is not much noted is in the last 10 years, foreign currency reserve accumulations have stopped. So the big expansion was from about 2000 to about 2015. So the governments of the world are no longer large net buyers of currency assets as reserves. They're buying gold very clearly. You can see that very clearly. That's diversification of their reserves. They don't want to hold, in other words, and the dollars are about 60%, slightly less. So they're basically saying, we've got enough dollars. So that means that huge deficit has to be covered by the private sector. By definition, or parastatal organizations like sovereign wealth funds in the Middle East and so forth. And they're looking for commercial return against risk. It's a slightly different thing. It's not just we must have these reserves because it's safe. They're looking for commercial turn and risks. And their problem is, given the huge deficits, there's a very considerable chance that nominal yields will rise further. They are very concerned, I think, in addition, that inflation will rise because there's a lot of pressure from Donald Trump on Mr. Powell, the Fed chairman, to lower rates when inflation is still quite high and the fiscal program that they have is considerably expansionary, so it might get worse. So that would mean that nominal yields should go up, but the Fed might fight that. And all in all, buying long-term treasuries in a country which has very high public debt, very high deficits, very high, which is funded from abroad, crucially, a third of treasuries is borrowed, owned by foreigners, it just looks risky. And then there's currency risk, exchange rate risk. So I suspect markets will be saying, we want higher yields to compensate for this risk. But then they start saying to themselves, well, if the yields go up, that makes public finances in America even worse. And then that's a vicious circle. So the sensible thing to do is we'll hold cash. We go short term. If we hold dollars, we hold short term. Then we at least can get out easily. And we can get out without paying a capital loss when we sell the bonds. And this is pretty clearly, they're being pushed to the short end of the yield curve. And that makes management of public debt in America really tricky. And it's obviously worrying the US Treasury a lot. And they're thinking, they once even said, we're going to force people to move much longer on the maturity, up to 100-year bonds, which again makes people frightened. I think we may be reaching sort of semi-satiation point from the point of view of global investors in long-term US Treasury debt because it's too risky, and raising the yields doesn't get rid of the risk, it just shifts the nature of the risk. And that's not a very good bargain. So I think US fiscal policy and monetary policy, given their external dependence, is at a very vulnerable state.
Welcome back to Indianomics. I've been speaking with a very special guest, Martin Wolf, Chief Economics Commentator at the Financial Times, brought to us thanks to NCAR. Thank you very much, Mr. Wolf, for your patience. Well, de-dollarization, you raised that issue. Will it really happen? I mean, is there an option? Is there an alternative?
I don't think de-dollarization per se is possible. I think two things are going. First of all, I think we've reached satiation, and this is
in terms of U.S. bonds.
In the U.S., that people don't want to hold these colossal foreign currency reserves. It is important to remember that foreign currency reserves are very high now. People had terrible shock in the Asian financial crisis, global financial crisis. They decided we need the insurance of dollar reserves and more broadly currency reserves. They went into a whole slew of currency reserves, mostly with the US and European and US allies. Remember, the other main issuers of reserves are US allies, particularly the euro, but also sterling, yen, and so forth. Now, people bought these and they seem to feel we've got enough of that, and I think that's perfectly reasonable. They have been made aware there are risks, particularly with the US. There are sanctions. Look at what's happened to Russian reserves. They know that if they rely on US dollar assets, it means they also rely on US financial markets, which the Americans can close. So these aren't riskless. You want reserves to be riskless. So the reserves themselves will be less important, but the dollar will remain the dominant one unless they go completely crazy. But in the longer term, there are other aspects, which is what currencies you use for transactions. And there I think the dollar is overwhelmingly dominant in transactions. But it is possible people will start wanting to diversify and do more of their transactions in other currencies because they might feel that the sanctions are less likely to bite. I think it's inconceivable to my mind that cryptocurrencies will replace any of the major currencies because they're not really usable. And stable coins, which people are talking about, are basically just repackaging of fiat currency. So that doesn't really change anything very much. So the idea that there are some very complex and subtle things going on, but for the foreseeable future, the dominant currencies in the world will be those of the US and its allies. And it's very difficult for me to see anything that will change that. But people will stop increasing their holdings because they do look risky. They will try and economize on reserves, and the world will become simply messier.
Okay. Well, now let me come to China. Because this is an under-discussed problem, the Chinese have raised the threat of rare earth magnets and said that they will not, they're holding the world to ransom. Yeah. They can do that with other things, and I understand lately they're doing it with some specialized chemical fertilizers as well. They could increase this. Is this an underappreciated threat that can disrupt economic growth and trade?
Well, it's obviously a salient way of engaging in a trade war. And what they've said to the Americans is we have weapons too. Of course, it's a double-edged weapon because it tells people we can't rely on China. I understand that it is possible, perfectly possible, I'm not an expert, to do the rare earth excavation. They exist elsewhere. It's a huge investment. But if the Chinese make themselves sufficiently unreliable, the rest of the world will invest it and make their own investments in these lots of deposits, as I understand it, in Africa and other major countries. So it's quite risky for China to do this, but it will reinforce the idea, which is, I think, going to be very important in the trade issue, more broadly, to discuss that we have to guarantee our security. And that implies that we can make the things that are vital for our security and we can get the raw materials. So the Chinese have a real danger here, threat to them, if they pursue this tactic. And what's going to happen, I think, in future is they won't push this to the limit. They will be careful. because they really don't want to be at a trade war with everybody. But everybody is going to pay a price to get greater self-sufficiency in those products and processes that they come to think are vital to their economic and military security. The crucial point here, the big point is, there is a breakdown of confidence among the and trust in the major players among themselves, particularly between the US and the Europeans and far more the Chinese, and that's not going away. By the way, that is another opportunity for India.
Yes. Okay, I'll come to that in just a minute. The Middle Eastern part, one of the things that stood out among all the the skirmishes, the conflicts and the bombing, is that crude price didn't rise so much. It was $78 for a day. Otherwise, it's gone below 70. Is the world a little more Middle East crude proof?
I think the answer is no and yes. If there were, this is the guess. I mean, in terms of crude oil reserves, the Middle East remains the dominant place. My understanding is about 40%. So it's a colossal reserves. Secondly, about 30% of world oil, transport oil, goes through the Straits of Hormuz. Now, if there was a war which started blowing up the oil fields, and if you remember the Kuwait war back in the early 90s, they did blow them up, and it was quite disruptive, and that's one of the reasons there was this huge
surge in crude prices,
and the huge battle to get them out of Kuwait, the war. If that happened, then of course the oil price would go through the roof. And though oil is not as important to the world economy as it was in the 70s, oil intensity is roughly halved, it's still very important. So the world is not crude oil proof. I'm talking about Middle Eastern crude oil. It's too important, and if it were really disrupted, it would be a big problem.
India has become the fourth largest economy and will hopefully become third very soon. And there is this conflict between US and China giving India a little more elbow room. How do you see India's place in what you call the new world disorder?
Well, my view is, I've thought ever since I first worked on India back in the 1970s when I worked for the World Bank as senior economist in the India division, 80% of what happens to India, because it's so big, and depends on what Indians do. So if you make the right policy decisions, make the economy work better, use your human resources better, India should thrive. Unless something unbelievably horrific happens, global thermonuclear war, or you get involved in a major nuclear war with a country I won't mention. Leave that aside. So it's important to remember the outside world is not decisive. But there's also no question, if you look at India's experience, particularly since the reforms of the early 90s, that opening yourself to the world, opening yourselves up to FDI, becoming a major export hub, beginning to industrial, all these are going to be very, very important. And I do think that relative to most other countries, because of your scale, so I think there's a relationship. But crucially, the West as a whole views India as a friendly country. There are now very strong cultural links, because there are lots of Indians everywhere. And that very much includes the Americans. Mr. Trump and Mr. Modi get on, which is probably not insignificant in this regard. And so it seems to me that India can probably thrive reasonably well in this much more difficult world, because it's going to be favored over others, and it has opportunities that are bigger than others, and it does have a domestic market again which will help it. So I think that the world shouldn't be a problem for it. India has a bit of an opportunity here to be a leader, in the sense it's not a part of the Western Bloc. It's obviously not part of the Chinese bloc. It's very, very respected by the countries of the South. It, I think, could, for instance, say, and it's one of my particular proposal, okay, we will have deals with the US, but any deal we offer the US, we'll offer to everybody. we are going to continue with non-discrimination. We are a friendly country. We're not going to privilege the US over Europe or over Africa or anywhere else. We are a friendly country open to the world. And I think India, that's a suitable role for India. I think it would be a credible role. I think it would have influence on the world. And I think it would also be good for India. I still think growth can be 8%. But there's one final comment, which is important. The world economy is now growing at 2 to 3%. India wants to grow at 6, 7, 8%. In other words, much faster than the world economy. You don't want your trade to shrink relative to your GDP. The evidence is that tends to be bad for growth. That means your exports have to grow 7, 8% a year when the world market is growing at 3%. That means you need to become ever more competitive. If you don't make that happen, it will be difficult to sustain the growth you want. And I think growth could well slow to 4 or 5%, which is very clearly not what the Indian people or the Indian government wants. So that has to be understood. There is no future, I think, in which India becomes a developed country if it becomes ever more closed. That's the experience. The challenge of growing much faster than the world when you're a country as big as this is quite a considerable challenge, as the Chinese have been discovering.
Most useful.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty up 2% this week after a strong rally on Friday. The Nifty is now just over 2% away from its record highs. Crude oil prices are down 10% this week, the biggest 5-day decline in 2 years. JSW Paints set to acquire Akzo Nobel's India business by shelling out 9,400 crore rupees. The deal will make JSW the fourth largest player in the highly competitive paints industry. CNBC-TV18 reported last month that the deal will be signed by the end of June. Axis Bank executive Rajiv Anand leads the race to become the next CEO of IndusInd Bank. Sources say Anup Saha of Bajaj Finance and Rahul Shukla of HDFC Bank are also in the running. That's an exclusive. US and China agree on a trade deal framework. Beijing will allow rare earth exports after review. US will ease the rules restricting high-tech exports to China.
But we're having some great deals. We have one coming up, maybe with India, very big one, where we're going to open up India.
President Trump teases a big trade deal with India ahead of the July 9 tariff deadline, but the Indian government sources tell us no consensus yet on steel, agriculture and automobile tariffs. India's chief negotiator Rajesh Agarwal is in the US for talks. The Union Cabinet is likely to have waived spectrum dues worth 6 lakh crore rupees. Sources say the waiver will only apply to government departments like Defence, Railways and Space. No waiver for PSUs and private players. Tata Power plans to expand electricity distribution across Maharashtra, seeks licenses across key regions, including parts of Mumbai, Pune and Nasik. Fintech unicorn Pine Labs files for an IPO worth 2,600 crore rupees. Existing investors include PayPal and MasterCard will offload stake as the company eyes a valuation of $6 billion. Well, let's go straight to the market action. Benchmark indices recording gains for the second straight week. The Sensex and the Nifty ended the week 2% higher. Broader markets outperformed with the Nifty small cap index up by 4%. So that's the Sensex for you, up by about 2% and a 2% gain coming in for the Nifty as well. The Nifty ending above 25,600 and it's now about 2% away from a record high. The Nifty Bank, meanwhile, also touching a fresh record high, closing above 57,400 for the first time. So strong close there for our markets this Friday afternoon. From equity markets to the commodity markets, prices of crude oil falling over 10% this week, registering the worst decline in over 2 years. Fears of supply disruptions in the Middle East have eased. However, oil prices markedly corrected today due to higher fuel demand in the US. But let's go straight to the big story we told you first, and it is now official. JSW Paints is set to acquire Akzo Nobel's India business in a deal worth 9,400 crore rupees. The deal will make JSW the fourth largest player in the highly competitive paints industry. Shares of Akzo Nobel surging after JSW announced an open offer at a 16% premium. Rachna is here with more. Rachna.
It is a CNBC-TV18 news break confirmed. JSW Paints has officially sealed the deal to acquire a 74.76% stake in Akzo Nobel India. Now, this is for 9,400 crore rupees at 2,762 rupees per share. That's a 16% discount to market price, as we had indicated earlier. Now, sources have told CNBC-TV18 that the deal would be funded through two ways. First, where 2,000 crore rupees would be coming in equity from the Jindal family, backed by stake and asset sales, while the remaining 7,000 crore rupees will be in form of debt and structured credit, including financing from global institutions. But before the deal can go through, there are a few crucial steps left, starting with a mandatory open offer. Under SEBI rules, any acquirer picking up more than 25% stake in a listed company has to make an open offer to public shareholders. In this case, JSW Paints will offer to buy up to 26% more of Akzo Nobel India at 3,417 rupees per share. That's a significant premium to current market price. Now, post-merger, JSW Paints will have a production capacity between 4,70,000 to 5,20,000 KL per annum, blending JSW Paints' Vasind and Vijayanagar units with Akzo Nobel's plants in Gwalior, Bangalore, Mohali and Hyderabad. The employee headcount is also expected to be around 3,500 people and an estimated revenue of over 5,000 crore rupees in 2025. This is well in line with their FY26 growth targets. Now, with a 9 to 10% share in the decorative paints market and becoming the second largest in industrial coatings, this move makes JSW Paints the new number 4 player in India's paint landscape. A transformative step and a bold bet by Parth Jindal to build what he calls the paint company of the future. But it was earlier this year in Davos where he had said that he would do anything to get this deal. Here's what he said.
I think there's no choice. If JSW and the ambitions we've shown that we want to be a top 3 player in whichever sector we play in, if I have to do that, then I have to give it everything that I've got for Akzo.
How will you fund it?
It's going to be a mix of the family investing, and private equity.
Well, that's Parth Jindal speaking to me on going after Akzo Nobel, and today the deal has been closed. Now, paint stocks traded with gains after that announcement came in. How does all of this change the dynamics of the sector? Mangalam is standing by with the details. Mangalam, hugely competitive already with the entry of Birla and now JSW.
Let's start with, JSW Paints acquiring Akzo Nobel at close to around 2,700 rupees per share for the promoter stake. 3,400 rupees, 3,417 rupees per share is what they've allowed for an open offer as well. But on Akzo Nobel, they're the fourth largest paint company in India. They're the makers of Dulux paints, and nearly 35% of their revenue comes in from decorative business as well. They have a high market share in the premium end of segment. Whereas JSW Paints, if you look at it, they've been in the market for over 6 years. FY24 is when they crossed that 2,000 crore revenue mark. FY25, they had a target of 3,000 crores. In FY26, 5,000 crores. All of this organically. Remember, 60% of their revenue comes in from intergroup business. So that's something we'll have to talk. If you look at the paint industry, the top two players have over 50% market share. Asian Paints last year did over 34,000 crores in terms of revenue. Berger, 11,500 crores. Kansai, 7,800 crores. Akzo Nobel stands in here. Add another 2,000 crores of JSW Paints. It becomes a 6,000 crore player on the whole. The paint industry worth nearly 80,000 crores right now. 65,000 crores is organized, expected to grow anywhere between 12 to 13%, with the market share of top two players being over 50%, and that's what the conglomerates are eyeing. What is it that helps in, the business to grow? Birla Opus launched last year itself. They have high single-digit market cap and market share rather, and 900 to 1,200 crore in terms of quarterly run rate. Can they continue this business or not? They have a stated target of 10,000 crores in terms of revenue and EBITDA break-even by year 3 of complete operations. What is it that the incumbents will need to do? Focus on distribution, brand, tinting machines, and capacity. Capacity, the least of them all. First 3 is most important. What everyone will be looking at, how the incumbents and disruptors expand, whether there would be margin contraction in the industry or not, and eventually valuation multiples. Are we likely to see another derating once this disruption comes by or not? All of that depends on what Akzo Nobel and JSW together do. We'll be tracking growth for JSW Paints along with Akzo Nobel, ex their own group, revenues. Secondly, how much more will they invest in capacity, branding and distribution? And thirdly, from a listed company standpoint, will they list JSW Paints business via reverse merger, or will there be an IPO for JSW Paints itself or not? Paint stocks have seen a correction of almost 30-35% from the peak. Asian Paints at some point was trading over 60 times, now at 45 times. Berger Paints 40 times. So there has been one leg of valuation multiple derating that has taken place.
Changes much, because these two players, as you rightly said, have been there in India already. Both JSW and Akzo have been operating in this market. We are more or less aware of their strengths and weaknesses, and we know what they are doing in the marketplace. So it's just a change of hands, possibly a change, in the management style that it is operating in. So from that perspective, there might be some small changes, but overall in the industry, nothing changes much. What does happen is that there is a consolidation which is happening now. So there are now 5 players in the industry. The top 2, Asian and Berger, remains. The 3rd, 4th, and 5th position is up for grabs, and that's where the competition will be intensifying a bit. Between Birla, JSW plus Akzo and Kansai.
Well, that's Berger Paints on the changes that we're seeing in India's paint market. On to a CNBC-TV18 exclusive. Axis Bank's Deputy Managing Director, Rajiv Anand, is a strong contender to take over as IndusInd Bank CEO. Sources tell us that 2 other finance executives are also in the reckoning. Ritu is here with more. Rajiv Anand, and who else, Ritu, the likely contenders to take over at IndusInd Bank?
Well, the big question for IndusInd Bank right now is who takes charge as the next CEO, someone who can clean up the books, restore trust, and steady the ship after months of turmoil. And our sources tell us that the bank's board is actively considering 3 contenders, and that includes Rajiv Anand from Axis Bank, Anup Saha from Bajaj Finance, and Rahul Shukla of HDFC Bank. Let's start with Rajiv Anand, who's got more than 35 years of experience. He's been with Axis since 2009 and served on the bank's board since 2013. And as the Deputy MD, he's led the wholesale and digital banking portfolio. But here's the key detail. Rajiv Anand has announced his retirement from Axis Bank and he's set to step down in early August, making him available to take charge at IndusInd if selected. Now, our sources point out he is indeed a strong contender for the job. Next up, Anup Saha, again 32 years of experience, 25 years in financial services, including 14 years at ICICI Bank. He's led everything from credit cards to mortgages, auto loans and structured finance. He's been with Bajaj Finance since 2017 and was very recently elevated to the position of MD. Finally, Rahul Shukla, more than 30 years of experience, began his career at Citibank and then joined HDFC Bank in 2018, where he oversaw corporate banking first and now heads the commercial and rural banking division, but is currently on a sabbatical. Now, while all three of these contenders are under consideration, our sources say the bank is looking more keenly at Rajiv Anand and Anup Saha. Now, remember, the Reserve Bank of India has asked the bank's board to submit the final list of names by end of June. Now, while the board has held informal discussions with RBI, we understand that the names have yet to be formally submitted. Now, typically, RBI takes anywhere between 4 to 8 weeks, sometimes even longer, to approve the bank CEO names. But in this case, it's not the usual case. We've seen a string of top-level exits, accounting lapses, irregularities come to light with a leadership vacuum at the moment. And so our sources indicate this appointment could be fast-tracked.
All right, Ritu, many thanks for joining us. The big global story: China has confirmed details of a trade framework with the US that seeks to allow rare earth exports and the easing of tech restrictions by the US. Beijing says it will allow the export of rare earth magnets to the US after review. On the other hand, the US will cancel a range of existing restrictive measures imposed against Beijing, including tech exports. With this, both nations have agreed to implement the framework that they agreed to in Geneva a couple of months ago. President Trump confirmed the agreement with China. He also teased a big trade deal with India, which he claimed will open up the country. All of this comes ahead of the July 9 deadline, when the 26% reciprocal tariffs are scheduled to kick in.
But we're not going to make deals with everybody. Some we're just going to send them a letter, say, thank you very much. You're going to pay 25, 35, 45%. That's the easy way to do it. And my people don't want to do it that way. They want to do some of it, but they want to make more deals than I would do. But we're having some great deals. We have one coming up, maybe with India, very big one, where we're going to open up India. In the China deal, we're starting to open up China, things that never really could have happened. And the relationship with every country has been very good.
Well, that's Donald Trump. Even as the US president teases a big trade deal with India, government sources say some hurdles remain. There is no consensus yet on steel, agriculture and automobile tariffs. Parikshit is standing by with the details. Parikshit, India's chief negotiator currently in the US, the 9th July deadline looms large. What's the latest now on the talks?
India and US are discussing an early harvest deal which will cover $100 to $150 billion worth of goods traded between the two nations. But there is no agreement on critical areas just yet, and India's top negotiator Rajesh Agarwal is visiting the United States again for talks. India and the United States are yet to come to an agreement on steel, agriculture and automobile tariffs. Sources say the US-India early harvest deal cannot and won't be a one-way street because both sides will have to win. Where are things stuck? Well, India wants an exemption from 50% duty on steel imports imposed by the United States. But America is unlikely to give a concession to India here. Differences still remain on tariffs on automobile components. Also, US wants access not just for American cars, but large, heavy-duty trucks as well. US wants more access in agriculture and dairy, but India cannot allow US dairy and meat products as American farmers use blood meal as food supplement for livestock. India is also unlikely to allow any genetically modified crops into the country. The US is likely to maintain a 10% baseline tariff on Indian exports even if a deal happens. And if that is the scenario, India would impose a 10% tariff on American goods as well. India also wants tariffs on labor-intensive products to be reduced to zero. Government sources believe that there will be at least 100 product lines where tariffs may be reduced to low single digits or even zero. United States may impose zero tariffs on imports of some labor-intensive goods from India. This may be through a fixed quota of goods to be imported at lower tariffs and anything beyond that to be subjected to higher tariffs. US and India are looking to conclude an early trade deal before the 9th of July. Indian officials have said that there will be no compromise on national interest and the country is not desperate for a trade deal. Experts have said that India should not be worried about reciprocal tariffs in case a deal is not struck before the 9th of July.
All right, many thanks, Parikshit. Now, the White House has indicated that President Trump could extend the July 9 tariff deadline. Press Secretary Karen Leavitt said the date is not critical and could be extended at the president's discretion.
The deadline is not critical. The president can simply provide these countries with a deal if they refuse to make us one by the deadline. And that means the president can pick a reciprocal tariff rate that he believes is advantageous for the United States and for the American worker. And he will continue to do that.
Well, while the press secretary hinted at an extension, U.S. Commerce Secretary Howard Lutnick insisted that July 9th will be the deadline for reciprocal tariffs to kick in. So mixed messages coming in from the White House. Now, the U.S. Embassy in India has cautioned visa applicants against omitting social media information, saying it could lead to visa denial and future ineligibility. Now, social media posts by the embassy reminded visa applicants that they have to list their social media handles used in the last 5 years. The U.S. State Department has referred to each visa adjudication as a national security decision. Applications for students and exchange visas have also been asked to make their social media profiles public for vetting. The Union Cabinet is likely to have waived spectrum dues worth 6 lakh crore rupees. Sources say the waiver will only apply to government departments like the Department of Defence, Railways and Space. Ashmit is standing by with the details. Ashmit, so just to be clear, there's no waiver for PSUs and certainly no waivers for private players. What has been cleared by Cabinet?
Well, just the term spectrum waiver, it sparks a lot of interest. But again, that's an important clarification that you gave, that this is not for PSUs, this is not for private players. This waiver that has come from the cabinet, what sources tell us, is strictly and strictly for only government departments. Bear in mind, departments such as the likes of Defence, Space, INB, Railway are allocated spectrum on an administrative basis for their operations, for their communication requirements. The spectrum is allocated by the DOT, and therefore, as a result, they're required to pay the spectrum dues in question. Now, these dues date back to early 2000s, and because of non-payment, had swelled on account of interest, on account of penalty components compounding over the very many years, swelled to north of 6 lakh crore rupees. And that is the question that was put before the cabinet. One government department having to pay the other. The wisdom was seen by the cabinet that given that this is a situation where the left hand appears to be paying the right, the wisdom was seen by the cabinet to grant a waiver. This waiver, again, to clarify, is meant for these government departments for their spectrum dues on account of their interest and penalty components. Now we're given to understand that after this relaxation, they'll only be required to pay a minimal interest burden as well as the principal component. That is the main charge that has now been approved by the cabinet. But again, to reiterate, this is purely and purely for government departments, the likes of Defence, Space, Railways and INB, not for PSUs and definitely not for private players.
Finance Minister Nirmala Sitharaman met with the heads of public sector banks today. The FM urged bankers to lend more and step up credit momentum. Government wants PSU banks to report higher credit growth this fiscal compared to the last year. The nudge from government to lend more comes after the RBI asked all banks to ensure 50 basis point rate cuts are passed on to consumers. Well, the 12,500 crore rupee IPO of HDB Financial Services has been oversubscribed on final day of bidding. As of 4 p.m, the HDFC Bank subsidiary issue was subscribed by more than 15 times. The retail portion was also fully subscribed with a bidding of 1.3 times. The portion reserved for qualified institutional buyers led the demand with a subscription of 51 times, while the portion of non-institutional investors was subscribed nearly 10 times. Fintech unicorn Pine Labs is gearing up to go public. The company has filed papers with SEBI for a 2,600 crore rupee IPO, offering a valuation of $6 billion. Existing investors like PayPal, MasterCard and Peak 15 will sell shares in the IPO. Tata Power is planning to expand electricity distribution across Maharashtra. The company has sought licenses across key growth regions, including parts of Mumbai, Pune and Nasik. This comes days after Torrent Power received initial approval for distribution in Maharashtra. Vivek joins us now to tell us more. Vivek.
Well, a couple of days earlier, we had highlighted about how you could see the entire landscape of the power sector as well as power supply in Maharashtra change. We told you about how Torrent Power was looking to get a parallel license as far as distribution of power in Maharashtra was concerned. Well, hot on the heels of that, Tata Power too is looking to enter the parallel electricity distribution sector in Maharashtra. They've applied to MERC, which is the Maharashtra Electricity Regulatory Commission, for operating parallel electricity distribution in 10 areas. What does this mean both for power producers, power companies as well as customers? Well, for power companies, it's quite simple. It opens up a new stream of revenue, while for customers, it opens up competition, indicating that you could see more choices when it comes to who you buy power from and hopefully also lower tariffs. Now, what is a Tata Power spokesperson telling us? Well, they are saying that the total customer base that the company currently has is at close to 12.8 million across Mumbai, Delhi, Odisha as well as Ajmer discoms, and they say that in case they do get these 10 areas of Maharashtra as well, they would be able to cross the 15 million consumer mark. Clearly, a positive development in case this fructifies as far as Tata Power as well as Torrent Power, if it does happen. What do analysts say? Well, analysts say that number one, this particular development is quite a new development as far as the power landscape in India is concerned. In fact, Bernstein says that these companies will have to compete with state discoms. And remember, they will also have to set up their own infrastructure. They will not be able to use the existing infrastructure for which they will have to incur capex. However, remember, power is a regulated sector, and any kind of capex that companies incur where there is an equity portion of 30% and 70% is debt. On the 30% equity portion, they will receive an assured return in the range of 15.5% to 16%, which indicates, again, a fixed income stream as far as power companies are concerned. Remember, companies will also need to tie up new contracts for receiving supply of power, either from their own arms or from other arms that are active as far as states are concerned. However, remember, given the high increase as far as renewable energy production is concerned, power companies now are able to source power at much lower costs.
Vivek, many thanks for joining us. And with that, it is time for us to wrap up this edition of Business 360. Do stay tuned to CNBC-TV18. We've got plenty more coming up right after this short break. We're back in a moment. Hello and welcome to the 12th edition of Voices from the Valley. I'm Shireen Bhan. Well, a couple of things haven't changed. The focus on AI continues, but what is different in its nuancing? It's a focus on launches and partnerships. To announce a launch and a partnership here on Voices from the Valley, we have two gentlemen, Umesh and Prasad. Many thanks for joining us. Unifor and KPMG coming together. It's an unusual partnership. Umesh, let's start by talking about that.
Well, first of all, welcome back to Silicon Valley, Shireen.
It's good to be back.
Every year it's great to have you here. Like you mentioned, you know, AI is appending everything that we know to be true about the business, about the world of enterprise. And that also includes business models of traditional and legacy businesses, including our customers and partners. If you think deeply about it, it's not too unusual for KPMG and Unifor. Unifor is an innovation leader. We've been pioneering developing an AI platform, which we now call the Business AI Cloud.
Yeah.
And the power of that platform is to deliver real business outcomes, automation, disruption within the enterprise. But that requires advisory, change management, hand-holding the customer on how do they think differently now. Where they used to think headcount and human capital, now they're thinking headcount, human capital, plus AI agents. And KPMG as a partner is perfectly suited. They understand my customer's domain. They know their internal business process. And as KPMG itself is looking to transform its current business model, this partnership is a very natural coming together of a consulting leader and an AI innovation leader.
Well, you know, consulting leader and an AI innovation leader coming together. What does it mean to start with for KPMG? But more importantly, what is it that you're hearing from your clients at this point in time and how they would like to use the Business Cloud AI?
Yeah, very symbiotic relationship. KPMG, as you know, 120-year-old firm, multi-dimensional in its services, audit, tax, advisory. And with AI and the advent of AI, we fully recognize that the market is shifting, that the profession of professional services as we know it is shifting, and clients are expecting us to bring technology-embedded solutions to bear.
Right.
The old days of just purely man-hours services followed by PowerPoints and stuff like that is shifting to a much more AI-enabled service.
Yeah.
And we recognize that our core assets are really our knowledge, our intelligence, our experience of having worked with clients across the world for over 100 years. And so we want to focus on harnessing that knowledge. And what we need is technology partnerships that can help us bring that to life.
Right.
And so that's where I think we started working with Unifor
to speak. I mean, give us an example of what you've been able to do already for KPMG, for instance.
So if you think about a typical customer engagement, whether it's an insurance customer, a telecom customer, or an oil and gas customer, every of these enterprises is looking at the power of generative AI, these power of large language models or small language models, AI agents, to change and transform their internal operations. If you think about it in the past, how KPMG had engaged with these clients was deeply understand each business process, find optimization opportunities, and send their industry experts within that enterprise to drive that transformation. Prasad just said KPMG is a knowledge company now.
Yeah.
Here's what that means. If you think about the over 2,000 partners that KPMG has, each one of them have so much knowledge embedded in their mind, in their documents, and using the Unifor platform, a firm like KPMG can now capture that knowledge from the minds of people into a small language model.
Okay.
They can fine-tune their own branded KPMG small language model for oil and gas, KPMG small language model for insurance. And now as KPMG approaches their clients, it's now saying that, look, I have this asset, I have this intellectual property in the form of a small language model. KPMG experts have worked on it. We worked with a tech partner called Unifor.
Yeah.
We've developed AI agents. And so we now think there are 7 or 8 processes in your company that are ready for disruption. We can give you efficiency. And by the way, KPMG.
But what does it mean in terms of what Umesh spoke of, in terms of rewiring and re-engineering the KPMG business model?
Yeah, I mean, at the heart of it, it is 2 shifts, right? One is what I first said about the shift towards a what's now popularly known as services software, which is using AI and delivering your services through AI. That's one major shift we've seen. The other shift is, as a result of AI, customers are expecting us to really drive towards the broader outcomes that they're looking for. You know, when you think about, let's say, pick a finance process and you want to bring AI to your AP and AR processing, that is not the outcome. That's only a part of the outcome. The real outcome they're looking for is improvement of their DSO. So broader outcomes where we have the kind of expertise and the scale and the industry knowledge to bring multidimensional sort of expertise to go solve for those outcomes, that's a big shift that we're seeing. So combine that with the shift towards AI-centric delivery models, AI-leveraged delivery models with driving broader and more ambitious outcomes using AI agents. That's where it's headed.
Now, as you look at the clients that you're working with, is the plumbing in place, or you know, where are we on that level? And in terms of the latency and the catch-up, I mean, what is the distance to cover at this point in time?
So both very important things, Shireen, that you're driving this conversation towards. Let's think about the plumbing. Unifor has seen very rapid growth in new customers in the last 12 months. We now serve close to 2,000 enterprises. Approximately 300
and how many customers did you add over the year?
So about 600 in just 1 year. And about 300 of our customer base are part of Fortune 500. So these are big banks, big telecom firms, not just in the US, but Europe, Middle East, etc. What are we hearing from them? The number one impediment of getting these AI initiatives working at scale is the data bottleneck. So despite big investments in data infrastructure, data lakes, ETL tools, chief data officers still feel like their data is fragmented. It's not ready for AI. And so the first thing that we wanted to solve with our latest business AI cloud is to make it easy for CIOs to say, look, data could be in hundreds of systems. We recognize that if you're a company which is more than 10 years old, your data infrastructure is probably not the most sophisticated, and so we'll make it easy for you. Our technology automates that. What's the number two thing we've heard? Is that, look, there's hyperscalers, there's these cloud companies who are giving us AI platforms, but AI sovereignty is a huge concern for these large companies. Where is my data? Which cloud can I or can I not run my AI stack? And by the way, I need to have the option. I could move from cloud A to cloud B, or now on-premise is back in vogue. So the fact that the Unifor Business AI Cloud is completely sovereign. You can run it on-premise, you can run it on any of the clouds, and that gives you complete optionality. Now let's talk about if you were to solve these big structural issues for the CIOs and get the AI platforms embedded into these enterprises. Why aren't they scaling fast enough? And we've come to realize, like has been the case in many tech transitions, IT usually takes the lead in choosing the platform, putting it in place, getting security right. But until business users start to innovate very fast with these platforms, the real adoption doesn't take place. And again, a testament to our partnership. As we partnered with KPMG, we initially would show up with a lot of concepts of prompt engineering, let's fine-tune your models, only to realize that the partners and associates at KPMG don't speak this language. So our platform had to get simplified, and the user interface we almost had to think about a consumer AI lens with our platform. So we are in the era of ChatGPT. We added a whole natural language interface. So don't worry about coding. Don't worry about prompt engineering. Don't worry about using the words fine-tune this model. Just give a goal to the AI platform that I'm an expert in insurance. I'm looking to automate the claims process. For you to be an expert as an AI agent in claims process, read up our company policy, read up regulation, and tell me when you're ready. Think as simple an interface as that. We call it the business AI user interface. To make it ready for the partners of KPMG to start innovating, so that the partners are not waiting for a person from Unifor to show up and say, what do you need? I'll code it. So the simplification for business users is a huge focus of what we are driving here.
So Umesh, weigh in on this. What are we talking about in terms of spends today? Is there wait and watch? Is it still pause, or is there in fact a sense of urgency to say, hey, if we miss the bus, then we're going to be out of the race?
So look, if you think across the globe and from a geography perspective, it's clear that North America is in the lead. There is no doubt. In fact, it seems to us as we do global business that America is about 12 months ahead of their European counterparts. Europe is beginning to get to the bandwagon, but it seems like they're a year behind in experimentation and POC.
And what about markets like India?
So let's look at Asia more broadly first. Middle East, as we know, is making big moves. They're not taking baby steps here. There are big moves, and we should talk about what's happening in the Middle East.
Yeah, tell me what's happening in the Middle East.
Well, look, I think there's a very concerted effort, certainly between UAE and Saudi Arabia. Those two countries, they are determined to not miss the AI wave and make this an alternate revenue source in coming years to oil and gas. And how are they doing it? Saudi Arabia has announced this company called Humane, which is the national AI champion. There's G42 in UAE. Every major AI player from Silicon Valley are part of that ecosystem. So is Unifor associated with Humane. And we're now beginning to see American companies invest in Humane, which is reverse. People used to think about going to that region when you need capital. We've seen now announcements with AMD and Cisco investing and becoming shareholders of Humane. Because what those countries are saying is not only are we going to be consumers of the chips, the models, and the application
But
layer,
we're also going to drive innovation.
we're driving innovation, and we want American companies to become a revenue source. So we're going to innovate on business models together. And I think let's make this real. We're talking a lot about partnerships and things like that. With KPMG, we are now getting live with one of their Fortune 100 clients on a use case that, as Unifor, as an innovation company, we would have never imagined. This is a procurement use case. There are billions of dollars being lost in contracting in these companies. And so KPMG is associated with some of these large organizations in driving that efficiency. We have now trained small language models and AI agents that are going to ease out this procurement contracting process. KPMG has branded that product Contract IQ. This now becomes a horizontal product that KPMG is ready to sell to oil and gas companies, to telecom companies across the board.
So that's the ancillary revenue kicker that he was talking about.
There you go, new business models. And all of this needs compute to run. We have a massive shortage of compute in America already. We are beginning to sense shortage in Europe because these use cases require so much compute. And that's where the Middle East, with their big data centers, are raising their hand and say, look, we have compute. And we are willing to lease it out at competitive rates. So it's becoming a global ecosystem. And I think geopolitically, the countries that are going to get aligned to America will play in one ecosystem, and we'll see another ecosystem getting aligned to China. And hopefully, India stays in the West camp here.
Well, that certainly seems to be the case at this point in time. We're not engaging with China on any of these issues, and of course we do have the ISET in place with the US to work on emerging and critical technologies. But Umesh, you talked about, and I think both of you emphasized what's happening on the small language models as well as on the agent side. And I think so much of the focus and the attention has been consumed by the large language models and what's happening there, and how this is the sort of magic wand and the silver bullet. But take me through what you're seeing actually happen on the impact and the implications of putting these small language models to use. What are you seeing today on the ground?
Well, first, let's talk about large language model versus a small language model. A large language model, it could be an 80 billion parameter model that a Llama has released or OpenAI has released. And a small language model is a 7 or 8 billion parameter model. First of all, the cost difference is about 100 to run a token of a large language model versus a small language model. 100 times the difference of inferencing cost, right? So that's significant. As we look across our 2,000 customers and we think about all possible use cases, automating customer support, automating marketing, automating back office, we are yet to come across a single credible use case that will need a large language model. So these small language models are perfectly equipped to deliver big ROI and big business outcomes within the enterprise. Then we should ask, why do these large language models exist? They exist for big consumer application like search, like what Perplexity and Google are going after, or ChatGPT is solving. And that's where the big innovation is, or self-driving cars by Tesla.
Yeah.
So when it comes to business AI, small language models are absolutely winning the architecture game. All right. Now within that, let's take a few more examples. An insurance company in the US by regulation needs to have, if you were to file a claim of health insurance, it has to go through 3 executives of the company who have to study the claims, your ECG reports, doctor's reports, and say approved or disapproved. And by regulation, a human being has to sign the final yes or no. AI agents now are capable of running this entire approval chain without a human in the loop and only give it to the final signatory to say, we've checked everything, this is either yes or no, right? Now think about an insurance company in US that's processing hundreds and thousands of claims every month. The efficiency that they are beginning to already experience in one process, which is claims. Customer retention. People have run for years analytics and cohorts and customer churn behavior and this and that. These small language models are really good at learning everything about customer behavior and predicting a pattern. And now an AI agent could say, I think so-and-so customer might be at the risk of churning, so I'm proactively giving them a discount package to keep them in the loop. So just productivity gains across the board is what we are beginning to see in our customer base.
So give me some numbers that help our viewers understand the context of what we're talking about, Umesh. As we look at these transformations that are already taking place and are on the cusp of taking place, what is the size of this market opportunity in the next few years? You know, we just talked about how AI spends have doubled just in the last few years, but what are we talking about? What could this transformation lead to in terms of market opportunity?
Shireen, you remind me a couple of years ago while making investor presentations,
yes,
I would show the TAM of enterprise software to be about 400 billion.
Yeah.
More recently, if I make an investor presentation, I'll say the TAM for enterprise AI is 4 trillion. And the reason is that enterprise AI isn't replacing enterprise SaaS. It's actually going after the manual tasks that we as human workers would have done.
Yeah.
Now, it's not a zero-sum game from where we sit. Would there be some near-term job displacement? Very likely. But I don't think it's a near-term zero-sum game where it's AI versus humans in the workplace. I think as some economists have put it, it's not out of realm that 3 to 4 years from now, the US GDP, which is growing at probably 2 or 3%, which is at the fastest rate for many years, it's likely that we could see the US GDP start to grow at close to 10%. Because of the productivity gains of AI. Now, it might mean...
That's a massive productivity lift. You're talking about a massive move up as far as GDP is concerned for the US and the productivity gains that, of course, everyone has talked about. But what are we seeing currently on the ground in terms of the productivity uplift that's already starting to take place?
Absolutely, absolutely. I mean, it also, you have to put productivity in context. What ends up happening is the first wave of AI, when it came out and the large language models came out, everybody introduced large language models into the enterprise and said, go forth and use it.
Yeah.
And productivity didn't go up. Adoption rates did not go up.
Yeah.
And over time, people have realized that the best way to increase adoption is through verticalization, contextualization, bringing it into the context of the workflow and the said outcome that the teams are working on. And every single function that has happened, productivity has been increasing year over year, month over month. There are examples where where teams have seen 20-30% productivity increase as soon as AI was introduced into the workflow, right? From our perspective, from the perspective of KPMG as a global provider, what this does is it helps us move from an episodic business model to a more persistent business model. And so we don't think of productivity increase anymore as a single engagement where we're delivering something of value and walking away and proving the ROI.
So it's much more life cycle.
It's much more life cycle. It's a journey mindset.
Yeah.
And so we want to be able to show that steady increase through adoption, through innovation, through further use case development and so on and so forth, but also partake in that upside. Right? Take the risk on the downside, but partake in the upside. That is the move to persistent, and that is where we're seeing we'll see the productivity increase continue.
Let's revisit the ARR question then. On track for the $1 billion?
We really hope so, and hopefully in a more accelerated trajectory now. We've really seen in the last 12 months an acceleration of our top line, and that's driven mostly by the consumption of the Business AI Cloud, which we announced, but was already in the hands of partners and customers for several months. So absolutely on path to faster growth. We grew over 70% last year. We think we can at least repeat that, if not more, in the next 12 months. We're really excited by these adoptions, but more importantly, I had a board meeting this morning and I told my board that there's one metric that's even more important than top line growth.
Okay.
And by the end of our fiscal 26, we should be measuring that. And we've said it's a 5x5 framework.
Okay.
By the end of fiscal 26, we'd like to have 5 major enterprises and 5 major partners who are either consulting firms or GSIs who will be using Unifor as their SLM and agentic factory.
Okay.
And the definition is not 1 or 2 agents running somewhere in the company, but every single week, fine-tuning new small language models and creating new AI agents. And the framework, we already have some customers moving in this direction. The framework was given to me by a CIO of a major telco.
Okay.
He said, Umesh, a lot of people come to me asking for headcount in their teams. And there are many teams I can't say yes to, just budget-wise.
Yeah.
Those are the teams I'm sending to Unifor and say,
to get the agents in place.
Get AI agents to start getting more productive. So if by the end of this year, we have that 5 by 5, 5 major enterprises and 5 partners using us as an agentic factory, I think you're looking at the next Salesforce of the AI era.
Wow, that is a big claim, Umesh, and we wish you the very best of luck with that ambition, and we wish you the very best of luck with this partnership as well as what you intend to do with it out in the marketplace with your clients and to unlock the transformative power that both of you have spoken to us about. But thanks very much for joining us here on Voices from the Valley. It's always a pleasure speaking to you. So that's the sum and substance of the many conversations that we've had here in the Valley so far. AI, agentic AI, small language models, perhaps the route to greater success at the enterprise level. That seems to be the consensus here that we've brought you. But of course, more conversations will come up here on Voices from the Valley. If you enjoyed watching this conversation, then log on to our YouTube channel. Visit us on our social media pages. From all of us here for now, goodbye. Many thanks for watching. Welcome to Voices from the Valley. I'm Shireen Bhan. We're here at Menlo Ventures. It's got a 47-year-old history investing in startups, 165 M&A transactions that it's been a part of. Some of the hottest bets that it's making today are in companies like Anthropic. Joining me now to talk about the road ahead for Menlo Ventures and his view on all things AI is a man who has now become a tech influencer. Also, of course, he's a products guy and an investor. Didi Das, thanks very much for joining us on Voices from the Valley. It's great to have you here.
It's a pleasure
on
to
the
be here,
program.
Shireen. Thank you for having me.
Before I talk to you about Menlo, let's get a little bit of your backstory. Cornell, Google, Glean, and now Menlo. How did this come about?
Well, Shireen, you know, I grew up in Calcutta, and when I was in India, what I really wanted to do always was, you know, just to come and be an engineer somewhere in the valley. You know, you'd grow up, you'd look up to companies like a Google that sort of was the bastion of the internet for the longest time.
Right.
And the reason I feel like when I was growing up, I learned so much about the world. And that was really the dream. So when I came to Cornell, I studied computer science. I eventually worked at Google, and I was working on search, and that was sort of the dream for me. With time, though, I realized that the potential and what the Valley really offers is far more than working at a big company, and I knew I wanted to do startups. And that's sort of when I made the transition, and I realized, well, I wanted to start something, but I ran into Arvind. I met Arvind very fortuitously, and then we spoke, and then I joined Glean on the founding team. And that was
your best decision, I believe.
I believe it was a fairly good decision. I mean, Glean worked out pretty well so far. It's a $7 billion company. We saw it grow from, you know, maybe 5 people when I was there to now it's almost a 1,000-person company over many, many places. But really at Glean is what really solidified, oh my God, like this is how companies are built. And after Glean is when I realized, you know what, like there's not enough people on the investing side who are, you know, understand how to build a company, who understand all the work that's involved. And I was I didn't really want to ever go into venture capital. That was never something I wanted. But after doing engineering, product, a lot of hiring, sales, marketing at Glean, I sort of started to understand how businesses are formed. may have made sense to go and start a company of my own, but I realized it would be so much more interesting if I could help a bunch of different companies figure this out on their own. And that's how I sort of moved on to the venture capital side, which is, traditionally an industry where it's full of people from business school who are doing finances, know how to read an Excel spreadsheet. That was never how early stage venture worked, though. You don't have many numbers to go off of. And what you really need is someone who understands technology, how to hire, how to get a company off the ground. And I thought, maybe I'd be pretty decent at that. And that's how I came here. And it's been about a year and a half, and I've been really enjoying it. I feel like it is really, really fun to work with companies who are just getting things off the ground.
A VC with a founder's mindset, is that how you would describe yourself?
I guess so. Like a lot of what founders look for, it's a very intimidating journey. You're doing this thing often for a first-time founder alone, maybe with one other person, and it's very isolating. It's a 24/7 job. You don't know who to look for help, and really all you have is your investor. And if your investor understands that journey and really empathizes with it and knows how to do it, I think that's a pretty good sell, and we can work better together to get that company off the ground. So I would describe it that way.
Let's talk a little bit about Anthropic and the bet that you're making there. $65 billion valuation at this point in time with the latest fundraise. What excites you about what's going on at Anthropic?
Well, there's so many things to name about what goes on at Anthropic. If you look at, we look around the world and almost a lot of people want to be software engineers. Computer science may be the most popular major in, dare I say, the world, if not America. And that's happened maybe in the last 15 years. In many ways, there was this career people would aspire to be in banking or in consulting, and for sort of the cookie cutter way to do it maybe in the 90s. Over time, that sort of shifted to computer science, and there's been so much talent that goes in. What really excites me the most about Anthropic is we're finally seeing a world where that really highly skilled job, you can have a machine do a lot of parts of that. And that's a tectonic shift in like how we even see the future of technology evolving. I, the other day, went on my computer and we were analyzing some data for this company. This was like a 100 MB Excel file. It takes 2 minutes just to even open on your Excel on your computer. And I want to run this analysis. I open up this Anthropic product called Claude Code, and I just say, hey, you know what? I just want you to run a cohort retention analysis on a dollar basis, transaction basis, and a customer basis. That's a task that would normally take, an MBA associate, maybe a week worth of time to do all of this stuff together. It took the computer 2 minutes. It printed out these beautiful, beautiful graphs that I could see. And if that's not magical, I don't know what is. I mean, when we grow up, I was like, this is what you sort of dream of. Like, what do you mean I don't have to write the code and think about it? I can just do what I want to do. So I think that's what's so exciting.
It's magical and scary at the same time. I mean, even the team at Anthropic is warning us about a white-collar bloodbath. So in this context, then, is computer science really going to be the sexy thing that people want to do? Or is our MBA associates going to be a thing in the future? I mean, what are we talking about?
I know it's really scary, and there are parts of, I think, every technological shift that can be a bit scary. I do think that it's really hard to predict the future, obviously, with things like this, and you honestly risk sounding very foolish by even trying to make any predictions. I don't even know what's going to happen 4 weeks from now, right? All of the guesses on how models change, how the intelligence increases over time, we don't know. That being said, if I were to look at history, usually what happens in history is when there is a monumental shift, humans find a way to adapt and do something else. And yes, is it a risk? Are white-collar jobs in danger? Maybe. But one can also make the argument that even if you didn't need 100 people to do the job, you can get the same job done with 10 people. And maybe those 90 people can go do other new things, and it's net more productive to society.
Yeah.
And I know one of the things that everyone always talks about, and it's TBD whether this actually happens, is when are we going to see generative AI actually contribute to productivity and GDP?
Yeah.
And I think it's coming. I mean, it goes without saying, even today, you know, change takes time.
Yeah.
But when I speak to companies, today companies are able to do with less than 10 people more than they've ever been able to do before. We are talking about billion-dollar companies that exist today with, you know, hefty amounts of revenue, less than 10 people in an office. And it's kind of surprising to see. You would not expect that in the yesteryears. Even 5 years ago, a billion-dollar company, you usually say has 250 people, maybe 500.
Yeah.
So just that productivity increase, I'm very optimistic about that future.
Yeah, you know, let's talk a little bit about what's happening in India, especially as far as the AI space is concerned. And I think, you know, there's sort of been this debate on whether we're doing enough deep tech and we should be prioritizing deep tech. And I think that it's a process of, you know, of the evolution of the startup ecosystem, and perhaps we're getting to that point of some degree of maturation where we will start to see that happen. But what do you make of, you know, the AI efforts, the Sarvams and Krutrims and so on and so forth? I mean, you're pretty woke as an influencer. So what do you make of what's going on there?
Well, look, one thing I'll say is, even on the history of companies that are formed, that have been formed in India, the tech companies that have been formed in India, often their right to win is a grasp of the knowledge of the people and the customers that they deal with. For example, if you look at a Zomato, a Zomato would have crushed any other international competitor in India because they were able to execute better on the ground in India. They innovated on the ground on how you can do these things, how you can recruit people, how we can make this business work. India is an example, you know, somewhat unlike China, which is a fairly closed-off marketplace, where we've chosen that we want to compete on a technological level. That's a hard choice to make. Right? Protectionism versus free markets has always been a debate throughout history, and we have chosen a free market path. For all of the companies in the past, that free market path worked out reasonably well. We got the best of companies that were in America and in the rest of the world and their products. And then in our products, we figured out how to make it work on an India scale. With AI, that's a little bit different because it's a pure technology where it's unclear whether your understanding of the local area has any difference in terms of product.
Right.
It's a pure software play. It's a pure, and when you talk about pure plays, it's very difficult to compete with the people here and the companies here. And the reason is you need capital investment. You need talent. You also, you know, some people make the argument of, hey, what if we made models that were very good for Indian languages? Sure. Why would you have more data than someone like Google? Google's sitting on all of YouTube. Google has infinite access to resources to collect data in every single language. And the last point...
So you're saying that's not an advantage either?
Maybe for the short term. Maybe you do partnerships that solidify, that make your product accessible to a lot of people. But at a pure technological level, I find it really hard to like even squint my eyes and see a world where in Hindi or Tamil or Bengali or whatever language you choose, that they don't have more data, they don't have better models, and they don't have cheaper prices.
They may choose not to prioritize it though.
That is always temporary in my opinion. For a company like Google, who is, you know, sort of in their DNA is to build products for the world, internationalization or localization as they call it.
Just a matter of time.
It's just a matter of time. They are prioritizing it at some level, and it will probably come. So the question is, how defensible would be the work that you do today?
And we've got the government coming in and backing, you know, foundational models and saying that we'll have our India model in the next 6 months and so on and so forth. How do you see this playing itself out? The government kind of also, in a way, collaborating, partnering, whatever you'd like to call it. How do you see this impacting business outcomes going forward?
Well, the downside of protectionism usually is you are protectionist when you sort of don't believe there's a current right to win, and you temporarily make some sacrifices to promote local technology in the hope that they will eventually catch up to global technology. And that's sort of I think the premise of supporting sovereign models. I mean, there's security and there's some other stuff too. Given that premise, you still have to believe that these will eventually catch up in terms of power to frontier models. I just don't know if that's the case. It could be the case, but look at the amount of spend these companies have had to do to create the models that they do. I mean, you look under the hood, even say, look at the public rumors on how much OpenAI spends and how much Anthropic spends. We're talking several billions of dollars a year without necessarily seeing profit for a while. And the other question you have to ask is, who will front that cost in India? Is it worth fronting that cost in India? And then you come back to even somewhat adjacent topics, which is that the best use of money in India? It's nice to say you want to compete on a global scale in AI, but to me, it often feels like that shouldn't even be the priority. You know, we wouldn't have said in 1998, hey, let's create a Google of India. It wouldn't have worked, right? Like, and so similarly here, I don't know if an Indian foundation model is competitive or would work as a business. There are local problems to be solved. There are many cases where Indian companies have a huge leg up over companies that are global. And I think you should exploit those opportunities. Why focus on something which is extremely hard to compete with on a global scale? Almost no other country in the world can compete with America on this scale. What gives India the right to compete? I think it's still unclear.
So what excites you about the India startup story today, outside of course, what's happening on AI, where there are questions and doubts at this point in time on how it's eventually going to work. But overall, the India story and the India startup story, how's that looking to you?
I'm so excited about it for primarily the reason is talent. A lot more of a bigger percentage of the world over time of software developers come from India. And add to that what I said earlier about access to skills and being able to learn with these AI and LLM tools, the potential is unbridled. In terms of just talent that can come up in India and do things. That's so broad, and for the foreseeable future, India will be a source of a lot of the global talent pool. And if we can figure out how to retain more and more of that talent, and undoubtedly we will retain a lot of them, then I think there's a lot of opportunity in India. I mean, if you look at just from a cost perspective, hiring an engineer, even an average engineer in the Bay Area, and I'm not one to say that Bay Area engineers are better than Indian engineers. I don't think so. They might look better on paper. But an average engineer, a senior engineer here might cost you $350,000 a year. That's not how much an average engineer in India costs. So what does that do for the ecosystem? That just means India will become a hotbed for both global startups and companies, but also an opportunity for innovation unlike any other. And there will come a time, and this is the story I love the most, there's early signs of this, where India is actually capable of building companies for the world. And you see a couple of these consumer companies, like I like to always look at Pocket FM, probably the biggest one. But you see Indian companies create these consumer experiences that even Americans and the world will consume. And that will continue to happen. And I'm very, very bullish on that.
2025 and 2026, do you believe that we're likely to see consolidation by way of M&A in the startup ecosystem? Some of the names that you spoke of, the IPO markets picking up again, after, at least in the US, after kind of being cold. India, of course, has been a completely different story. But both consolidation as well as IPOs, do you believe we're likely to see things heating up?
Absolutely. I mean, this has been a fantastic year for even Menlo. From that perspective, we've been very fortunate to have Chime go IPO this year, which was a huge IPO after a long time in the entire valley. And then we had some big M&A acquisitions that happened as well, where one of our companies that we funded, Neon, got acquired by Databricks for near $1 billion. So yes, I would say that M&A markets are heating up. I wouldn't say IPO markets are necessarily heating up. They're opening up again. But, most venture capitalists will tell you that there is a stark difference between public and private market valuations. And crossing that chasm, if you will, has become hard because you're so overvalued when you're private compared to the value you can get publicly. That's number one. And then number two is, I think, an increasingly large number of companies want to stay private, which is somewhat the reason that the reason you wanted to go public before is for access to liquidity and capital. Today, you have that liquidity. You can just sell in the private market. There's so many private buyers. There's so much capital that the only incentive to go public is that you want to go public and you want to be listed, and it's some sort of achievement that you have. But who wants to report all their stuff to the SEC? Who wants to abide by all this regulation? It's very, very cumbersome to have predictable revenue and be a public company. So an increasingly large number of companies are just choosing to stay private. And that's something that we also have to contend with. The secondary markets are another way of getting liquidity for investors and people at the company. Secondary markets, M&A is picking up, IPOs opening up, but still I would say wait and watch mode.
Valuations, especially on the AI front, are we anywhere close to the peak, or are we still going to see crazier valuations?
The valuations are crazy. I don't think they're necessarily always justified. A lot of people, will say, hey, look at venture capitalists, they're giving people these crazy valuations. And, in my defense, the one thing I will say is, valuations are really set by the market. And the interesting thing about a private market is there's no downward pressure. There's no equivalent of shorting a stock. In a public market, there's a reason because people can sell it and people can short it. And so there's no incentive for you to artificially blow something up. But in private markets, there's only upward pressure. So when there's access to capital to win good deals, you just pay crazy prices. And we're seeing all of these crazy prices.
So you admit you are paying crazy prices?
No, we are paying crazy prices. I don't think it's like that hard to admit. Just objectively by the numbers, those prices do not make a ton of sense in many situations. You are often, it's not all companies, we often tend to focus and over-focus on the very, very crazy ones. But even the normal ones, I would say, are much higher priced than before, which increases the bar for returns. And that is just the market we live in, because there's access to a lot of capital. Last thing I'll say, though, is venture cycles. The reason this is possible in venture versus, say, like hedge funds who trade public markets is because the time that it takes for you to realize that you haven't done a good job is 7 to 10 years. It's a typical cycle for a fund. So 2021 was a time of reckoning. And a lot of the funds of the 2021 and 2020 vintage are affected as a result. They're not doing particularly well. But this will take 10 years to sort of play out. And maybe if you squint and go to like 2030, people think there will be a time of reckoning for a lot of the funds who have an overflow of capital to be like, we haven't actually done a good job for our LPs. We haven't actually returned money that we were telling them we would return. And then a lot of those funds will cease to exist, perhaps. And that's where you get the reversion to the mean over time. But I don't see it happening in the recent future. Right now, the valuations are still quite out there. You're looking at, maybe the most iconic example of that is Thinking Machines, Mira Murati's company from OpenAI. They started with a seed round of nearly $10 billion. And I don't know how to reckon with that. Like, you don't have a product or make any money. $10 billion is a pretty lofty price for something like that.
So what do you believe the bet is on then?
I wish I knew. We're not investors in Thinking Machines, but for the companies who are, their claim, actually, I do know. I'm friends with some of the people who work with companies like that. Their claim is the outcomes are so large that we can drown out competition with capital. Capital allows us to recruit better. It allows us to have leverage on how we distribute our product, and any other company that tries to compete with us won't compete. Maybe we won't see like a 3x, 4x, 5x return, but hey, even if we see a 2x return on that, that could be pretty lucrative given the amount of capital that's going into this, and maybe it could be at a shorter time period. More notably. So can we keep our internal IRR pretty reasonable, even by paying a really high price up front? Maybe. And the fact is, there's precedent for this. I would say that even if you look at companies like Anthropic, where we did back them, there is precedent for these humongous valuations turning into something even more incredible. We backed Anthropic at first the Series C and then led their Series D. And that seemed like an egregious price to pay at the time, when they made no money, they made no revenue. It was unclear how they would even make revenue. Would they be consumer? Would they be enterprise? Would they have the frontier models or not? All of that was very unclear. And we made such an insane bet, and you fast forward now and you kind of look like geniuses. Like, the company is doing so well, it's valued at $60-something billion. So there is precedent for that.
Didi Das, the entrepreneur, Didi Das, the investor. Where do you find that you're most comfortable today?
I mean, I think I would always be more comfortable in an entrepreneurial setting. I think that is the source of anything that I've been able to do or otherwise as an investor. So that's always going to be my choice. Entrepreneurs are the lifeblood of the Valley.
Well, there's plenty of that energy here in the Valley, and we hope we continue to see you fund a lot of that energy, at least in this avatar at this point in time. But thanks so much for joining us.
Thank you so
on
much,
Voices from the Valley. Appreciate you joining us here on the program. That's Didi Das. If you enjoyed that conversation, visit us on CNBC-TV18.com, on CNBC-TV18 Prime and Access. Log on to our social media pages. We'll see you again next week. Till then, from all of us here on the team, for now, thanks very much for watching. Welcome to Voices from the Valley. I'm Shireen Bhan. We're here at Menlo Ventures. It's got a 47-year-old history investing in startups, 165 M&A transactions that it's been a part of. Some of the hottest bets that it's making today are in companies like Anthropic. Joining me now to talk about the road ahead for Menlo Ventures and his view on all things AI is a man who has now become a tech influencer. Also, of course, he's a products guy and an investor. Didi Das, thanks very much for joining us on Voices from the Valley. It's great to have you here.
It's a pleasure
on
to
the
be
program.
here, Shireen. Thank you for having me.
Before I talk to you about Menlo, let's get a little bit of your backstory. Cornell, Google, Glean, and now Menlo. How did this come about?
Well, Shireen, I grew up in Calcutta, and when I was in India, what I really wanted to do always was, just to come and be an engineer somewhere in the Valley. You'd grow up, you'd look up to companies like a Google that sort of was the bastion of the internet for the longest time.
Right.
And the reason I feel like when I was growing up, I learned so much about the world. And that was really the dream. So when I came to Cornell, I studied computer science. I eventually worked at Google, and I was working on search, and that was sort of the dream for me. With time, though, I realized that the potential and what the Valley really offers is far more than working at a big company, and I knew I wanted to do startups. And that's sort of when I made the transition, and I realized, well, I wanted to start something, but I ran into Arvind. I met Arvind very fortuitously, and then we spoke, and then I joined Glean on the founding team. And that was
your best decision, I believe.
I believe it was a fairly good decision. I mean, Glean worked out pretty well so far. It's a $7 billion company. We saw it grow from, maybe 5 people when I was there to now it's almost a 1,000-person company over many, many places. But really at Glean is what really solidified, oh my God, like this is how companies are built. And after Glean is when I realized, you know what, like there's not enough people on the investing side who are you
know how to start a
understand
company.
how to build a company, you understand all the work that's involved. And I was I didn't really want to ever go into venture capital. That was never something I wanted. But after doing engineering, product, a lot of hiring, sales, marketing at Glean, I sort of started to understand how businesses are formed. May have made sense to go and start a company of my own, but I realized it would be so much more interesting if I could help a bunch of different companies figure this out on their own. And that's how I sort of moved on to the venture capital side, which is, traditionally an industry where it's full of people from business school who are doing finances, know how to read an Excel spreadsheet. That was never how early stage venture worked, though. You don't have many numbers to go off of. And what you really need is someone who understands technology, how to hire, how to get a company off the ground. And I thought, maybe I'd be pretty decent at that. And that's how I came here. And it's been about a year and a half, and I've been really enjoying it. I feel like it is really, really fun to work with companies who are just getting things off the ground.
A VC with a founder's mindset. Is that how you would describe yourself?
I guess so. Like a lot of what founders look for, it's a very intimidating journey. You're doing this thing often for a first-time founder alone, maybe with one other person, and it's very isolating. It's a 24/7 job. You don't know who to look for help, and really all you have is your investor. And if your investor understands that journey and really empathizes with it and knows how to do it, I think that's a pretty good sell, and we can work better together to get that company off the ground. So I would describe it that way.
Let's talk a little bit about Anthropic and the bet that you're making there. $65 billion valuation at this point in time with the latest fundraise. What excites you about what's going on at Anthropic?
Well, there's so many things to name about what goes on at Anthropic. If you look at, we look around the world and almost a lot of people want to be software engineers. Computer science may be the most popular major in, dare I say, the world, if not America. And that's happened maybe in the last 15 years. In many ways, there was this career people would aspire to be.
Hello and welcome to Global Eye. I'm Parikshit Luthra. The Trump administration continues to crack down on immigration. US visa applicants are now required to list all social media usernames or handles of every platform they have used from the last 5 years on their form for background checks. The US State Department referred to each visa adjudication as a national security decision. In a post on social media, the US Embassy in India cautioned applicants against omitting social media information, saying that it could lead to visa denial and future eligibility. Earlier, the US Embassy also asked those applying for student visas to switch the privacy settings of their social media accounts to public to facilitate vetting. How is this move expected to impact visa applicants? Joining us now to discuss this is Piyush Kumar, Regional Director, South Asia, Canada and Latin America at IDP Education. Thank you for being with us. Piyush, let me begin by asking you, how has this changed the time taken for processing visa applications for students?
Well, if you talk about India, I would say currently the visa applications are in a pause mode. So what I mean is that the students who had not got the visa interview slots, currently the visa interview slots have not been opened, and hence, obviously, till the time they get opened, the processing will not begin. For students who had already submitted their visa applications and had got the visa interview slots, for them the time taken has not changed. It is just what it always used to be, which is for US, which is pretty good. But if a student has not yet got the visa interview slot, then they are waiting for quite some time. I think it's almost like more than 3 weeks since the pause was done, and we are still waiting for the government to lift it. Although the US government has announced that they are going to lift it, but in India we have still not seen the visa interview slots open up.
Right. Now, when it comes to the social media vetting policy, over the last 2 to 3 weeks, we've seen different updates to that. One which says that switch your privacy setting from private to public, give all the social media information, all your handles from across platforms in the last 5 years to the US government. If there is anything objectionable, your visa application can be rejected. Is there any clarity on the kind of content a prospective applicant should not be putting there on social media?
Absolutely. One interesting thing to note is that this requirement is not new. Actually, if you look at the DS-160 form, which is the visa application form, the requirement to declare your social media handles has been there since 2019. But it is only now that it looks like that the US government is very serious in implementing this policy. And hence, this is the first time they have asked their students to change their profile settings to public, declare all the social media handles which they have been using for last 5 years. And what we understand is that the US consulate is looking for evidence which could be related to any potential fraud, any inconsistency in their profile, and most importantly, any post, comment or like which they would consider potential threat to national security. So students should be very careful about their posts, comments, likes, and even things like their profile names, which are going to be scrutinized for anti-Semitism, anti-US, hateful, politically motivated or threatening material.
Right. I would also like to ask you, when it comes to vetting of social media accounts, like you're saying, it's happening more aggressively right now. And there could be cases where you may be rejected. And it is also saying, the advisory is also saying that even after you get your visa, you will continuously be monitored. So even if you go to the US, you have to be very careful about what you're posting.
Absolutely, that is absolutely correct. So just because a student has got the visa successfully, it doesn't mean that this process has ended. So during their entire course of study, so right from going to the US when, for example, at the port of entry, the same questions could be asked, right? So they may still want to see your social media profiles. Some questions still could be asked. We know for a fact that some of the questions which are getting asked is, what is the student view about the Israel and Iran war? What is their view about, what do they think about America as a country, right? So these questions are getting asked. So, what is going to happen is till the time you are in the US, during that entire period, the students need to be very careful about what they are posting or commenting on or liking what kind of posts, etc. The US government is very clear that they would not allow anything which is against their declared national policy.
Right. Does this apply only to J, F and M visas, which are either exchange programs or student visas, or does it apply to all categories?
It also applies to, I would say, long-term non-immigrant categories. Like, for example, it could apply to H-1B, L-1 kind of visas also. So it's not only limited to student visas.
Right. Does the student have any recourse in case the visa is rejected? Because the advisory from the US government also says that this is a privilege, not a right.
Well, the only thing which the student can do is to reapply, right? I mean, when the US consulate rejects the visa, they would typically give a reason why the visa is rejected. So I think the students need to go and relook at their visa application, check what exactly is the reason being mentioned, and maybe take corrective action and then reapply. That is the only thing which you can do. As you rightly said, the US government is very clear that it's a privilege, not a right. So I would advise the students to be careful, do it right the first time. But in case, if you unfortunately get your visa rejected, do have a relook at your profile and look at the reasons what have been mentioned and take corrective action and then reapply.
Right. My final question would be, would you now advise students who are looking to go to US to possibly consider other locations as well, considering there is a pause on fresh interviews, there is so much of social media vetting, and there is uncertainty about the visa process in India?
Well, this is again something which frankly depends on the students. There are many students, see, we actually engage with thousands of students. There are many students who are very, very clear that they want only to go to the US because of the quality of education. We all know that US has really got world-class institutions. So there are students who are very clear that they would want to go to the US only, and they are even willing to defer their intake by 1 year if need be, if they don't get visa on time. But yes, there are a certain category of students who have started thinking about other destinations, like, for example, going to the UK or Australia or Canada. So yes, depends on the students. There are people who are very clear about the US. There are people who are also willing to look at other destinations, considering that these other destinations also have some really world-class institutions. So we see students in both categories. We are not advising anyone not to go to the US because there are still a large number of students going to the US and things are very fine. As you know, a very large number of Indian students are currently studying in the US and things are absolutely fine with them. As long as students are not indulging in any activity which the US government thinks is breaking the rules and regulations of their visa, I think things are fine.
All right. Thank you very much, Piyush, for joining us. That's indeed an important conversation, and students should listen to this, especially if they are looking to go to US for education. Let's move on and focus on India-China relations. And we're going to look at two issues today. China has halted its specialty fertilizer shipments to India in the last 2 months, while continuing its exports to other nations. These fertilizers are crucial for enhancing yields of fruits, vegetables. Chinese officials are reportedly avoiding inspection of India-bound consignments. This has effectively blocked exports through procedures. 80% of India's requirements for these fertilizers come from China. Beijing has also restricted the export of rare earth magnets to other countries, including India. And even though China has started releasing magnets on a case-by-case basis for companies in Europe and US, they've not released any consignment of magnets for India. Now, taking this discussion on fertilizer forward, I'm now joined by Rajiv Chakrabarti, National President, Soluble Fertilizer Industry Association. Thank you so much for joining us, Rajiv Chakrabarti. Let me begin by asking you, China was always blocking the supply of specialty fertilizers, but has this now completely come to a halt? What has changed?
Thank you, Parikshit, for having me in this show. For the general understanding of the audience, I would like to give a brief introduction of specialty fertilizer in India. Specialty fertilizer is different from the subsidized fertilizer. In India, fertilizers are governed by fertilizer control order. There are two categories of fertilizer. One is subsidized fertilizer. In this category, there are products like urea, DAP, SSP, and all. For these products, India is self-sufficient. For the specialty fertilizer, which is non-subsidized, there are four categories of fertilizers. One is soluble fertilizer, which is the primary nutrient supplier, the organic fertilizer, micronutrients, and biostimulants. For these fertilizers, we are dependent on external sources. India started using water-soluble fertilizer in 1993. The major recognition came in 2002 when the government listed water-soluble fertilizer in FCO, and then onwards, this revolutionary fertilizer started showing its results. It can be seen from the growth in grape cultivation and the success in grape cultivation. It's a great story that is to be narrated, and it is to be followed everywhere. Now, the specialty fertilizers are some fertilizers which are actually replacing the subsidized fertilizers. So it is why it is so important, because it is very high yielding, low in residue, high in quality. It makes the fruits and vegetables exportable, longer shelf life. It is very nutrient rich, and above all, it is highly profitable for the farmers. Yes, you are correct. Right. China has been putting ban on restrictions or delaying consignments for quite some time. We as an association have been negotiating with CCPIT and other organization in China to get the supply sources stable. This time China has restricted it in a different mode, and it is very sudden. So consignments are not coming to Indian ports.
Okay. Have you taken this up with the Indian government so far? Can we also link it to the rare earth magnet issue? China, for the last 3 to 4 months, is not releasing rare earth magnets to India. This is a worldwide policy, but in India's case, they're not giving licenses at all. Have they stopped fertilizer, specialty fertilizer exports to all nations, including India? Or here, there is a specific treatment for India itself?
Earlier, there was delay for all nations, but this time, some consignments are going to other nations, but not to India. They have not issued any written explanation for this, but we have understanding that this CIQ arrangement, which is inspection arrangement in China, which is not getting approval from the Chinese authorities. So we are preparing a couple of things, because we understand that this can be a problem for the supplies. So we have been doing a lot of things at our end. Approaching various other suppliers outside China, and then organizing trade fairs and direct communication with associations abroad. We are also contacting the embassies, Indian embassies overseas. They are also helping us.
Rajiv Chakrabarti, what I'd also like to understand from you, how badly are we getting impacted with the absence of these specialty fertilizers from China, which are the particular sectors within India's agricultural framework which are getting directly impacted, where production could be impacted in the next few months?
In the Kharif season, there is not much consumption of specialty fertilizer. This is the time for subsidized fertilizer only. The actual consumption starts from September onwards. So we have 3-4 months where there will be not much consumption. But then for the next season, we need stable